Easing, the U.S. Federal Reserve delivers an outsized 50 basis points cut amid signs of inflation easing and a weakening labor market. The Fed's dot plot also indicates another 50 basis points rate cut by the end of the year. The S&P 500 and the Dow Jones hit record highs but slipped to close in the red after the Fed's 50 basis points cut. Asian markets opened largely higher, while the GIFT Nifty is suggesting a flat start for our own markets. Crude oil prices snap a two-day gaining streak, with Brent falling to around $73 a barrel even as the US Fed delivers an outsized rate cut. Gold prices ease after hitting record highs. Andhra Pradesh approves a new liquor excise policy. The state decides to adopt a private liquor retail system as part of an attempt to increase management efficiency. The new policy comes into effect from the 1st of October. And a day after exploding pagers injured thousands of Hezbollah members in Lebanon, walkie-talkies explode, killing at least 20 and injuring over 400 more in cities across Lebanon. Hezbollah continues to blame Israel for the attacks and promises fair punishment in return. The Fed rate cut has finally happened. The US markets have reacted to it, and how will our own markets react to that? We'll bring you all of that on this edition of Power Breakfast on CNBC-TV18 in the Mumbai News Center. I'm Hormus Fatakia, and of course the top story this morning is the big rate cut from the US Federal Reserve. The US Central Bank has lowered interest rates for the first time in more than 4 years and has cut its overnight lending rates by 50 basis points. CNBC's Steve Leisman brings us more on this.
50 basis points, the Federal Reserve cutting interest rates by 50 basis points to a new range of 4 3/4 to 5%. There was one dissent, Fed Governor Michelle Bowman preferring to cut by 25, but 11 voting in favor of 50. It might have been close. I'll come back to that at the end of this report. The statement says the committee will consider additional adjustments to policy based on the data, the outlook, and the balance of risks. The summary of economic projections saying an additional 50 is expected or forecast by the median Fed member for this year, for a total of 100 this year. That would bring the median down to 4.4%, or an additional 50 basis points from where we are right now. Another 100 basis points of cuts expected through next year, bringing the rate down to 3.4%. All of that a bit above where the market is priced. And the new long-run rate would hit 2.9%. That's up a tick by the year 2026. The statement now says the Fed is firmly committed to supporting both maximum employment and the 2% inflation target. Before and for many months before this, the Fed had relied solely on saying it was focused on the inflation target. The committee has gained greater confidence, the statement said, that inflation is moving to that 2% target, and risks to both sides of the mandate now are said to be roughly in balance. On the economic description, the economies continue to expand, it says, at a solid pace. Job gains, however, have slowed. Inflation making further progress towards 2%, but remains elevated. It's seen declining to 2.3% this year, 2.1% next year, and hitting the target 2% by 2026. Unemployment, the outlook for unemployment did tick up. I think that's important to what the Fed said here and what it did. Up 0.4 to 4.4%, 2 ticks higher than it is right now. Growth pegged at 2%, slightly above the 1.8 potential, well into 2027. Now, 9 officials in the dot plot wanted to do 75 basis points or less this year, and 10 wanted to do 100 or more. So it may have been a very close call as to what was actually wanted around the table in terms of 25 or 50 today, but they decided ultimately with 11 voting in favor of the 50 basis point rate cut.
Now, in the press conference addressing the media, Jerome Powell commented about the change in the policy stance coupled with favorable economic data can aid the Federal Reserve in bringing the inflation down to 2%. Listen to what he had to say.
We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond.
Jerome Powell, the most important global voice these days. Now, on that note, let us also listen into some important reactions coming in on the Fed's interest rate cut decision. Listen in.
I was a little surprised they went with 50. I thought they were going to do 25. But I think he gave very good explanation for why they did 50 this meeting. It was really in two parts. The first part was that the employment data has been a good bit weaker since the July meeting, and had they known how much weaker the payroll employment would be, they might very well have acted back in July. And the second is he used the term recalibrate several times. And I think what that reflects is they've had more progress than they expected on inflation. The employment data has been a little bit weaker. And so they wanted to get the Fed funds to be less tight, to be more reflective of the current economic conditions that the economy is facing.
I thought it was a super confused message, and the market is acting in a super confused way. It's really weird to have someone ask Jay Powell, how do you explain to consumers that you've gone in this aggressive way, 50 basis points? And his answer is the economy's in a good place. That was strange. It's strange to say that we're not going to move quickly, and nothing about the projections suggests we're in a rush. But we just did a 50, which we don't normally do. 50s are really unusual. 50s are reserved for times of something super important happening. And why was it necessary to do so much right here? You could have indicated that you're going to be on a faster path and open up 50s if you need them. But the whole rhetoric really was odd to me.
Well, some reactions there in response to the Fed policy and in the US markets as well, because the benchmark indices hit record highs earlier after the Fed announcement, but sold off immediately and ended in the red. The Dow Jones erased gains of almost 400 points to end lower by 100 points. The S&P 500 and the Nasdaq both lost around 0.3% each. The 10-year Treasury yields edged lower to settle at 3.685%, its second lowest closing level of the year, while the dollar weakened against a basket of major currencies. Now let's also now get you some voices explaining the market's reaction to the Fed's decision.
The market got exactly what it wanted, but it also got almost exactly what was priced. And I think that's the reason we saw such a muted reaction, not just across treasuries, but as you noted, across dollars and across stocks too. For equities, it's not just about what the Fed is doing, it's about expectations. And as big as the move was today, it didn't really do much to change expectations. A lot of investors in our conversations were concerned about that potential negative signal from a 50 basis point cut, but I don't think that's what happened in the market today. I think it was coming into the meeting, investors expected the Fed to cut by about 200 basis points in the next year and a half, and that's what the dot plot showed us. So as we would say here, a typical buy the rumor, sell the news type of event.
A lot of these emerging market stock markets are performing much, much better than the U.S. market. If you look at Taiwan, if you look at India, you'll see that those markets have outperformed the S&P 500 over a 5-year period. So I think you're going to see more and more of that in emerging markets as money flows back into these markets. I was very leery previously, except for India, but now I'm much more bullish because of these rate cuts and the general dynamics of how money in America is going to be flowing outside. And just remember, the biggest pool of money is in the U.S. And if U.S. investors begin to get more interested in what's overseas, emerging markets are, of course, going to benefit.
Buy the rumor, sell the news is what played out on Wall Street last night. And let us now take a look at how the Asian markets are faring in response to that. Mostly it's a mixed picture, but the gains are coming in from the Japanese markets because the Nikkei is trading with gains of over 2%. The rest of the markets are absolutely flat. As you can see, the Taiwanese index is flat, as is the Hang Seng. Losses coming in from South Korea. The Kospi has resumed trading after a holiday. That's down 1%. But the Nikkei is the outperformer this morning, trading with gains of around 2.5%. Pull up the GIFT Nifty as well, and that will give you a picture of how our own markets are likely to fare. A slightly subdued start for our own markets. The implied open currently suggesting around a 20-point uptick at the start of the trading session. Remember, it's also the weekly expiry of the Nifty today. Time for a short break. Up next, we'll tell you how will all of these overnight cues impact our own markets. Stay tuned. We'll be back with the Power Prep segment.
'25 with a very dovish, aggressive stance towards cutting rates. You still have December for the RBI, and therefore those sectors still play out. Government spending really hasn't kicked in yet, and private capex is still to kind of pick up to the levels I would like to get that multiplier effect where we could go into the second half of the fiscal year saying, okay, earnings will start to increase again. I'm not seeing that.
Welcome back, and on to our Power Prep segment now. Our research team joins in with how the trade setup is looking like, the stocks that are likely to be in the news, and the setup on the FNO side as well. Vamakshi now first joins us to get us all the market cues you need to watch out for. Vamakshi, good morning. The handover from the US markets has been pretty choppy, but what's the setup looking like on our end?
Well, absolutely, Hormaz. Let me first look at how the trading session went by yesterday. The Indian markets were, there was a choppy session here as well. India VIX was up nearly 6% today, and in fact, the Nifty and Sensex hit a record high intraday, but this was followed by a very sharp decline. Nifty declined by almost 200 points from the day's highest point to the day's lowest point. The Sensex similarly was down nearly 600 points from the day's highest point. But in the last hour of trade, recovery kicked in, and as a result, Nifty ended with a modest cut of 0.2%. The Nifty IT remained a major drag. In fact, it posted the biggest single-day loss since August 5. The financials, however, bucked the trend in a weak market, and in fact was the top sectoral gainer. The broader indices, however, continued to underperform. Very sharp cuts were seen, especially on the Nifty Mid-Cap Index, which ended the session with cuts of nearly 0.7%. So this is how the trade panned out for the Indian markets. Of course, today will be in focus because of the Fed rate decision. The Fed has slashed the interest rate by nearly 50 basis points, and resultantly, we saw the S&P 500 and Dow rally to record highs initially reacting to this news flow, but all three of the indices on Wall Street reversed course and ended the day with modest cut. The Asian markets, however, are looking up. As far as the day today is concerned, we will be watching out for Bank of England's rate decision and the US initial jobless claims. Also, keep an eye out on a couple of IPO subscriptions which closed today. Keep an eye out on Western Carriers, Arcade Developers, and Northern Ag Capital. Overall, the handover that is coming in from Wall Street does look choppy, but GIFT Nifty is indicating a positive start to the trading session today.
Building on the gains is the GIFT Nifty. Vamakshi, thank you for that. Now over to Winnie, who would list out the stocks you need to watch out for today. Winnie, good morning. What's on your list?
Good morning, and I'm going to start with IREDA. That's going to be in focus after the government has approved dilution of 7% of its stake in the company. They'll be raising around 4,500 crores IREDA via QIP, so keep an eye out on that one. Moving on, Garden Reach Shipbuilders also in focus. They've received a $54 million order, and this is from Carson Radar Schiffsmakel, and big order win coming in for Garden Reach. Aavas Finances, the board is approved a fundraising of around 630 crore rupees, and this is via NCDs. So keep an eye out on that. GET&D India, that's in focus after the promoters are looking to sell up to 11.7% equity in the company. This is going to be via OFS. The floor price of that is at around 1,400 rupees per share. And today it's opening up for retail investors. Tomorrow it's going to be for non-retail investors, the OFS that is opening up. Keep an eye on that. Macrotech Developers, they've signed an SPA with Ivano Warehousing India, and this is to acquire an interest in digital infra platform for around 240 crores. Lastly, we have BL Kashyap also, that's in focus on a back of an order win of around 221 crores. And Ugro Capital, they are also to consider fundraising plans on 23rd of September. So keep an eye out on all these stocks today.
Winnie, thanks a lot for that. Over to Mangalam now, who joins in with cues from the FNO space. Mangalam, good morning. Will today be the day when the Nifty finally breaks out of that range?
Well, who's to say, but more than the Nifty, it'll be the Nifty Bank which will be in focus. Because if you look at yesterday as well, the Nifty ended mildly lower, but it was a tug-of-war between the banking stocks as well as the IT stocks. So on the one hand, the Bank Nifty went perilously close to its all-time high. And if you look at the contribution chart as well, it'll line up as two cricket teams. On the one hand, you have some really strong batters, the likes of HDFC Bank, ICICI Bank, even Bajaj Finance and Shriram Finance did well. Whereas on the other hand, you had Infosys, TCS, Reliance, HCL Tech and the others that dragged the index as well. The two things that I'm watching out for, one was the mid-cap index in the broader markets. If you look at the advanced decline lines, for two trading sessions now, it has been favoring declines, and those lines haven't been very different for 2 days in a row, where nearly 15 to 1700 stocks have been declining. And the second part, after declining for all of last week, the India VIX in the last hour of trade yesterday spiked by about 6.5%. So those are a couple of factors that we'll be watching out for. And the Nifty Bank itself, yesterday again, like I said, went very close to that 53,000 mark. A lot of call writing was visible at the 53,000 mark. So could it have been a weekly options expiry impact that it could not cross that mark? And if it does cross it today, because you remember US rate cuts put pressure on RBI to go ahead and cut the rates as well at some point in time. And if that were to happen, then all these rate sensitives will benefit. How far is the Nifty Bank away from a fresh record high? Close to around 500, 600 points. So that's something that we'll keep an eye out on. GIFT Nifty indicating a mild positive start. The FIs are on the extreme long side right now. Yesterday as well, they bought around 1,400 crores in index futures, but nearly all of that and a little more was directed towards Nifty Bank. Nifty, they've unwound some positions, so 200 crores worth selling in the Nifty futures itself. The FI long contracts are now at 69%. Closer to 70% is where we start to, feel a little overheatedness in the market itself. For the Nifty, there has been a fair amount of writing at the 25,500 call. So initially, 25,550 or thereabouts is a hump that we need to cross, because above that, there has been a lot of punt buying at the 25,800 and 26,000 calls as well. The support now, after yesterday's fall, has come a little lower from close to 25,300. It's come down to close to 25,200 itself. That's the writing that we've seen at the 25,250 put. Just a couple of stocks that I'll be watching out for. OFSS, a big decliner yesterday, has entered FNO ban. And on the other hand, we've had Hind Copper, which is out of FNO ban.
Thanks a lot for that update on the FNO side as well. Time for a short break. Up next, we get you cues from the commodity space. Stay tuned. Back on the other side.
Today is National Voter Registration Day, and we are asking you to please join us in going to iwillvote.com to check your status and vote early like we do.
We are voting for Kamala Harris and Tim Walz because they are fighting to protect our reproductive freedom, our planet, and our democracy.
We can't let extremists control our lives, our freedoms, and our future. The only way to stop them and the dangerous Project 2025 agenda is to vote and elect Kamala Harris.
Vote like your life depends on it, because it does.
Go to iwillvote.com and make a plan to vote early.
Love you guys.
Welcome back. Now, the Union Cabinet has approved the proposals tabled by a high-level committee led by former President Ramnath Kovind on simultaneous polls. Union Minister Ashwini Vaishnav, while making the announcement, said that the government will form a panel to implement the reform, which was once the BJP's top manifesto promises. Vaishnav also said that the government will aim to build consensus over the next few months. The panel has recommended simultaneous polls to the Lok Sabha and the assemblies as the first step. It then suggested the elections to the municipalities and panchayats be synchronized with those for Lok Sabha and the assemblies. The panel proposed that the synchronizing needs to be done in a way that the local body polls are held within 100 days of those to the Lok Sabha and state legislatures. The high-level committee led by Kovind has reached out to 62 political parties for their feedback during the consultation process. 47 parties responded. 32 political parties, mostly those affiliated to the NDA, were in favor of simultaneous polls, while 15 political parties, mostly those belonging to the opposition alliance, opposed the move. On to some more news updates from West Asia. Now, handheld radios used by armed group Hezbollah detonated across Lebanon in the country's deadliest day since the cross-border fighting erupted between the militants and Israel nearly a year ago. Lebanon's health ministry said that 20 people were killed and more than 450 were injured, while the death toll from Tuesday's pager explosions rose to 12, including 2 children, with nearly 3,000 people injured. Meanwhile, an explosion disrupted a funeral in a town in southern Lebanon. The attacks, which were widely believed to be carried out by Israel targeting Hezbollah, have also killed civilians and hiked fears that the two sides' simmering conflict could escalate into an all-out war. And Manisha Gupta now joins in with all the updates from the commodity space. Manisha, good morning. Gold is shining after the Fed rate cut.
Oh, it is, and as expected, we did see an all-time high of $2,600 an ounce on the 50 basis point rate cut. But since then, it also went into a profit-taking, and that is because the dollar index and the bond yields gained on the U.S. Fed future guidance, where it says that the Fed is not in rush to ease policy, and 50 basis points is not the new pace. So markets are now accounting for 25 basis points, 2 rate cuts going forward for the rest of this year. Hong Kong also has cut rates by 50 basis points yesterday, and the street is now moved on and will watch out for the Bank of Japan and Bank of England monetary policy meetings for the rest of this week, where there's also an expectation that you will see rate cuts coming in from them as well. Same is the case with the crude oil prices. We saw the prices gain up on the rate cut. All the commodities did give a knee-jerk reaction, but post that, the U.S. Fed press meet, the kind of statements and the mood that came in did lead to profit-taking as well. For the crude oil prices, the reason that it is holding above 73 is also that the U.S. crude inventories have declined way more than what the street was anticipating by 1.63 million barrels. Same was the case for the metals as well. On one side, it is the strength in U.S. dollar post the rate cut. On the other side, the weak China data is weighing on. The China unemployment has gone up, the home prices and the industrial output data has declined, and that's weighed onto metals, which all have, by the way, posted negative movement in the last 24 hours. So zinc is slipped by 1% overnight. Copper and aluminum fell by 0.5% to 1% as well. With the kind of decline that we've seen in metals, the street is now waiting, watching if China would come out with more stimulus measures, and that perhaps is the only thing that can lead to some buying right now in metals.
Manisha, thanks a lot for all of that updates from the commodity space. But with that, it's a wrap on this edition of Power Breakfast. From me and the team that put this show together, thank you so much for watching. Bazaar Morning Call up next to set you up for today's trade.
ये सिर्फ आम आदमी पार्टी में हो सकता है, अरविंद केजरीवाल जी के नेतृत्व में हो सकता है कि एक फर्स्ट टाइम पॉलिटिशियन एक राज्य की मुख्यमंत्री बने। मैं खुश हूं कि अरविंद केजरीवाल जी ने मुझ पर इतना भरोसा किया है, लेकिन जितना सुख आज मेरे मन में है, आज उससे बहुत ज़्यादा दुख भी मेरे मन में है। दुख इसलिए कि दिल्ली के लोकप्रिय मुख्यमंत्री मेरे बड़े भाई अरविंद केजरीवाल जी आज इस्तीफा दे रहे हैं। मैं आज ये ज़रूर कहना चाहती हूँ आम आदमी पार्टी के सभी विधायकों की तरफ से, दिल्ली की 2 करोड़ जनता की तरफ से, कि दिल्ली का एक ही मुख्यमंत्री है और उस मुख्यमंत्री का नाम अरविंद केजरीवाल है। भारतीय जनता पार्टी ने पिछले 2 साल से अरविंद केजरीवाल जी को परेशान करने की, उनके खिलाफ षड्यंत्र रचने की कोई कसर नहीं छोड़ी। अगर अरविंद केजरीवाल जी की जगह कोई और मुख्यमंत्री होता, कोई और नेता होता, तो वो 2 मिनट नहीं सोचता मुख्यमंत्री की कुर्सी पे बैठने के बारे में। लेकिन अरविंद केजरीवाल जी ने वो किया जो आज तक इस देश का इतिहास तो छोड़िए, शायद दुनिया के इतिहास में किसी नेता ने ना किया हो। उन्होंने कहा कि मेरे लिए सिर्फ सुप्रीम कोर्ट का फैसला काफी नहीं है, मैं जनता की अदालत में जाऊंगा। जब दिल्ली की जनता मुझे कहेगी कि हम तुम्हें मुख्यमंत्री के रूप में देखना चाहते हैं, जब दिल्ली की जनता कहेगी कि तुम ईमानदार हो, तब मैं मुख्यमंत्री की कुर्सी पर बैठूंगा। मुझे नहीं लगता कि हमें लोकतंत्र के इतिहास में ऐसा कोई त्याग का उदाहरण मिलेगा जो आज अरविंद केजरीवाल जी ने देश के सामने रखा है। दिल्ली भर में लोग बहुत दुखी हैं अरविंद केजरीवाल जी के इस्तीफे से। तो आज सभी दिल्ली वाले ये प्रण ले रहे हैं, सभी दिल्ली वाले इतने गुस्सा हैं, भारतीय जनता पार्टी के षड्यंत्र से नाराज हैं और अपने बेटे, अपने भाई अरविंद केजरीवाल जी को फिर से दिल्ली का मुख्यमंत्री देखना चाहते हैं। क्यों देखना चाहते हैं दिल्ली वाले अरविंद केजरीवाल जी को फिर से मुख्यमंत्री? क्योंकि उन्होंने देखा है कि भारतीय जनता पार्टी की 22 राज्यों में सरकार है, किसी एक राज्य में भी वो फ्री बिजली, अच्छे स्कूल, अच्छे अस्पताल, मोहल्ला क्लिनिक, फ्री बस यात्रा नहीं दे पाते हैं। और एक ईमानदार अरविंद केजरीवाल है जो दिल्ली के लोगों को इतना कुछ देता है। मुझे पता है कि भारतीय जनता पार्टी अपने एलजी साहब के थ्रू दिल्ली वालों के खिलाफ षड्यंत्र रचेगी। मुझे पता है कि वो दिल्ली वालों की फ्री बिजली रोकने की कोशिश करेंगे। मुझे पता है वो दिल्ली वालों के अस्पताल में फ्री दवाइयां रोकने की कोशिश करेंगे। मुझे पता है वो मोहल्ला क्लिनिक बंद करने की कोशिश करेंगे। मुझे पता है वो सरकारी स्कूलों को खराब करने की कोशिश करेंगे। तो अगले कुछ महीने तक, जब तक ये जिम्मेदारी मेरे पास है, मैं दिल्ली के लोगों की रक्षा करने की कोशिश करूंगी और अरविंद केजरीवाल जी के मार्गदर्शन में दिल्ली की सरकार चलाऊंगी। मेरा अपने सभी कार्यकर्ताओं से, सभी विधायक साथियों से, दिल्ली के लोगों से बस एक ही अनुरोध है, आप में से कोई मुझे बधाई मत दीजिएगा, आप में से कोई मुझे माला मत पहनाइएगा, क्योंकि मेरे लिए और मुझे लगता है सभी दिल्ली वालों के लिए ये एक बहुत दुख की घड़ी है कि दिल्ली के चहेते मुख्यमंत्री को आज इस्तीफा दिया है। मैं एक बार फिर अरविंद केजरीवाल जी का धन्यवाद करती हूँ जो उन्होंने मुझ पर भरोसा दिलाया, मुझ पर भरोसा दिखाया है। और मैं दिल्ली के लोगों की तरफ से फिर से एक बार ये कहूँगी कि वो जल्द ही आने वाले चुनाव के बाद अरविंद केजरीवाल जी को अपना मुख्यमंत्री देखना चाहते हैं।
Belly of
India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. I'm Prashant. With me, my colleagues Surbhi and Mangalam. I'm here in Delhi, actually in Gurgaon, where the Jefferies India Investor Meet is happening. and we hope to get some perspectives after the big decision overnight, which is, of course, the kicking off of the Fed easing cycle. Surabhi Mangalam, good morning.
Hi, good morning, Prashant. So the event is finally done. An intense volatility, right? It was up, and finally down.
Well, you know, the one thing that I'll be looking at is what is the street expecting now? Largely because 25 basis points with dovish commentary was factored in.
Yeah.
50 basis points with hawkish commentary was factored in. But here's 50 basis points with dovish commentary.
Yeah.
So let's see
and
how
I
it
guess
goes.
that's what unnerved the market. So Prashant, plenty to go over today.
Oh, plenty to go over today. So, you know, let's just dive straight into it, right? I mean, the big talking point, of course, is what the Fed has done. And it's interesting because, you know, you essentially have a situation where the Fed kicked off the easing cycle. I mean, they went from 0 to 5% from the depths of COVID to the high in 2021, to 22 actually. And then we are, for the first time, starting to cut rates. And they've kicked off in a big way, right? 50, not 25. And the market reaction is interesting. Equities actually went up 1%. They were higher through the course of the sort of statement, the press conference, and then they paired gains, and they gave up those gains later. So finally, the close, the S&P was down about 0.25%. The Nasdaq was up about 1/3% or so. Why is that? Markets essentially viewed the meeting with some degree of hawkishness. Let me explain why. And we'll get to specific points in a bit. The basic sort of, you know, thought process, the thinking from a market perspective, right, wrong is a different matter, but the markets took it like this. Markets thought that these guys are doing 50 basis points, right? So it's a big one. That this 50 straight off the bat in the first cut is an acknowledgement that they're a long way off from neutral rate. The neutral rate could be 2%, 3%, depending on who you ask, but it's a long way off. And that starting with 50, they'd want to prevent any further labor market weakness, get to that neutral zone fairly quickly. But the combination of the Fed sort of dot plots, as they call it, the projections, and the press conference and the commentary from Powell essentially implied that this was, you know, this 50 basis point was sort of a catch-up. It was not something which was, you know, 50, 50, 50. It's a catch-up, and that this should actually have come in July. If you listen to the press conference, they were actually questioned specifically to this regard, and Chair Powell actually acknowledged that. He said that we would have cut in July if he had the July data, the labor market data in July, which kind of sparked off that sort of, you know, market volatility, etc. Now, that essentially is the backdrop and the reason why, if you're thinking, well, 50 basis point rates are coming down, why the market's down, this essentially is the reason. Actually, Powell was very explicit. He said that FOMC is not in a rush. And then at another point, he said that 50 basis points is not the new pace. And that, I think, is what the market really was worried about. So, I mean, if you look at the economic projections, they're expecting just 2 more 25 basis point rate cuts this year, which is 50 now, 25, 25, that is 100 total. But at the same time, they've raised their unemployment rate forecast for 2024, 2025, and 2026 as well. So essentially the fear is that, I mean, if the labor markets were to soften meaningfully and the Fed cut by only 25, it may not be enough. I mean, that is, you know, markets day to day for you. And the reason why, I mean, we had a bit of a pullback. Now, the 10-year yield went up 6 basis points to about 3.71. The dollar index, it briefly got to about not 200, but 100.1, 100.15. And then there was a nice move to about 101. Oil prices were down about 1%. We're back at about 70, just under 73. Gold prices hit a new high of $2,600 intraday and then pared back to about $2,550 by New York close. So this is essentially the lay of the land as we begin a fresh trading session. Remember, I would say this, that there is too much nitpicking, and I said this yesterday as well, whether it is 25 or 50. I mean, you know, from that press conference, you can come out feeling hawkish like what the market did, or you can come out with the sort of, you know, feeling that they are ready to do what it takes. The asymmetry in terms of the reaction function of the Fed is very, very large. And, you know, I don't think, despite the commentary, there is any reason to believe that if the labor market were to weaken substantially, I mean, they'd want to be behind the curve. Actually, you know, Powell mentioned explicitly that with this cut, they hope to be sort of in line or in pace with what data shows their way in the future. So I think maybe, I mean, just a day-on-day kind of a thing more than anything else. With this small pullback that we've seen, nothing to really worry about. I'll sort of put in the levels here. The Nifty support comes in at 25,313. Yesterday we had a pullback here as well. That's the 40 hourly moving average. And then you get to the 20-day moving average for the Nifty. And that'll sort of come up on your screens as well. That's 25,133. Bank Nifty was the only index which ended 1% higher, and it closed above the 78% retracement. Yesterday's high of 52,954 is the first level to take out, and then the all-time high, which is 53,357. Remember, Nifty has made its highs and done all that and pulled back a little bit. We're looking at sort of, getting back to newer highs there. For the Nifty Bank, we've not made a new high, so that's essentially the repair that's pending here. Support for the Nifty Bank comes in at the 40 hourly, which is 52,064, and then the 20-day moving average, which is 51,438. The advice is this. I mean, I think GIFT Nifty is indicating a 20, 30-odd point higher start. I mean, start of an easing cycle is good news for emerging markets. It will send flows our way, first to the debt market, fixed income, because there'll be interest rate differential. RBI will only start cutting maybe later this year, much later after the Fed, so that interest rate differential is there and it makes bonds here attractive. At the same time, a rate cutting cycle means lower dollar, and that's good news for flows into emerging markets. So day on day around the Fed, volatility is to be expected. So if you're trading, be mindful of that. But I don't think there is any real big reason to be worried. Actually, it was a joyous cut, right? I mean, it was a cut where he said, well, we are happy to do it. Labor market is good. And he had to push back. The point is, if you do 50 basis points and then do not sound optimistic, the market will think that, well, maybe there is something wrong. Maybe there's something that we're missing, which the Fed knows. And I think they wanted to push back to it. So just wanted to sort of make those points. Surbhi, what are you looking at?
Prashant, a joyous cut. I guess despite all the priming with some of those news articles that you were alluding to earlier in the week, despite all of that, I guess they sufficiently managed to confuse the market, right? Because it was up, up, and then finally kind of ended down. But Asia this morning, Prashant, is a sea of green, probably taking that larger cue that, all things put together, because you're talking about a series of rate cuts from the US Federal Reserve. This should just make money cheaper. And net, go back to classic theory, it should be good for risk assets. And that's the simple sort of, analogy that seems to be playing out across Asia. By the way, the Taiwan market will also be considering its own sort of central bank moves today. There's so many central bank moves. Taiwan is going to be looking at the possibility of rates being left unchanged at 2%. They're at 2% right now, and no change is expected over there. Speaking of the dot plot, just to quickly remind everybody, in case you missed all the dots and where they point, what the Fed essentially is saying that that they'll do another 50 basis points this year. So 50 plus 50, that's 100 basis points this year. Another 100 basis points next year, that's 2025. And then 50 basis points in 2026. So that's what the dot plot is telling us right now. Coming back to Japan, that's the other interesting one, because the Bank of Japan central bank meeting has kick-started today. It'll conclude tomorrow. And remember, it was the BOJ that really got markets in a topsy-turvy ride in July with that rate hike, that surprise 25 basis points rate hike they did. But right now, the expectation is they're not going to go on that hiking curve, especially when the Fed is cutting. They'll just stay pat, at least in this policy meeting. The Nikkei, by the way, is surging. It's the best performing market in Asia right now, the gain of well over 2.5%. The yen is something to watch, because despite all this, despite the expectations that the BOJ is not going to be hiking rates, the yen has continued to strengthen. In the last 1 month also, it's up about 3% against the dollar. It rose to as much as 140 to the USD. It's pulled back a little bit, still around 143. So the yen is something to watch for. And I was reading some commentary. Citi, by the way, on technicals is saying that the yen can keep strengthening. It can even go to 130. So let's see. That was an interesting outlier view. So thought I'll put that on the table as well. More central bank actions. Taiwan, I mentioned today, is expected to leave rates unchanged. Ditto for the Bank of England. Not expecting any rate moves there either. Let's come back home then. Of course, the critical question is going to be whether this thesis that was playing out in the market yesterday, that, global central banks have started moving. What next? RBI will eventually cut rates, so it's good for lenders. Whether that will play out today as well, whether that is a sort of start of something new on banks and financials. So let's watch out for that. The other aspect, of course, is IT. Let's see if IT can recover after yesterday's big drubbing. So those are big trends to watch. In terms of flows, FIIs were buyers. They bought, cash equity worth nearly 1,200 crores, 1,150 to be precise. Domestic institutions, much smaller figure yesterday, a buy figure of about 150 odd crores. As usual, once the central bank headlines get over, it's going to be all about individual stocks, and there's plenty to keep us busy. Just a sampling. Yesterday, you saw the move in fertilizer stocks at the end of trade, and the news was coming in as we were closing out that the cabinet has approved almost 25,000 crores worth of nutrient-based fertilizer subsidy. Let's see if there's any follow-through today. Mangalam tells us that in Andhra, there's good news, because the government there is looking at a new, liquor policy, which basically will allow sale of liquor at the retail level by private companies. This might be good for, and we've seen that in some of the stocks already, the build-up in stocks like Radico Khaitan. More on this as we go along. Nazara is raising money, almost 900 crores. Irida, if you remember the management's conversation with us earlier this month on the channel itself, they were saying that they want to raise money, equity, and it will all rest on how much equity the government is willing to dilute. We have the answer now, and IRIDA is looking at a dilution. The government of India, it's holding in IRIDA. They're looking at a dilution of up to 7%. So that's a stock in focus. And GETND, big, business restructuring underway, because of which the promoters could be selling some equity. So, like I said, Mangalam, short point, I think beyond the central bank headlines, individual news flow, there's enough to keep us busy today.
I'll just keep an eye out on three things, Fed or no Fed. One is the tug-of-war between IT and banks. So if you just pull up yesterday's contribution chart, it looks like two cricket teams. One of the batters, the others are the bowlers. You have Infosys getting beaten, TCS, HCL Tech, all of them dragging the index. On the other hand, you had HDFC Bank, ICICI Bank, all the financials doing extremely well. The second thing I'll be watching out for is how the market breadth behaves, because for 2 days running now, we've seen more stocks decline than the number of stocks advancing. 1,500 to 1,700 stocks on an average over the last 2 trading sessions have been on the losing side. And the third thing I'll be watching out for is what happens to the volatility index, because after declining for all of last week, the India VIX saw a sharp spike in yesterday's trading session to the tune of almost 6% odd. So what happens to that once the Fed event is out of the way is something we'll be watching out for. On the Nifty Bank itself, yesterday was an outperformer. Could it have, done a lot better had it not been for the weekly options expiry? Because 53,000 calls were written, quite aggressively. So maybe there was some resistance out there. Now it's perilously close to that previous record high as well. So yesterday it went about 300, 400 points close to its record high. And today, with the rate sensitives being in focus once again, can the Nifty Bank do better? Because that's what the FIIs believe as well. They've been buying in index futures, but they've been buying in Nifty Bank futures. If you look at the FII net buy, yesterday was 1,400 crores. They bought 1,600 crores worth in Nifty Bank, and on the Nifty, they actually sold 200 crores. They're net long to the tune of 69%, and they've increased their long exposure by almost 1 lakh contracts. So that's something we'll be watching out for. Also, it's a Thursday, so it's Nifty weekly options expiry. Do not lose sight of that range as well. 25,500 call writers, pretty active, telling you that 25,550 thereabouts could be a bit of a resistance. If we do manage to cross that, then there has been a lot of punt buying at higher levels as well. But at the lower level, support comes in closer to 25,200 to 25,250. Prashant.
Well, this is a nice summary of everything you need to know as we kick off this day. Mark Giannani and Arvind Sanger are with us to take some questions on what they made of things. Gentlemen, great to have both of you here. Thank you very much for your time. Mark, let me start with you. The market reaction yesterday maybe is what flummoxed some people, or maybe the commentary, and of course what led to it, as I said earlier, is Powell saying that 50 basis points is not the new pace and kind of painting a rosier picture of the economy. In that sense, I mean, rate cuts which are needed by weak data are bad news, but you don't have that weak data and you get a 50 basis point cut. It's kind of the best of both worlds. Would you be inclined to view it that way? What's your sense?
Thank you very much. Good morning. Absolutely. I think the overall economy in the US is still doing really well. I think growth is still very solid. GDP growth in the second quarter was 3%. In the third quarter, we expect something north of like 2% in real terms. So pretty solid growth here, still supported by consumer. So then the question is, why is the Fed cutting? I think the Fed is cutting because it sees that inflationary pressures have really come down, that they feel confident that inflation is turning and returning sustainably towards the 2% target. And at the same time, the labor market, which is the other side of their mandate, seems to be at full employment, but is easing, is cooling. The labor market is cooling, and they want to make sure that they keep it near full employment where it is, and not that it gets into more weakness. So I think what we saw today is really on the part of the Fed an effort to recalibrate their policy stance by really bringing down the funds rate to a level that's more consistent with the easier labor market conditions and also the lower inflation, and make sure that they don't endanger the labor side of their mandate.
Fair enough. Arvind, what is your sense? I mean, ultimately the question is, what does it mean for markets from here? Can it provide fresh impetus to global markets? I mean, India has, of course, been a league of its own, a clear outlier in that sense. But all said and done, it's a, for the lack of a better phrase, it's a happy cut. I mean, it's not a sad cut. Go on, Arvind.
Yeah, well, I think that's an interesting way to put it, happy cut. I can't disagree. I think the reality is that 5.5% is a tight condition for where the long-term neutral rate may be. The long-term neutral rate may be, 3.5%, 4%, as the Fed sees it right now. And 5.5 is clearly tighter conditions, and with inflation rapidly diminishing and maybe closer to 2.5%, not quite 2%, but at the same time unemployment rising, the risk of staying too tight too long is the risk that we could tip the economy over into recession. Clearly, right now the economy is not looking that weak, but it could weaken if the financial conditions remain tight well past the neutral rate. So that's why I think the Fed may be admitting that that they might be a little behind the curve and they should have done 25 in July and 25 now. They didn't explicitly say that, but I think that's what is implied by this 50 basis point cut in one shot, is to make sure that the financial conditions get towards neutral much faster. And the other question, I think that helps global liquidity, yes, markets and risk capital.
All right, so then that begets the question, what happens to emerging markets? The US cuts rates by 50 basis points, with 50 basis points slated for this year as well. So where do you see emerging markets headed as a result of this? And on that, India itself, I mean, it's already run up. People are talking about valuations at one extreme here. Do you see this as an incremental positive for India or incremental positive for emerging markets ex-India?
Well, if I were to answer this, I would say that if you look at the US market today, the best performing part of the market was the Russell 2000, which is the value part of the index, not the growthy part, NASDAQ. India is like the NASDAQ. Other emerging markets may be more like the Russell, more value parts. So on a relative basis, I would say the value out of favor may benefit at the margin more than the momentum part of the market, which is India. But it doesn't mean that money will not flow into India or to emerging markets in general. So I think India will benefit, but I think some of the laggard markets may be the bigger winners if financial conditions ease rapidly, as the Fed futures are indicating.
Mark, hi, great to be having you in the conversation today. Let's talk about other asset classes as well. I mean, what does this rate cut cycle mean for commodities? Because that really ties into what we can expect on inflation next. And also, throw in a word on the other major central bank, right? Tomorrow, we're all watching out for the Bank of Japan. And I think the expectation is that at least tomorrow they won't do anything. But a section of the market still believes that if they need to hike, they will, irrespective of what the Fed is doing. Would you agree?
Yes, I mean, I think whereas for the US, there was a lot of uncertainty about whether, in fact, they would do 25 or 50 basis point cut. I think that, people over the past week have really moved around these expectations quite a bit. But I think overall, the path for the funds rate is pretty clear. The direction is downward. The question was, 75 basis point by the end of this year, 100 basis point by the end of this year. Now it looks like it's more going to be 100 basis point at the end of this year, with another 25 basis point cut in November, another 25 basis point cut in December, as based on the SEP. But broadly speaking, this is not really changing the market expectations. So whatever the commodities we're pricing in and the other central banks were pricing in is not radically changed by this new policy decisions today, irrespectively of all the uncertainty that we've seen over the past week. I think what's pretty clear is that the Fed is going to be cutting more. It's going to be. It made very clear this, I think, today that it's not going to cut rates at a very rapid pace. It's no longer going to do 50 basis points. It's more like in the 25 basis point range, unless we see a very substantial deterioration in the labor market. And so I think in that respect, they project an economy that remains quite resilient, continues to grow solidly. That's going to be favorable for overall global economic conditions and supporting the world economy as a whole, as well as commodities as a whole.
Sure, Mark, that point's well taken. So if this continues to be a gentle rate cut cycle, then I think the markets will absolutely love that. But just finish the other point on the BOJ as well. Do you expect the BOJ to continue hiking? And if that happens, then, I mean, I don't know, what precedent do we have where one major central bank is cutting and the other is hiking?
Well, they still have a large discrepancy in terms of rates, in terms of levels. And there are different stages of the cycle. The Bank of Japan is also dealing with inflation at a different cycle than the US. So, as part of where they are going, they may converge eventually, but for the time being, they may well proceed in different directions.
All right, gentlemen, thank you very much. Great to have perspective from both of you today. There's plenty to think about and plenty to discuss, and we'll keep doing that over the course of the coming weeks as well. The new rate regime has only just started. Well, with that, we have to take a very quick break, come back on the other side, and of course, we have to boil this down to stocks as well. All the individual movers and shakers that you need to keep your eye on this Thursday morning. Back in a moment.
People of Jammu and Kashmir are voting for the first time in an assembly election in 10 years. This is also the first assembly election in Jammu and Kashmir since the abrogation of Article 370 in 2019, which gave the erstwhile state special status. A total of 9 million citizens are eligible to vote in this election for 90 assembly seats. In the 2014 election in unified Jammu and Kashmir, Mufti Muhammad Saeed-led Jammu and Kashmir People's Democratic Party had won 28 seats, which was the highest number of seats won, but fell short of the majority mark, which was 44. BJP had won 25 seats, Jammu and Kashmir National Conference won 15, and the Congress 12. The PDP and the BJP had formed a post-poll alliance, which fell in 2018 due to sharp differences, and since then, the state has been under the Lieutenant Governor's administration. This time, in 2024 assembly elections, there are 13 main parties fighting the election. The major regional players are the PDP, led by Mehbooba Mufti, and National Conference, led by Omar Abdullah, both of whom are former chief ministers. The National Conference has an alliance with the Congress party in these polls. Apart from the Congress, the BJP is the big national party fighting these elections, and there is a lot at stake for the party, which is in power at the center. After several years, even separatist leaders are contesting elections. Engineer Rashid, a controversial politician, was released on bail and is contesting elections, and so are his supporters as independent candidates. Rashid could be an important candidate considering his strong support base and also because he had won the recent Lok Sabha election from Baramulla, defeating Omar Abdullah. Rashid's Awami Ittihad party has joined hands with the outlawed Jamaat-e-Islami. Now, why is this election important? In a way, This election can be seen as a referendum on abrogation of Article 370 and also the BJP's policies and handling of law and order in the state over the last 10 years. All opposition parties have promised to restore statehood and special status if elected. The BJP has ruled out restoring Article 370 but promised to restore statehood at an appropriate time after the elections. Union Minister Amit Shah has urged voters in Jammu and Kashmir to vote against separatism and terrorism. Let's see what the people of Jammu and Kashmir decide.
For what it's worth, the color is a bright green across most Asian markets, and the anticipation is that we'll be in step. We'll start off positive. I'll get the implied open up for you. There we go. 80 points pop is what that level is suggesting. But what about individual stocks? So, well, let's straight away get to the CNBC-TV18 list of top stocks to watch this morning. Our team is standing by. Guys, morning to all of you. And Vivek, let me kick it off with you. Congratulations. You got that NTPC story bang on, and indeed, the IPO of the renewable energy arm is finally happening?
Well, absolutely right. In line with what we reported a couple of days ago, NTPC's 100% wholly owned subsidiary, that is NTPC Green Energy Limited, has gone ahead and filed the DRHP to go ahead and launch an IPO. Now, as per the DRHP, NTPC Green is looking to raise close to 10,000 crore via a fresh issue of shares. What is the company raising 10,000 crore for? As per the DRHP, there will be a repayment of close to 7,500 crore that will be used for debt repayment for its subsidiary, that is NTPC Renewable Energy. Now, talking about the FY24 financials, revenues of close to 1,960 crore and operating EBITDA of close to 1,750 crore and a profitability of close to 345 crore is what this particular subsidiary, that is NTPC Green, did. What is it that they have in terms of capacity? 3.3 gigawatt of capacity is what they have, and the company actually has a plan to go ahead and commission close to 20 gigawatt of capacity by FY27. So very strong pipeline as far as the capacity is concerned, and NTPC will be able to unlock value. Markets were knowing it, and the management also had guided for this particular development at the end of the Q1 call.
All right, take that point, Vivek. NTPC will be the stock, and congratulations once again for getting that story right as well. But let's talk about the alco-bev companies. You have seen a big rally in a lot of these alco-beverage companies for the last many trading sessions, and now we know the reason why. It was expected, and now it's formalized and passed by the Andhra Pradesh State Cabinet, where they've approved a new liquor policy which starts from the 1st of October for the next couple of years. And this is a policy that facilitates retail sale of liquor by private players, and also price of select liquor brands will be brought down to 99 rupees per quarter. Positive for a lot of these mass brands and not just the P&A brands itself. Remember, a couple of weeks ago, we did have the management of Tilak Nagar Industries join us. Remember, they get almost 50% of their sales from Andhra, Telangana, 30% coming in from Andhra. They said that if the new excise policy in Andhra is announced, volumes can grow by 8 to 10% compounded over the next 5 years in this geography itself. We spoke to analysts as well, and they've said that Andhra policy can actually grow volumes by 7 to 8% for alco-bev players for the next couple of years at least. And FY26 itself, there could be a volume growth of 14 to 15% for beer and 10 to 12% for prestige and above players as well. Is that in the price? Well, who's to say? Because if you look at it, over the last 1 month, United Spirits is up 10%, Tilak Nagar up 32%, players like Radico and Global Spirits up anywhere between 33 and 51% itself. So a large part of that was expected, but going forward, going into the festive season, etc. as well, we can see some green in all of these liquor stocks continue. But talking about one confirmed story from Vivek to another one from Rachna. Rachna, you spoke about Nazara Tech going ahead and increasing, the funds or adding to their fundraise portfolio, and they've done that.
That's right, Mangalam. It is a CNBC TV18 News Break confirmed. We had reported earlier in the day yesterday that the company is looking to raise funds via a preferential issue, and that's exactly what the company announced later in the day. This is a 900 crore fundraise, and as per the company statement, these funds will be allocated towards more acquisitions. Now, the company had recently acquired and actually made the biggest acquisition with Pokerbazi just last week, and it was on our channel that Nitish Mehta Sen confirmed that funds from this fundraise will be allocated towards a part of a payment for that particular transaction. Apart from that, the company has now announced hiking of their stake in their subsidiary Sportskeeda. Now the company holds about 91% in Sportskeeda after acquiring 20% more yesterday at a value of about 145 crore 45 crore rupees. But that's not all. From what we've learned from our sources is that they're further trying to acquire and foray into the offline entertainment and games business along with publishing business. So these are the new sectors within the gaming sector that we could see Nazara entering in the near future.
Okay, quite interesting. Thank you very much for that, Rachna. Let's head across to Vamakshi now. She's watching out for a bunch of stocks, including, I think, GE, TND, Irida, and all cargo as well. So that's a big list. Take it away, Vamakshi.
Well, good morning, Surbhi. Let me first start off with GE TND. The promoters, Grid Equipments and GE Grid Alliance, have announced a proposed OFS. Keep in mind that the company back in August had intimated that the promoters were reviewing the shareholding structure to simplify the holding structure of the company. The promoters have announced that they will be looking to offload nearly 11.7% stake. They also have an option to upsize this stake sale by almost 3.9% to 15.6% in case of oversubscription. The floor price for this has been determined at 1,400 per share, which is coming in at a steep discount of 18% to the closing price yesterday. The OFS opens for non-retail investors today and for retail investors tomorrow. But given that it is coming at a sharp discount to the closing price yesterday, and the stock itself is trading at premium valuations, going with a red for GE TND. The next stock that I'm watching out for is Irida. The government has approved dilution of up to 7% equity in the company via QIP. Keep in mind that the company had received an in-principle nod to raise 4,000 crores back in August, and the government currently owns around 75% stake in the company. So given the stake dilution, going with a red for Irida. All Cargo Logistics, on the other hand, is expected to see a positive start to the trading session today, and that is because the August less than container load volume is down nearly 1.1% month on month, but up nearly 5% YOY. The volumes are expected to remain upbeat till the third quarter of this calendar year. They also witnessed an increase in volume for LCL in Latin America, Europe and Middle East. Container utilization, on the other hand, has also seen a good improvement on the back of increase in volumes. August FCL, that is the full container load volumes, were up nearly 4% month on month, 10% YOY, and this is the highest ever monthly volume that has been posted. So given those developments, going with the green for all cargo.
All right, take those points. Vamakshi, thank you so much for that. Vivek, let's wrap it up with all the other stocks that are in the news this morning.
Well, that's right. Quite a few stocks on the back of news flow that will remain in focus. First up, Power Grid. The company has emerged as a successful bidder under the BOOT model, that is a build, own, operate, transfer model. This is to establish an interstate transmission system in Rajasthan. So from a substation in Madhya Pradesh, there will be a transmission system that will be set up, and Power Grid has emerged as the lowest bidder over there. The second stock on the radar is Garden Reach Shipbuilders. On June 22nd, 2024, the company had received an order for 4 vessels from 2 German companies. Now, what's actually happened is that there has been a confirmation of another 4 fresh vessels that Garden Reach has received an order for. So the total order value is at close to $108 million, and this is something that will lead to a total multipurpose vessel capacity of 7,500 deadweight tonnage. Lastly, Restaurant Brands Asia will remain in focus. Yesterday, you saw a large block deal take place over there. So the promoter entity, that is QSR Asia, which is a part of Everstone Capital, sold close to 2.16% stake in the company at 105 rupees a share. The entire share, stake sold yesterday was picked up by Mirai Asset Mutual Fund. Remember, Everstone Capital held 15.33% in the company at the end of Q1.
All right, got that, Vivek. Thank you very much. So plenty of stocks on the radar. Let's quickly recap the list of stocks to watch, the ones that have positive news flow around them are NTPC, United Spirits, Radico Khaitan, All Cargo Logistics, Power Grid, Garden Reach Shipbuilders, and Restaurant Brand Asia. Stocks with negative news around them are Nazara and GE TND, along with Irida. Okay, so that is the stock-specific action we're watching out for. Let's look at the world of commodities now and how they have digested this 50 basis points rate cut. Manisha is joining in with the latest. Good morning, Manisha.
Thank you for that. To be well digested and done with. When you look at the gold prices, we did see a knee-jerk reaction. The gold price has hit an all-time high at $2,600 an ounce. But then you saw the dollar index and bond yields gain as the U.S. Fed started to give future guidance. So Powell did say that Fed is not in a rush to ease policy, and 50 basis points is not the new pace. And that really led to profit-taking, so much so that the gold prices fell $40 as Powell was speaking. But markets will now watch out for the Bank of England Bank of Japan monetary policy meeting that is in this week as well. For gold, it also is about the Western investors buying it quite at quantity. Not just gold, that is exactly what we saw happen in the industrial commodities as well. So initially there was a run and a rush on the higher side, but after that the crude oil prices came off as well, and we saw prices decline 0.5% overnight, and that's exactly what the metal prices also did. Zinc slipped 1% overnight. So was the case with copper. Aluminum fell 0.5%. The markets this is a reaction to the Powell testimony, and also the Chinese data has been on the weaker side, and that started to take over as well.
Right, Manisha, thank you so much for that. We'll keep an eye out on all these developments out here. We'll take a short break for now. On the other side, we'll have Siddharth Khemka of Motilal Oswal Financial Services joining in for some fundamental stock ideas.
A little while ago, I got a very nice call from Kamala. No, it was very nice. It was very nice. It was very, very nice, and we appreciate that. It's a dangerous business, however, being president. It's a little bit dangerous. It's, they think race car driving is dangerous. No. They think bull riding, that's pretty scary, right? No. This is a dangerous business, and we have to keep it safe.
Welcome back. You're watching us here on Bazaar Morning Call. The GIFT Nifty has expanded its jump start, now 88 points. Remember, when we started the show, it was up almost 25 points. So as the street comes to terms with the US Fed rate cut of 50 basis points, we'll see an impact of that on our markets as well. But what are the individual stocks that you need to keep on your radar? Our team has told you that, and now we have some fundamental ideas coming in from Siddharth Khemka, Head Research, PND at Motilal Oswal Financial Services. Siddharth, good morning. Yesterday, the toast of trade were the financials. Bajaj Finance also ended higher. So you had banks, NBFCs, both of them do well. With the overnight developments in the US, do you think the pressure on the RBI to cut rates earlier comes by, and as a result of which financials becomes a good trade?
Hi, morning, Mangalam. So yes, I think the 50 basis points rate cut definitely puts a pressure on not only our own RBI, but a lot of other global central banks to relook at their monetary policy going forward. As we could see, there was a lot of confusion post the rate cut and the Fed commentary. So while some of the emerging markets did cheer the 50 basis points rate cut, there was also a concern on the thought that there could be a recessionary pressure or a growth slowdown in the US markets, which could lead to pressure on a lot of other sectors as well as other economies. Having said that, we definitely think NBFCs do make a case here which tend to benefit from the rate cut or the interest rates going down directly, and also some of the financials like banking sector also benefit, but that will be with a lag. So the immediate effect will be on the financials, the NBFCs within which we like something like a Cholamandalam Investment and Finance, which has been in the forefront of growth across segments that it operates in. Shriram Finance is another stock that we like from the NBFC space and which has been doing well even after the inclusion in the Nifty index. Some of the other themes within the broader NBFCs, for example, the capital market theme that continues to do well. Some of the asset management companies, I think that will continue to do well in the near term.
Okay, Siddharth, hi, good morning, great to have you on. Let's straight away get to this whole Alco-Bev space, right? Mangalam's been telling us that the policy is changing in Andhra, and I think some of the estimates say that maybe volumes across the sector could go up by 7-8%. Do you like anything here? Radico, United Spirits, any favorites in the entire segment?
Morning, Subi. So if you look at from within our coverage, we like United Spirits. That is one stock that we have been liking for some time now. There has been a clear shift from the executive segment to the premium segment, where there has lead to an improvement not only in the overall growth but also in the margins. And hence, I think the changing policies across states, that should be positive. One clear trend that has come out in the last few years is some of the brands that the Indian alco beverage companies have been able to launch in the global spirits market, and that has been well received. So that has helped some of the smaller names. Also, the ethanol blending, where some of these alco beverage companies do produce and are able to contribute to a growth as well as getting a good margins from the ethanol in the OMC blending space. So overall, that space looks interesting. The consumption of alcohol beverages has gone up in India with the urbanization, with the higher spending capacity. And as I said, within that space, we like United Spirits has been the market leader and is now again back to gaining market share in India.
Right. And a word on IT. Yesterday was an underperformer. The street believes that, if the US sees some weakness in its economy, our IT stocks could bear the brunt. Anything that you like or dislike here?
Yeah, Mangalam, I think that's a fair assumption to go by now, given that the mixed chatter, especially in the US economy, economists there talking about a slowdown. The slowdown brunt will be first borne by the IT companies. So we'll have the pre-quarter update starting coming in sometime later during the month, and I think that will give more insights. But for now, I think sentimentally, after the run-up that we have seen in the Indian IT space, they could see some profit booking and some negative sentiments with regards to the IT space. But if you look at TCS, something that we like is more diversified in its client presence. Growth has been very strong, better than even Infosys. And in this volatile environment, we believe a market leader like TCS could do well. So any dip in the next few days could be an opportunity to add to a market leader like TCS.
Okay. All right. Stay on. We'll come back, Siddharth, in just a bit with some more questions. Let's also go across to Anuj and get a sense on today's trading setup. Anuj, the US markets might have been confused, up, down, but I think Asia is giving a very clear verdict. It's just all green. What does it mean for us?
Absolutely, Surabhi. I think this is a perfect scenario, and I think that's what the Asian market is reacting to. You've had a hawkish cut, a 50 basis point rate cut, along with the fact that the next few rate cuts will be, slower and lower. And Surabhi, the data that you were presenting yesterday, I think was fascinating. The next day after the 50 basis point rate cut, normally Nifty rallies on an average 1.6%. And regardless of rate cut or rate hike cycle, the market rallies big in India. Anyway, that's for another day. The US market did see some profit booking as was expected after a 50 basis point rate cut. But for the market, this is a Goldilocks scenario. You have the US economy, which is resilient with no fear of recession. There might be a bit of a slowdown. At the same time, there's going to be rate cuts. So I think that's a big positive. The other factor which got missed this morning was the dollar yen. Yesterday we were talking about 140 being breached again. This morning we're at 143.15. There's a massive rally which has happened here, which has sort of ended the risk or lowered the risk of carry trade unwinding for global markets. So that's another positive. My sense is IT stocks could rally big today because yesterday's reaction to Accenture, what I think was overstated, and also the market wanted to book some profit ahead of this Fed event in the IT stocks. The bank Nifty in any case is showing signs of hitting an all-time high after the consistent underperformance, so that's also another positive. Coming to levels then, on the Nifty, the first resistance I'm watching out for is 25,450, 25,500, which is perhaps where we begin, going by the GIFT Nifty, the all-time high. And then today's weekly expiry, 25,558 to 25,633, based on the options data. The support, of course, comes in at 25,250 to 25,300, which was yesterday's low. And then the biggest support is 25,150 to 25,200. Last Thursday, when we had that massive breakout, it was from this level. On the Bank Nifty, which has been one shade better than the Nifty, it needs 1.1% move to hit a new all-time high. The first resistance here would come at 52,900 to 53,000, and then, of course, the all-time high. Support at 52,400 to 52,500, and then 52,100 to 52,200. It's for the quote of the day. Since it's election season and since it's US, which are both in focus, I've combined the two. Benjamin Graham once said that in the short run, the market is a voting machine, but in the long run, it's a weighing machine.
Okay, all right. Interesting thought. Really, voting machine, but in the long run, it's a weighing machine. And let's see how it comes out on top. Thanks very much, Anuj, for joining in with that. Well, with that, let's just go back to Siddharth. I think Siddharth is still with us. Yeah, I think Siddharth is still with us. So, Siddharth, back to some more stocks, some more questions. I don't know if you track GE T&D in any detail, because there is a big restructuring that's happening. I think promoter level reorganization, because of which there'll be some stake coming in the market as well. Any thoughts?
So I don't track it that closely, but if you look at, I think across the capital goods space, some restructuring that the company is planning. The last few quarters, we have seen strong order book run up across capital goods, and that should help. But beyond that, no views on GT&D.
Do you have a word on NTPC because of the unlocking in their renewable business? I mean, everyone's looking at renewable as a theme. Everyone's seen PSU's rally as well. This one's an amalgamation of two, renewable plus PSU. One would imagine it to be pretty good, but at the same time, we're in a bit of a profit booking mode for all these PSUs. So do you think it's a little late in the day, or do you think there's still value to be unlocked here?
So, Mangalam, I think this news was there in the street for some time now that NTPC is in the works to file the IPO for its green business, renewable energy business. Having said that, we are positive on the core business power sector, where we see consistent growth in demand, and with the economic growth continuing, especially on the manufacturing side, we see consistent improvement in the core business growth, and that makes us positive on NTPC. The renewable side is something that we are also positive that the street has been waiting for the value unlocking to happen, because so far what we have is some of the small players in the renewable space, and this will be the first large renewable company that will come out. Even some of the other utilities, for example, you have Tata Power, they had divested some stake in their renewable business. That should also look up after this. So I think this is a positive development, and the value unlocking will only create more interest in a lot more towards these power utilities which have a subsidiary or a business in the renewables. So overall view on NTPC is positive.
Okay. All right. Got that, Siddharth. Well, on that note, we do have to take a very quick break. We'll come back on the other side. Mitesh as well as Sudarshan Sukhani are going to be with us. We'll get to some technical trading ideas today. Back in a bit.
So when India, which is a very big abuser, he happens to be coming to meet me next week, and Modi, he's fantastic. I mean, fantastic man. A lot of these leaders are fantastic. You have to understand one thing. They're 100%. These people are the sharpest people. They're not a little bit backward. They are at the top. You know the expression, they're at the top of their game, and they use it against us. But India is very tough.
Okay, welcome back. If you're just waking up and you've not seen any of what has happened in the last, 10, 12 hours or so, the Fed has cut interest rates, 50 basis points. Markets in Asia are higher. In the US, there was a bit of a pullback. But as we've been saying, don't fret too much about it because, it's looking pretty all right. The economy is pretty strong and you've got a large rate cut to kick this off. Let's bring in Mitesh and Sudarshan with us to run us through specific trades and what the risk reward looks like, because that is the issue, risk reward. It's not just here in India, but both India and US have been really world beaters in terms of returns out there. So how do you trade this one is the question. Mitesh, let me start with you. What's your sense? Yesterday we had a bit of a consolidatory kind of day. Nifty Bank, though, was up 1%, the only large index which was up in that sense. What do you do this morning?
Morning, Prashant. So, a couple of days we have been highlighting that the financials and the banks will cover up for the underperformance. And while the Bank Nifty met the target of 52,800 and even went past beyond that, I think today could be a more quieter day, a day of pullback with some choppiness. The Bank Nifty also is now at supply levels of 52,900, 53,000 zones. And Nifty, I think, is not clearly showing momentum on the upside. With the IT pack breaking down, I think it would be a slightly negative day. So today we'll approach the markets with a mixed bias. I have both buy and sell calls. And on the Nifty, maybe around 25, 250, 280 zones is where I think if we get it, then, we'll want to go long. Otherwise, we'll wait it out.
Okay. All right. Sudarshan, how would you approach things?
Yeah, good morning. See, the market is in an uptrend. We have to understand that basic fact before we discuss any market action. In an uptrend, the trade is to go and buy. Now, because it is in a consolidation, there's no rush to buy the Nifty or even the Bank Nifty today. We wait patiently. The markets can chop around and consolidate for more days than we imagine. That is a likely scenario. So inside a consolidation, wait for a patient 80 to 100 point dip from the opening price. If you get it, go long in the Nifty. Don't think about it. Just keep a 100 point stop loss from your entry and be long. If you don't get this dip, then just avoid the day today.
Okay. All right. Sudarshan, what would your specific trades be?
Well, there are a lot of stocks that are giving good signs. M&M is a buying opportunity with a stop under 27.70. My only intraday short is TCS. I would think it's sacrilege asking somebody to sell TCS. So be careful, but it's an intraday short with a stop above 4,500. I'm repeating, it's only intraday. L&T is a buy with a stop under 3680, another large cap, and finally one more large cap, Dr. Reddy's, is a buy with a stop under 6500. Broadly, the theme is there is sector rotation going on, stock rotation going on. There are stocks that are now coming out from small corrections. Look for them.
All right, M&M, L&T, DRL longs, and TCS a short, but only for the day. Sudarshan, thanks for that. Mitesh, what about you?
I have a buy on Nestle with a stop at 2560 for targets of around 2685. Aditya Birla Fashion is a buy with a stop at 329 for targets of 345. A sell on Godrej Consumer with a stop at 1450 for targets of 1400, and a sell on Container Corporation or Concor with a stop at 940 for targets of around 900 or just below.
All right, gentlemen, hang there. We'll come back to you in about 45 minutes odd as well. Take a short break, come back. We'll have the pre-opening rate, and also with us will be Karan Taurani of Elara Capital to focus on the Alcobev companies after the new liquor policy in Andhra Pradesh has been cleared by the cabinet, comes into force from October 1. Stay tuned.
Jammu and Kashmir is witnessing its first polls in the last 10 years, and lot has changed on the ground. It's historic polls because application of Article 370 has taken place, and also the fact that J&K has been divided into two union territories, which is Ladakh and Jammu and Kashmir. Around 23 plus lakh voters will exercise their franchise in the first phase, where around 219 candidates are going to these polls, and they are contesting and trying their luck. And there's a stiff competition that is going to take place. This is we are in Bijbehara constituency, where Iltija Mufti, Dr. Abeba Mufti, along with the
Right, 10 seconds to go for pre-open, 15 minutes to go for the market opening right now. The GIFT Nifty is suggesting a positive start itself. In fact, if we wait by for about 2 more seconds, we'll have the early rates of pre-open coming in as well. We'll wait by for them to settle, and rates that have come in so far from the pre-open, we need for them to settle. The Sensex is indicating a 1,000-point uptake, the Nifty lower. It's all over the place. Individual stocks are actually doing a lot better in pre-open. It's the IT pack which is seeing a bit of a bounce back. So we have, Tech Mahindra, which is up 2%, Infosys up around 4% in pre-open. And we are seeing some traction in a couple of these, names, stocks which have news backing them as well. Case in point, something like, an Oracle Financial Services, which entered F&O ban. We have REC, Pidilite, all of them up and about in today's trading session. And TPC too was mildly higher in pre-open. We'll wait for the rates to settle. Good time to get in a quick F&O check on the market as well. We do have with us Chandan Taparia joining in. Chandan, yesterday was a tug-of-war between the IT and the banking stocks. The Nifty, as a result of which, ended mildly lower. Today, we have the Nifty weekly options expiry. What are your thoughts?
Good morning, Mangalam. Thanks for having me. So we have seen a small decline in Nifty, but Bank Nifty was holding well on the last trading session. First, talking about Nifty, it has been consolidating in a range of 200 points in between 25,285 to 25,485 zone from last 4 trading session. We have noticed that every small decline is being bought. However, some sort of consolidating move was there as we were expecting the comment from the US Fed. But now, after the key event, we believe the momentum could continue and Indian market may see the next leg of rally. So major trend is positive, and till Nifty holds above 25,285, overall bullish resistance could continue and index can head towards 25,500 to 25,750. Looking at the data internal, we have seen hold of put-call ratio and volatility index is holding below 13-14 zone. So both the data setup indicates that buying interest could continue. Talking about Bank Nifty index, Bank Nifty has been outperforming the Nifty index from last 4-5 trading session. It has been making high top, high bottom on daily scale, and it is just 600 points away from its all-time high of 53,357. So now hold of 50 to 250 could take the banking index to higher zone led by short covering, and which may accelerate the up move towards 53,357 in higher levels. Looking at the stock specific, positive on the Motherson Samvardhan. We have seen that selective auto counter has seen a good momentum, including Motherson, Bajaj Auto, Hero Moto, Escorts, M&M. And here we like Motherson. The stock has given a classical breakout from a bullish pole and flag pattern, which indicates that momentum could continue. And this pattern breakout is happening after the consolidative move of last 13 weeks. So momentum could be seen. It has seen the open interest addition of around 20% in the series, which clearly indicates build-up of long position. So one can buy with support of 199 and Motherson can head towards 214 level. Second trading area, there is buy on ICICI Bank. We have positive stance in banking name. However, IT could see recovery, but banking could continue to see the outperformance. So ICICI Bank has seen the positive momentum. We have seen coal unwinding in 1260 strike. Some short covering was clearly visible in the counter, and the momentum could trigger towards 1340. One can buy with support of 1260. Last trading idea, there is buy on MCX. We have positive on most of the capital market name, including exchanges, broking, AMCs, or depositories. So MCX is one of the strongest counter, has been making higher tops, higher bottom. We have seen a major surge in the trading and the delivery volume, which clearly indicates fresh leg of rally. So one can buy with support of 5685, and this stock can head towards 6,000, 6,085 marks.
All right, Chandan, thanks a lot for that. While we're talking stocks and indices, don't lose sight of the currency as well. The rupee is opened 7 pies stronger against the dollar. Of course, it's a function of the weakness that we've seen in dollar index overnight, largely on account of the rate cut that was announced by the Fed. And over the last few trading sessions itself, the rupee has been strengthening from levels closer to that 84 mark. Now it's strengthened closer to 83.68 itself. But let's put focus back on the stocks. Andhra Pradesh cabinet has cleared the new liquor policy. The new policy will facilitate retail sales by private players, will bring down the prices of select brands under rupees 99 per quarter, and also we will have the policies which are pretty similar to what they were pre-2019 itself. Karan Taurani, who's the Senior Vice President Research Analyst at Elara, joins in now. Karan, the street was expecting this. For the longest time, this was on the cards. Now that this has come by, how much more of an incremental positive do you see this for the liquor companies, and who, according to you, would stand to benefit the most?
So I think, this is good news for the alcobev companies, but a lot of this is, largely priced in. In terms of potential impact, if you see, I think generally AP in terms of volume contribution, it can, boost the volume growth by about 7 to 8% largely for all the companies, because you will also see negative impact of Telangana state coming in, because of interstate movement. So I think net 7-8% volume growth impact, and assuming that, clearly the policy is going to be like Karnataka, which is corporation-based market, wherein the retail will be controlled by private, you will definitely see better margins, as compared to Telangana, which means that there have been earnings made of anywhere close to over 8 to 10%. And if you look at the stocks, all the three names, UBL, UNSP, and Radico, have moved up in the range of 20 to 40% over the last 6 months. And this has been one of the triggers, for these companies, apart from inflationary pressure coming down, glass prices cooling off, and, so on and so forth, and H2 being strong gradually. So I think large part of movement is done. Maybe 3 to 6% kind of a price movement could happen from here on. As far as valuations are concerned, they are largely fair. Most of the companies are beyond our target prices by about 10 to 12%, except for UBBL. So in terms of delta, I think UBBL still has got some, more respite in terms of performance. As far as Radico and UNSP is concerned, from a near-term perspective, there's immediate upside.
Okay, so United Breweries, you're saying, could have further upside. Stock's not done much. Actually, if you look at it year to date, United Breweries is up just about 16%. I mean, compare it to the kind of market we are in current, maybe, so, that still has some elbow room. Beyond the AP policy, if you were to pick an Alcobev stock right now, would it be United Breweries? Would it be anything else? And you're saying Radico is at risk of near-term decline, is it, because of the sharp rally?
No, I would not say that any of these names would be at risk in some sort of a decline, because there are still a lot of triggers going ahead. So if you look at the ENA prices might kind of move up, which could be a positive impact for Radico. They will definitely see backward integration positive impact as well, and Radico has been our top pick. So we would say one can definitely accumulate on dips, because this Radico is a very good compounding story with very strong volume growth prospects led by brand innovation. As far as UBL is concerned, as I say, why? Because clearly the problem there has been margins. So execution on margins, has been challenging. Q1, which is the strongest quarter for the beer industry, UB did not report a strong volume growth as per expectations because of the elections. And I think, once you see volume growth acceleration, and UB was a market leader in 2019 in Andhra Pradesh. So this is going to add some respite, plus inflationary pressures. Glass prices are seeing a cool off. And glass is a bigger contributor for beer companies. 35 to 40% of their COGS is glass led, and plus you have margin improvement. You could see price hikes in other states like Telangana as well. So UB still has ample triggers on valuations perspective as well. Risk reward is quite favorable, and other names would not be a sell or a decline, but yes, it will be more of an accumulate on near term basis.
Guys, I've been listening into this conversation on Alcobev and Mangalam. You talked about. So we talked about decline, right? I'll tell you, I'm here in Gurgaon, of course, for the Jefferies conference, and you know more. Gurgaon is the land of the big, fancy, glitzy liquor shops, right? I mean,
yeah,
it's filled with them. I mean, you just drive from the airport all the way in. It's and in Mumbai, but I think that's just sort of the size and scale between Delhi and Bombay. You've got smaller shops, although they're getting bigger and fancier in Mumbai as well. But here in Gurgaon, it's another level.
It's an Alcobev discussion, and you say Gurgaon, and thereafter you say no more, Prashant. Everyone understands that. But one of the banes of the Alcobev industry has been that retail outlets, are just 80,000. As compared to all the other consumer products, which are 8 to 10 million. Obviously not equating the two, but one of the wants of the industry has been the ability to open more shops for the industry itself, better distribution.
Okay. Actually, speaking of the triggers ahead, if Karan is still with us, Karan, just to go back to that point that you also made on ENA, because if you're talking about policy developments, and on one hand there's AP, in the last, I think, week, the other news was that sugar companies will now be allowed to use cane and molasses to produce ENA. Does that have any bearing at all on the input price itself, and just purely in terms of margins, what should we expect over the next quarter or two for these companies?
So I think molasses that way does not have a big impact for these spirit companies, because most of these brands have moved to the grain-based ENA. Now, also what came in terms of announcement is that grain prices are bound to see a cool off in the near term because of increased supply. And basis that, what's going to happen, ethanol, ENA manufacturer companies like Radico, companies like Global Spirits are bound to see a positive impact of this, because over the last 2 years, what has happened is your ENA prices somewhere have been largely flattish or maybe 3 to 4% higher. But, the cost of manufacturing ENA has gone up substantially because of higher grain prices. So if at all, grain prices are to see a cool off over the near term, companies like Radico will see a positive impact in terms of backward integration because they'll be able to manufacture ENA or rather procure ENA for their internal requirement at a much lower price as compared to market averages. So this is bound to have a positive impact selectively only for Radico and not for other players because other players outsource ENA externally. But as of now, I think there are no signs of increased inflationary pressure. As I mentioned, glass prices are cooling off. ENA is largely stable. So unless we don't see ENA prices moving up sharply, if at all they do, then the positive impact for Radico becomes higher, and it becomes a mild negative impact for companies like UNSP and ABD.
All right, take that point. Thank you so much for joining in, Karan. I'm not sure if you track the lower rung of the liquor companies, so whether you'd be able to comment on that or not. But we are seeing a bigger set of gains coming in for the lower rung of players itself. Case in point, something like Tilaknagar Industries, which gets about 30% of its revenues coming in from Andhra. Andhra and Telangana itself account for nearly 50% of its sales. That stock up around 4% after having rallied about 30-40% in the last 1 month or so itself. Let's get into our 9-10 calls then. Mitesh joins in. Mitesh, your 9-10 pick?
I'll go with the buy on Nestle. I think a very good breakout yesterday. Should head towards targets of 26.85.90.
Okay, all right. Got that, Mitesh. Sudarshan, what about you? Your call for the day?
Consider buying M&M with a stop under 27.70.
Okay, M&M would be Sudarshan's pick. Got it, gentlemen. Thanks very much. Pre-open Nifty is telling us we're starting about 110 points higher. The mid-cap index is also in step with the Nifty, actually slightly shade better if you were to look at it as that. But of course, the key remains to talk about, whether banks will continue the roaring move from yesterday and whether IT will come back or not. The two key questions. But before we hit open, let's go across to Nimesh for the standout brokerage report of the morning. Nimesh, good morning. Which one is it?
Hi, morning, Surabhi. So today's standout is an Info Edge, a big upgrade coming in from BofA Securities. So they've upgraded the stock to buy from underperform. So technically a double upgrade, and they've raised the target price now to 9,000 versus 51.85 earlier. Now, Naukri has a 70% market share and is a dominant position, and BofA sees no risk to that position. Or there is no major disruption risk according to the BofA note. Now, basic commentary from IT companies as well as their own internal checks suggests that there is a steady recovery in terms of recruitment within the IT companies from current levels. In fact, Info Edge's other businesses, ex of Zomato and PB Fintech, has actually underperformed Nifty and is currently trading at 52 times FY26 price to earning versus the entire internet coverage or trading at an average of 124 times. So there is a valuation comfort. Recruitment is picking up in the IT, and there is no risk to the business as well. So on back of all this, a double upgrade on Info Edge to a buy now, and they've raised the target price to 9,000.
Right, a big upgrade that from 5,185 to 9,000, a double upgrade coming in on Info Edge. Keep an eye out on this stock as a standout brokerage, but also a couple of initiating coverages that have come in on Brain Beast Solutions. You know this company better as the company that runs First Cry, a recent listing on the bourses. Issue price was close to around 465. The first one is from BofA Securities. They've initiated their target price is 770. The stock has settled 5% higher at pre-open itself. Why is that? Because they believe that First Cry is well positioned to show 21% revenue CAGR, and at the same time they can improve margins by nearly 500 basis points. What does that imply? The EBITDA would compound at over 57% for the next 3 years. And then you have the optionalities of their global businesses, which is international and global beast, which may surprise positively. We have another initiating coverage coming in from Morgan Stanley as well, and their target price is actually a shade higher than that of BofA Securities. It's 818 rupees, overweight rating. Again, a quintessential play on First Cry, which has strong distribution, large portfolio of home brands, and also supply chain capabilities. It is an underpenetrated childcare market in India itself. But, going forward, the optionalities of the international business like Global Bees, etc., can do well as well. They expect domestic business to compound at 18%, EBITDA margins improving from 9% to 13%. The childcare business can actually grow by 20% CAGR over the next couple of years, with EBITDA margins nearly doubling from 5% to closer to 10%. That stock doing well could perhaps be one of the stocks of the day.
Okay, absolutely. Yeah, those are big targets. And this is one of those IPOs that hasn't already gone absolutely berserk in a different orbit. First Cry has not had such a huge move since listing. So let's see, maybe these target prices will work well for the stock. We're counting down to the open. And in step with the rest of Asia, it is going to be a straight out gap up. 100 points gap up is what we are getting. So to kickstart things, the Nifty closing in on 25,500. There we go. We actually had 25,500 for a bit, back above that level. So what's leading it? NTPC, the excitement around the renewables arm, finally making its way as a separate listed entity. So 2% up there. IT is rebounding. LTI Mindtree, Wipro, Infosys, TCS. So the entire IT pack is undoing a lot of the damage that we saw inflicted on it yesterday. Bajaj Finance is another stock in focus, up about 1%. Some of the metal names like Tata Steel, JSW Steel, all on the upside. Coal India. So basically commodities are up. Bank Nifty is actually soaring about 0.6%. So no problems there whatsoever. Axis Bank leading from the front with a gain of about 0.7. IndusInd Bank is managing about 1%. Kotak is up in about, let's see what the big boys are doing. HDFC Bank also 0.7% higher. ICICI is a little flat, but the shade is green. And State Bank of India is managing a 0.5% up move. So no problem whatsoever. IT up, banks up. Commodities generally starting on the positive side. Just two stocks on the Nifty actually negative. One is ONGC because of the flip-flop on oil prices. Also, there are some brokerage notes this morning saying that the fall in oil is not working well for ONGC. The market's taking note of that foreign broker note. And the other is Bharti Airtel. It's kind of sitting on the fence, not doing anything. But other than that, you have 48 out of the Nifty 50 on the green side of the screen as we start off. Mangalam.
Well, the broader markets are a bright shade of green. Nearly 1,800 stocks advancing for just about 300 stocks which are declining. And that is something that the street will like in particular because the last two trading sessions, the broader markets had seen a bit of a pain. And among the top gainers, we have InfoEdge, which is the top F&O gainer this morning. And that's largely on account of that big upgrade coming in. Nimesh highlighted that in his standout brokerage note as well. The other one is United Breweries. The Andhra liquor policy actually doing well for not only United Breweries, but a lot of these other liquor companies as well. So we have Tilak Nagar Industries, which is up 5%. We have GM Breweries, which is up another 3%. And a lot of these, lower rung allied blenders, etc., lower down the order, if you look at it, past United Breweries and United Spirits, all these stocks doing extremely well too. What's also well bid in today's trading session is mid-cap IT. So IT is generally making a bit of a bounce back. So you have L&T Tech Services, Birlasoft, First Source, all of them bouncing back from lows of yesterday. The other stock that is doing extremely well is Brain-Based Solutions. Two initiating coverages coming in on that stock, up around 6%. Ireda is one as well. We're back in that phase where, more supply actually is positive for the stock. Ireda, the OFS news, the street likes that. I mean, it's up 3% right now. And then these market-related plays. CDSL is up around 3%. BSE has opened on the back foot. Let's see whether that dip gets bought into or not after that big rally that we've seen on the stock in yesterday's trading session as well. And rallying for the second day running are the Reliance ADAG group stocks. So we have Reliance Infra, which is up 5%, Reliance Power as well. There were positive developments when it comes to, their balance sheet improvement in yesterday's trading session. So there was news that stock up around 5%, Reliance Power as well. So generally way more stocks advancing than the number of stocks which are declining. The mid-cap index doing well. And now, mind you, the Nifty Bank is just about 200 points away from a fresh record high. We've been seeing record highs on the Nifty, the Sensex, the mid-cap index on a regular basis. That mark was eluding the Nifty Bank. And as we speak, maybe just about 100, 200 point uptick on the Nifty Bank. A slight jump on HDFC Bank could take the Nifty Bank to a fresh record high.
Yeah, absolutely. And the way the banks are charging ahead promises to be another good session. Let's see if the gains can be held on to or not, and we can get more follow through. InfoEdge is really surging now. Those two, important notes that we had Nimesh highlight. It's really up and away. 9,000 was the target price that was put out. The stock's at about 8,100 now, 5% on the upside. The other one is Raymond Lifestyle. The recent carve-out, the recent listing from the Raymond Group. Good day today, 5.5% up on that stock as well. And I think the market really heard our conversation with Karan Taurani on Alcobev because United Breweries is actually the best of the pack right now, about 3.5% up. That's one of the stocks that he was relatively even more optimistic on. So looking good. The Nifty retaining a gain of 170 points, Bank Nifty up 400 points, and the mid-caps as well running right in step. Prashant, good morning today.
No, and I think, it's a great morning, 170 on the Nifty, and why not, right? We've got, a big rate cut kicking off the global easing cycle. Remember, the thing to remember is that it's not just the reason why we spend a fair bit of time looking at the Fed and what it does, etc., is because, essentially it's the largest, most powerful central bank, and whether we like it or not, I mean, it's got a powerful signaling effect for other central banks around the world in terms of the monetary cycle. So in that sense, it's not just the Fed kicking off the easing cycle in the US, but for, other sort of markets as well. I just want to highlight one or two more names. You guys have wrapped up things. Reliance Infra is the biggest volume-led gainer. So Reliance Infra has been doing well. Last 2-3, I think today is the third day in a row when you're seeing action here. Stock was $210 on the 13th, and it's at 290, all 300 actually, almost 300 now. So in 3 sessions flat, and today is the third day, it's moved from 210 to 300. So, and that's got humongous volumes as well. AB Capital and HFCL and Garden Reach had some news flow. There was an order there. It's up about 3.5% as well. So, we'll come back to more stocks in a bit. But Nilesh Shah is with us now of Envision Capital. Nilesh, great to have you with us here. Thank you very much for your time. Appreciate it. So the question, Nilesh, is what to do now, right? I mean, where to focus your energies on in trying to find opportunities. And before you answer that, if you can give us a sense whether an easing cycle will provide more impetus for even top performers like the Indian stock market. Go on, Nilesh.
I think the markets will continue to favor strength. And from a global perspective, clearly India has been the strongest bastion and has been the strongest kind of island, if you may call that, from a global investment landscape. And with this environment of aggressive rate cuts, that should only augur well for a market like India and an economy like India. The reality is that global international investors, foreign investors have been underweight India. India's weight in various market indices has been kind of galloping ahead, and they have not yet been able to catch up with that. So clearly, I think an environment of rate cuts, cost of capital coming down, I think that should essentially trigger them to kind of allocate more to India. So I clearly believe that while global growth could be a concern, specifically growth in the US, and that's what I think the US Fed has highlighted in terms of jobs. So that will be a headwind, but clearly for India, this headwind could actually end up being a very, very strong tailwind. So that plus the strong domestic liquidity are something which will continue to favor Indian market. So to that extent, I think while conventionally a rate cut cycle has not necessarily resulted in a good equity market, but probably this time around, India is probably going to kind of keep behaving differently the way it has over the last couple of years. So to that extent, I think this bodes and augurs well for India.
So what sectors do well, Nilesh, and where would you look for opportunities? Will you look at something which you were not looking so far? Let's put it that way. We know some color on what you own and what you like from our previous discussions. But would you look at something which you were not looking at so far and now you'd want to because of what has happened?
I don't think the investment strategy or the style is going to change materially with this development, Prashant. I clearly believe that the two most powerful themes from an India point of view, which are very long-term structural in nature, are around urbanization and digitization. These two are essentially the most powerful structural multi-year kind of trends, and these continue to be favorites. I clearly believe that digitization still, I think, is being undermined. I think most investors are kind of having a chorus around valuations, but clearly believe that growth and the upside from a business point of view is far going to outweigh the near-term valuations. And I clearly believe that investors are still significantly underweight on digitization-oriented opportunities, online businesses, consumer, fintech, and they will continue to positively surprise for several years. Yes, sure, there will be one or two intermittent quarters where they could have some kind of a patchy performance, but otherwise I clearly believe that that remains the most powerful thing. Similarly, consumer discretionary, I think that's again going to continue to do well. Prashant, also the last 2 or 3 years, a very large part of the government's allocation has gone towards infrastructure. That continues to be north of 3% of the GDP. But in addition to that, what we have seen in recent months is essentially a lot of cash transfers which are going to happen at the state government levels. And these are humongous amounts. I mean, individual states allocating 20, 30, 40,000 crores as cash transfers. That essentially is going to rev up the entire consumption space as well. And several discretionary products are going to essentially enjoy strong tailwind. So I clearly believe that while we so far over the last 2 or 3 years have been seeing one side of the market perform, which is the capex infrastructure-oriented place, but I think going forward with falling commodity prices, falling input prices, falling input interest rates, and these cash transfers are going to provide massive tailwinds for the consumer-oriented businesses.
All right, Nilesh, you speak about digitization. And can't talk enough about how big that opportunity is. We have InfoEdge, which is doing extremely well. Brokerages are positive on that. Zomato, we've seen the massive run that has happened. And this morning, there were a couple of notes coming in on FirstCry as well. But we can't, have you and not talk about the IT pack, because yesterday it was under a lot of pressure. Now it's seeing a bit of a bounce back. From the lows, generally, the IT index has seen a rally of nearly 30% as well. How do you look at the US economy and Indian IT stocks in conjunction to that?
So Mangalam, I think the entire US economy, I think, is going to go through headwinds for some time. And that honestly doesn't augur well for the big conventional IT services companies. So I clearly believe that that's really not the space to be in. But there are several tier 2, tier 3 IT services companies which are having niche offerings around products, around services. Some of them have built strong AI capabilities, and they will be able to grow at a substantially higher pace versus the bigger ones in the peer group. So I probably think that this rally should be probably utilized to continuously switch from the large cap IT names, the top 3, 4, 5 names, and move over to specialized tier 2, tier 3, mid cap, small cap IT services and IT product companies. And that probably is the space to continue to be in.
Okay, mid cap IT companies and fintech, consumer tech, the other aspects of technology beyond traditional IT services. Got that, Nilesh. Good listening into you. So, beyond this, I think the other question that people are grappling with is whether the leadership change away from capex, from manufacturing, from that entire side of the market, PSUs, whether that indeed is now well entrenched, if it's truly underway. What would you say? If someone's still holding on to those positions, is it time to book profits? Should you stay away, or should you look at buying the dip? I mean, where do we stand on that entire, massive move that we saw for the last 2 years?
That space surely deserves a much lower weight or a lower allocation. I think if somebody's kind of been there 3 years ago, 2 years ago, or maybe even a year ago, it might actually be a good time to kind of take some money off the table, especially in the conventional defense names or some of these other infra-oriented spaces. And clearly, I think, move towards more of the consumer, the online, the financials. I mean, banks have been a big pocket of underperformance. That might be a good space. NBFCs, HFCs, these are the kind of places where incremental capital allocation ought to be done. In addition to that, even within the overall capex infra space, maybe the ones which are more veered towards the manufacturing side, the semiconductor side, these are probably the kind of areas where one should kind of veer more towards rather than the conventional capex names. So clearly, I think this is an environment which really will call for some tweaks in portfolio strategy. It will call for some kind of reallocation in terms of sectors. So clearly, I think it's time to kind of be a slightly cautious on the capex cycle, on the defense cycle, not because these businesses may not do as well. These businesses will do well, but just that the valuations have gone up so much that they factor in much, much higher growth, which I think may not be possible. They'd probably still grow at 10, 15, 20%, but they essentially will not grow at the kind of pace at which they have been growing over the last 3 years.
What else are you cautious on? Nilesh, what else are you cautious on?
I think that I kind of earlier talked about the large cap IT. I think that space calls for caution. Clearly, again, for commodities, this is a difficult time for commodities. It will be a difficult time, especially if global growth slows down. Demand, I think, is going to be challenging. There could continue to be more softness in terms of commodity prices. So I think one should be very careful, even with the typical commodity and the cyclical space. Obviously, users, consumers of commodities will do very well, as they essentially will have lower input prices, which could obviously bolster their margins. So clearly, I think avoid producers of commodities and basically kind of be more towards the consumers of commodities.
Nilesh, finally, to wrap things up, I mean, back to a market question, really. And I was just thinking that the last time we got into a US rate cut cycle, I mean, the big ones, let's go back to 2008-9. It was basically in response to a massive crisis, right? Markets had collapsed, and then the rate cuts kicked in, and then 2009-10 onwards, we started getting the market rally. Ditto for COVID. The market fell, there was fear, then the US Fed started cutting rates, and then the market rallied. This time, the difference is that we've gone into the rate cut cycle on a song, on a dance, right? Markets are at all-time highs, whether it's the Dow, whether it's India, NASDAQ, whatever you look at. So in that sense, can the party just keep continuing? Or do you think that there's some risk out there that we've perhaps missed?
The party, I believe, will continue. At least I can say that the India party looks pretty good. We surely have higher growth, we have moderate inflation, and we have stronger liquidity back home. So I think the India party will continue. Just that when these global headwinds, which have started to kind of surface, or you could probably say resurface, there would be breaks in between to this party, and that break could probably be shorter, but could kind of be steep as well. So I wouldn't rule out at any point of time maybe a 5 to 10% correction in the market indices and maybe more correction in individual stock prices. That I think is quite possible, and that's like par for the course, especially if you're essentially looking at a slightly more medium to long-term perspective. So clearly, I think yes, and historically, every year we do have situations where markets during the year correct 10 to 15%. So that possibility can never be ruled out. But clearly don't believe that the India party is over. The India party is essentially still kind of has way more to go before we can say that, we are done with the bull market.
All right, Nilesh, thank you so much for joining in. Always a pleasure speaking with you. India party is likely to continue, far from over. On that optimistic note, we'll take your leave with the news that the market still continues to hold on to its initial gains. The Nifty Bank actually was very, very close to its record high as well, went just within 4 points from that record high before cooling off a little bit. So we'll keep an eye out on how the market pans out, especially in the second half of trade. And as we speak, we'll also, very shortly get all those doyens up on your screen for you in conversation. So it's the JP Morgan India Investor Summit that we will talk about. We'll have Sajid Chenoy, Sanjay Mukim, Kaustubh Kulkarni, all of them talking to us as well about their view on where the Indian markets are and what's the expectation as well. Let's cut across to Lata, who's now in conversation with the JP Morgan Brain Trust ahead of the all-important investor conference on a day where the markets are at a record high. Over to you, Lata.
The Fed has delivered a supersized cut, and EM central bankers, like the Reserve Bank, will now have to face up to a 4.4% Fed funds rate by year-end and as low as 3.4% by end of 2025. So will dollars rush to emerging markets because you earn less on US bonds? Will the Reserve Bank have to cut rates to avert a rupee depreciation? The FOMC has also, remember, lowered the US growth forecast just marginally from 2.1 to 2% for the current year. It has upped the unemployment forecast to 4.4% from 4%. This will mean a slowdown in global growth, or will it? Then which stocks would be best bets for an Indian investor? For a 360-degree perspective on the Indian and global markets and macros, I have with me the JP Morgan Brain Trust. Sajid Chinoy, the economist, Sanjay Mukim, the head of equities and research, and Kaustubh Kulkarni, the head of country head in India. They've all been kind enough to come over ahead of their all-important investor conference on Monday. And so here's trying to get everything that foreign investors think about us. But first, Sajid, first things first, the Fed cut. What does this mean? Now is a Reserve Bank rate cut imminent in 2024?
So first, let's talk about the Fed cut. And, our US team had called for a 50 basis point cut, so this is not a surprise. I think what matters more than the quantum of whether this was 25 or 50 is why is the Fed cutting? Is the Fed cutting because the US is on the cusp of a recession? And our answer is no. In fact, if you look at the Fed Atlanta's nowcast, growth in the third quarter in the US is tracking 3%. The consumer is extremely solid. So the Fed moved because the balance of risk has now changed. They're much more comfortable that inflation is heading towards 2%, and they're a little bit concerned that the labor market has begun to soften. If you look at their own Taylor rule, right, about where rates should be, given this mix of unemployment and inflation, it should be at 3%, 3.5%. So there was this 250 basis point level shift that they had to undertake, and that's the way to understand this 50 basis point cut, that we may see more of it if the labor market slows in the coming months. Don't rule out another 50 in November if the labor market slows. But the point is that rates are now much above where conditions on the ground in terms of growth, inflation, the labor market are. The important part is the US is not slipping into recession just as yet. So they're cutting, in a sense, from a position of strength. This was a happy cut because inflation is coming off faster than they actually thought. What does this mean for emerging market central banks? Lata, there are going to be a lot of idiosyncratic factors. We should not rush to India. First, India. Well, let me just lay the backdrop by saying Brazil hiked yesterday by 25. Bank Indonesia cut by 25 even before the Fed. So a lot of idiosyncratic factors will matter for emerging markets. I think for the RBI, again, the news is incrementally positive, that despite a slight upside surprise to CPI last month, despite the fact that September CPI could bounce back to 4.8 or 4.9, there's more conviction now with every passing week and every passing month that food inflation is going to gap down. We've had a strong monsoon. It looks like a good sowing season. Global food
for domestic reasons, you're saying?
But I do think the RBI will want to see a little bit more data. So we actually think in October they'll still hold their gunpowder. They'll want a little bit more conviction that, yes, food inflation after 3 years of being sticky is finally going down. And as the governor keeps saying, it's not about being at 4% for a month. It's about durably seeing 4% for the next few quarters. But this does, I'll end by saying, if the Fed cutting this year increases the odds of a soft landing in the US, that's a very good global environment for risk assets and emerging markets in 2025.
Our viewers are dying to hear what it does to Indian stocks. But very quickly, would you believe that there is still a global cloud on Indian growth? The domestic factors are pro-growth, but there is a global slowdown?
No question that, yes, the US is holding up, but look at the other parts of the world. There's been a lot of US exceptionalism. Europe has been soft. China continues to soften. So global growth is going to soften. And as we saw in the latest trade report, we won't get the same tailwind from exports that we have been getting over much of the last 2 years.
Okay. Well, with that, let's come to the area where we are, immediately interested in stocks. Sanjay, I read your report on how India is in a late cycle of the business cycle. First, just explain to us before I bring the Fed in.
Well, look, we've seen for the last few years in India very strong stimulus support, very strong economic growth, upgrades which are rare in India to earnings estimates and companies beating forecasts. That seems to have faded away, Lata. Right? And in
the first quarter saw downgrades.
That's right. And a significant number of downgrades, which actually is very rare for 1Q. We normally see downgrades in 3Q and 4Q towards the end of the year, but we've actually seen misses and downgrades in 1Q. We've also seen the downgrades to the GDP number, for example, as well. And that's one of the reasons we are talking about slightly late cycle dynamics in equity markets. Of course, we've stopped talking about valuations because, that signal has been flashing red for 2 years now. But in terms of growth, in terms of outcomes of companies, earnings momentum also, it does appear that we are more than through a significant upcycle in the equities market, at least.
Okay, so therefore, is it don't avoid equities, or is it some kind of equities?
Well, that's a bit hard.
What would your preferences?
Right. So it's difficult to say avoid equities entirely because, of course, let's say if you're a local investor, Lata, this is one of the challenges.
Where else will I put my money?
Exactly. right? With the tax incentives that we have in the economy, equities still appear relatively decent on an expected return basis, right? And it's difficult, therefore, to say you sell everything and leave the market. It's the only thing that we argue is that a lot of corners of the market are propped up principally on liquidity. And when things turn, it is that liquidity that presents a risk. See, the one thing that people forget at the top of every bubble, and we don't know when it will be, is liquidity, right? Bubbles burst because of liquidity issues. And therefore, our advice to investors is that in all of your participation, be cognizant of quality risks, right? Do not compromise on having...
Quality.
Exactly, right? We can't
so you're never left holding a lemon.
Exactly, because when the tide turns and you should not be unable to get out of your stock.
No, but what is a typical late cycle stock that does well? If you're in the late cycle, obviously the big growth areas, consumption should not do well. What should do well?
Well, as of now, we are overweight consumption, Lata. Okay. And this is because we've...
Both durables and FMCG?
More durables, more FMCG, I beg your pardon, for now. And this is because we expect, the K-shaped recovery that, we've had post-COVID to converge a little bit. We're starting to see a little bit of signs of it. It's still very early to kind of convincingly argue it, but there is hope that this might happen. So we are actually overweight the staple stocks.
And what else?
We like real estate, for example. We think the momentum, again, going back to the argument, where else will you put your money? The equity market benefits from it. The real estate market should also benefit from it. We are overweight healthcare. We also like, so we are not very keen, let's say, on the IT and material space as of now.
No, I would assume healthcare is a late cycle preference. It's a defensive.
It is.
I want to come back on whether the K is converging, even slightly. But before that, Kaustubh, the big point is that FIIs are not flowing into Indian equities as much as they're even flowing into Indian debt. When you look at the data around, quite a few GEM funds are, not up to the weight they should be, rather underweight India's, weightage in, for instance, MSCI. What's your sense about how they will behave now? Do you expect that now, with the dollar also weakening, will there be a FOMO and they rush in?
I think it's true that relative to the MSCI weightage that India has, FII ownership is still, at least depending on the day, 2 to 3% lower than what it should be. But the big reason for that is the weights for India have increased meaningfully compared to where they were 3 years ago. Two, Indian market and FII, a number of the largest FIIs understanding in the Indian market was reasonably limited to around 75 to 100 of the larger liquid stocks, as Sanjay mentioned. Whereas, as we know in India in the last 3 to 4 years in particular, the breadth of the market and number of companies which have created excess returns is way, way larger than just the 75 or 100 companies. FIIs, therefore, have to go through their own recalibration and understanding of the market in India. Once they're able to do that, and that's where we are seeing so much more interest from FIIs to understand exactly what's happening. Because of the change in weightage, they have to do more work. But equally, they have to do a lot more work in terms of the complexity and the breadth of the stocks that they have to start covering. We think they are doing active work, and hopefully, I think, therefore, the money will follow once they finish the work.
Okay. I want to come to Sanjay on, the stock preferences. Aren't FIs put off by the valuations? I mean, at least in the mid-cap, do you ever see them broadening beyond the large caps?
Well, to a large extent, they have. If you look at data across Asia, Lata, the largest off-benchmark exposure for foreign investors is in India, right? Whereas in other countries, foreign investors may not even own the entire index constituents. In India, they own a far broader. It's still not a very big divergence, but at least within India, the foreign exposure off-benchmark is reasonably high. Are we starting to see interest? We do get questions from people about, hey, what's going on in this part of the market, etc. But the one sort of feedback, if I may, people are generally cognizant about valuation issues, right? And they don't want to be, like I said, be caught buying the top. And especially
so
when
that is a deterrent.
There is a deterrent. Okay. Especially when you contrast Indian valuations to similar sectors or similar countries elsewhere, the divergence looks very stark at the moment. So I do get this resistance saying, hey, look, I'm okay with the set of stocks I have in India for now. I really can't make up my mind and convince myself to buy anything.
I want to put the incremental money. But what about large banks? I mean, Sajid is saying that if not a rate cut in October, it's somewhere there in the horizon. What does that do to your view of financials?
Well, I think most foreign investors, of course, have a decent exposure to financials already, right? And this is a legacy exposure. It's a macro view, take an economy to just go buy a set of banks in the country. That's how it's played out for many years now. And what we're seeing, of course, is banks are best placed on the valuation filter, Lata, but on the growth momentum, naturally, there has been a significant slowdown, right? In the terms of the YOY growth that you got in 22 and 23, the growth we are now getting out of banks is much more meager. So the debate you have in the investment sort of ranking, this looks great on valuation, but the growth number is perhaps no longer as exciting as it used to be. Now, our pushback is, look, relative to growth valuation or a PEG ratio.
You may prefer NBFC in that case, no?
Yes, but NBFCs can be far more cyclical.
Okay.
Right. You have to take a cycle view, sector view, rate view, for example.
Fair enough. I have more questions on the rate view as well and what it does to bank margins. As well, this very interesting point to make about whether the K is not widening, but probably lessening, and more important, dollar. Dollar and dollar rupee, where is it headed? All those questions to the JPM Brain Trust after the break.
People of Jammu and Kashmir are voting for the first time in an assembly election in 10 years. This is also the first assembly election in Jammu and Kashmir since the abrogation of Article 370 in 2019. Which gave the erstwhile state special status. A total of 9 million citizens are eligible to vote in this election for 90 assembly seats. In the 2014 election in unified Jammu and Kashmir, Mufti Mohammad Saeed-led Jammu and Kashmir People's Democratic Party had won 28 seats, which was the highest number of seats won, but fell short of the majority mark, which was 44. BJP had won 25 seats, Jammu and Kashmir National Conference won 15, and the Congress 12. The PDP and the BJP had formed a post-poll alliance which fell in 2018 due to sharp differences, and since then the state has been under the Lieutenant Governor's administration. This time in 2024 assembly elections, there are 13 main parties fighting the election. The major regional players are the PDP led by Mehbooba Mufti and National Conference led by Omar Abdullah, both of whom are former...
Welcome back. There was some interesting conversation with the JP Morgan Brains Trust. The market continues to hold on, scale newer heights right now. While we are talking about the Nifty hitting that 25,500 mark for the first time, it's also the mid-cap index which hit that 60,000 mark for the first time. So a big milestone that we have on the mid-cap index, though it's cooled off a tad, and that is understandable as well. Just pull up the, crisscross lines, the intraday crisscross lines. You'd see them coming slightly closer. At the open, we had 1,700 stocks advancing for about 300 stocks which were declining. Now the number of stocks that are declining have tripled. So it's come to close to around 900, whereas the number of stocks which are advancing have come down from 1,700 to around 1,400 as well. So this is a trend that we'll keep an eye out on as we move towards the second half of trade and expiry, the Nifty weekly options expiry in particular as well. But more market and investment talk lined up for you. We have Anand Shah, who's the head PMS and AIF investments at ICICI Pru AMC, joining in. Anand, always a pleasure speaking with you. With the overnight Fed rate cut that has happened, what's your view on markets in general, the sectors that are likely to do well, and something that you're cautious about post yesterday?
Hi, very good morning. Thanks for having me. So I think what it does, what the rate cut does is actually it removes one overhang in the market in terms of that was one uncertainty, because very clearly, if you see, Indian economy has been okayish, but the headwinds were more from say China slowdown or a US rate hike, dollar strengthening, and so on and so forth. So I think this in a way removes one overhang, that what if the dollar, the interest rates in US continues to remain high and the dollar continues to remain strong. So I think that will give little bit of respite. Nevertheless, the verdict is not yet out. If you see, the response of markets post the Fed cut is also not very strong, given that the commentary is not as per the expectation, and to that extent, the subsequent cuts will be more data dependent. Coming back to India, I think India, the divergence in the various sectors in terms of performance has been very high for last 4 years. We had consumer-facing businesses sort of underperforming, IT underperforming, and the core sectors, manufacturing allied, they were doing extremely well. Now we have reached a point where most of the stocks that were to be discovered, most of the sectors that to be discovered have been sort of researched and discovered, and to that extent, the broad moves in the market would be smaller and smaller. The market cannot really move exceptionally fast and high in a short periods of time, but it will be more stock specific. So what we've been telling our advisors, our investors, and even my own team, that from here on the market, within the sector also will have winners and losers. And within obviously the broader market, there will be more stock picking opportunities, which we'll have to pursue rather than the macro ideas.
Yeah, absolutely. Take that point, Anand. Hi, great to have you with us this morning. And from what I recall, across a lot of your strategies, there was a fair amount of exposure to the whole manufacturing theme, right? And now the market seems to be in a mood to kind of churn portfolios, if I could say. There's some buying in banks, obviously interest coming back in IT. So in this environment, within that manufacturing theme, what would you still hold on to, and where would you say the time has come to maybe take some money off the table? If you could explain it in a little more granular way.
No, indeed. I think we've been, overweight banking in general, which has not really played out in last 6 months. It's been only last 1 week, 2 weeks that there's some excitement in banking, but banking remains a pick where the risk reward is fairly favorable because you have a large cap, liquid names with good quality of earnings, more stability, and to that extent, that offers you a good opportunity. Within the manufacturing, the one area which has sort of suffered the most from China's slowdown has been metals. That one area has been under serious stress in terms of profitability. The prices are coming off, and within that, the Indian metal companies have repaired their balance sheets over the last 4 years. They've been more ready for stress on the pricing more than they were in 2020 or before. And to that extent, that metals within the overall manufacturing space is something which can look at bottom up and identify businesses which can withstand this slowdown and then benefit as the metal prices recover. Auto ancillaries remain strong in terms of opportunity, not only within India, but outside India. Many of the auto ancillaries over the last decade have sort of diversified their customer base much better than where they were 10 years back. And to that extent, they also do. But again, as I said, it's more bottom up than the top down.
Yeah, no, take that point. But, on auto ancillaries, just yesterday, we were speaking to one of the companies, Suprajit, and discussing what the slowdown in the West means, because a lot of these auto anch players, they have a lot of exposure to the Western markets where sales have been coming off. Does that bother you, and how are you reading the export part of the ancillary play?
Indeed, that has been a pain for last almost 12 to 18 months. Especially the Europe has been not really doing well for many of these guys. And that's been reflected in the numbers, reflected in the stock price. So many of the auto anchs and even the bearing companies which have exposure to Europe have underperformed a lot. So both metals and auto anchs, as I said, have suffered, but any recovery in US, any stability in Europe can incrementally help them. And as I said, many of these businesses were much more vulnerable to a slowdown, say 4 years back, 5 years back, that the debt levels were high, utilizations are low. Today, many of them have repaired their balance sheet. They can withstand this slowdown, and genuinely last 18 months, they have withstood this overall slowdown very well compared to what was the situation a decade. So overall, bottom-up ideas in manufacturing where people have now stronger balance sheets and more diversified customer base
is where you need to be. By the way, I should just point out that the color is changing in the market, especially the mid-cap screen. Look at this. We've got red on mid-cap. So the sense of caution is very much prevalent even here in India. It wasn't just the volatility in the US market. See that changing very, very quickly. Where's the money coming off? Quite a few of the PSU stocks, by the way, RVNL, IRFC, PFC, IOB, REC, Central Bank of India, you get the drift. So PSUs is where the money is coming off, and some of the other names like, the more active names like an IRB, Infra, NIIT, some red on these stocks as well.
Well, there was a mild dip in gold as well overnight, and as a result of which we've seen some of the stocks which have higher exposure to unhedged gold coming off too. So PN Gargil, for instance, down 5% now, had a stellar listing in the earlier part of the week. And then we have BSE as well, a big mover in yesterday's trading session, now seeing a sharp bout of profit, taking down about 6%. So negating, a large part of yesterday's up move that happened as well. But back to Anand, one of the stocks which has been in focus today among the top gainers is NTPC. The street was expecting value unlocking through its renewable, subsidiary, and that's something that is happening. You hold this stock. I mean, how much of it is in the price right now?
No, so again, stock specific is difficult, but overall, look, last couple of months have been tough, especially with good monsoons. Electricity demand has sort of softened. And to that extent, generally the segment where we were looking forward to a significant deficit of power, and to that extent, we had strong up move in across the power sector, both generation, distribution, and T&D. We have seen some softening there, but our take is that given that manufacturing is picking up, given even the electricity penetration will go up and the consumption of electricity at the household level will go up, we remain constructive on the power segment as a whole, generation, distribution, as well as T&D.
Okay, Anand, we'll leave it there. Thank you very much for your time. Pleasure speaking with you here on CNBC-TV18 this important morning. So that's essentially what we have as far as the market view is concerned. By the way, I have to say that, and Surabhi was pointing out the mid-cap space, overall market breadth has also flipped into the negative. I mean, this is overall NSE. You've got about 1,250 stocks down now, and you've got about 1,140 stocks which are higher at this point. And the biggest loser is Bajaj Housing. The biggest volume-led loser is Bajaj Housing, is down 7%. Stocks at about 161 at this point in time. And you've got BSE, of course, which had a one-way kind of a move. At the highs, recent highs, BSE's market cap had reached almost about 20% of NSE's implied market cap at about 5,500 rupees a share. Ola Electric, recent listing, and of course, there were two initiations. Stock went up day before, 3% lower here. Nazara is down sharply, 4.5%. That fundraise yesterday, 1,040. So yeah, I mean, it's kind of more and more into the mix as we sort of finish and we get closer to the first hour mark as far as markets are concerned. Well, we've been talking about rates in the US and how perhaps the Fed has kicked off a global easing cycle. Let's bring it down to India and get a perspective on, what we should expect on rates here in India, and of course what the impact on financials really is. Remember, the neutral rate in India is estimated to be between 1.5% to 2% RBI's target inflation is 4%, and RBI is not expected to start to cut rates. Is expected to start to cut rates only by about December of this year, maybe a few 25 basis points from that point on. We have the former RBI Deputy Governor, Mr. S.S. Mundra, is joining us. We have Param Subramaniam, Vice President, Equity Research, Banks and Financials. He's with Nomura. Gentlemen, great to have both of you here. Thank you very much for your time. Mr. Mundra, if I can start with you. So, the Fed's cut, when do we start to see the cut here in India? And in your experience, is this a big global easing cycle on the downside? How does it typically play out? Go
on. Thanks for having me here. If I look at it, actually, 50 basis point cut has come as a surprise, little bit of surprise. But if we look at the US scenario, I think all the forecasters were expecting a 25 basis point cut. But market were already probably building in a 50 basis point cut. That was the scenario before the Fed meeting. Now, with this 50 basis point cut, probably what Fed is signaling that maybe they are comfortable with the trajectory of inflation. they are also factoring in the fact that while inflation is at 2.5%, but there would be lag impact, and it will be on course. And probably focus is on now employment and growth. Interestingly, the expectation, the forecast of a recession in the US has significantly increased in last 1 month. I think from almost 50% to 61%, and that is the trigger. But there is an interesting point between the India and the US. While in India, the consumer inflation is well on lower trajectory, but the core inflation is stubborn. In India, the situation is exactly reverse. The consumer inflation is stubborn, while the core inflation, in fact, part of it has even moved into the deflationary category. Anyway, my view is, or I would say, expectation would be, desire would be that probably RBI now would move with a 25 basis point cut in its next policy announcement. There had already been a significant divergence of view in the MPC. Of course, we would have a new MPC, new members, but I would expect that this 25 basis point cut, where the RBI would also factor in that there will be some lag impact. If you read the inflation reading in the nearest month, that is the July and August, it is already below 4%. Of course, RBI will take a longer view, would like to look how the trajectory is in next 6 to 12 months. But I think looking to the overall environment, looking to the Fed action, and looking to the data point which is emerging within India, also slowdown in both consumer-facing activities as well as the investment-facing activities.
Right.
There is a sign of some slowdown. Probably a 25 basis point cut would be a thing to go for.
Okay, got it. Thanks for sort of putting it clearly, Mr. Mundra. Param, if I can come to you. Good morning, Prashant here. What's the impact on financials here in India? If you can go segment by segment. And are there any plays here from a stock perspective? Go on.
Yeah, sure. Thanks, Prashant. Good morning to all your viewers. So yes, from a rate cutting perspective, if you look at it for the banks from a margin perspective, remember in this cycle, it's different from previous rate cutting cycles because banks have a large portion of their loan books directly exposed to external benchmarks, and so when the rate cuts do happen, there is a negative pressure that will come through on bank margins as well as their ROAs. The rough math we have is that about a 50 basis point rate cut by the RBI will translate to about a 15 to 20 basis point negative impact for the large private bank margins. At an ROA level, it probably comes down to something like 7 to 10 basis points, right? Some of the smaller banks, mid-cap banks that have higher fixed rate exposures, they have a lower, say, negative impact on their margins and their ROAs. But you also have to take into account the fact that some of these smaller banks also have exposure to riskier segments, be it microfinance, be it personal loans that have been in focus from, say, an NPA perspective for the sector as a whole. Now that's the first order impact. From a second order perspective, you also have to take into account that rate cuts generally do bring in easier liquidity, and that has been one of the constraints for the sector as a whole. So when you have, say, an easing money supply, that will also help the banking sector from a growth perspective as well. And generally, in 2 out of the 3 last rate cutting cycles, we've actually seen CASA ratios for the sector as a whole also improve. Now we've seen sharp deterioration in the CASA profiles across the banks over the last 2 years. But at the margin, if you are moving into an accommodative phase, one would expect that you don't need to be very negative on this front. From a positioning perspective, we are more towards the large private banks at this stage. So the names we like are names like Kotak Bank, ICICI, among the large privates. We also like SBI among the PSUs, and within the mid caps we like a federal bank. We don't see a need to move down the risk curve. Of course, there is a margin level pressure, but to play that, we don't see a need to move down the risk curve as the sector as a whole is pretty cheap, from a historical valuation standpoint.
Well, Param, quickly, do NBFCs, because the liability side has been the problem for a lot of NBFCs, liquidity has been tight, larger ones can raise or go overseas, etc., smaller guys cannot. Do you think, from an investor perspective, NBFCs and some of the smaller ones stand to benefit as well?
Yes, of course. So the NBFCs are natural beneficiaries. And the way we would look at it is to look at NBFCs that don't have problems, at least from a credit cost or NPA formation perspective. And from that standpoint, we are more in favor of some of the secured NBFCs, which will have the margin benefit tailwind as well as the liquidity easing tailwind, but not as much of the credit cost pressure. And from that perspective, the names we like are names like Shriram Finance. Within the affordable housing space, Aadhar Housing is something our analyst likes. And we also like a small SME focused lender called 5-Star. So I think that's the way to look at it. Secured NBFCs is of course a key beneficiary. Yeah.
Okay, got that, Param. I'll just stay on some more questions in a bit. Mr. Mundra, if I could come back to you, sir. You said that in all probability, maybe we'll see 25 basis points from the Reserve Bank of India. But let me ask a wider, broader question. Apart from the fact that one of the biggest central banks in the world is now on a cutting cycle, does the RBI really have any reason to move on rates at all? Because inflation, consumer inflation, like you rightly pointed out, sir, is very, very sticky. And the governor has been always in his commentary mentioning that there's a hawkeye on inflation and we can't sort of, lift the foot off the pedal there. And on the other side, growth is not really faltering in India. So is there a need to move on rates at all? The RBI could perhaps look at liquidity measures instead of rates, could it not?
No, you are very right. And probably that is why I say my desire would be, I never said that RBI would cut. That was not an emphatic statement. I said my desire would be that there should be a cut. No, the point is, as I mentioned, in the recent month, the inflation reading is below 4%, while growth is strong. But if you again look from the recent month, both on the consumer-facing business as well as the investment-facing businesses, there had been a slowdown. So I think while growth is continue to be good, but it continue to remain below potential. So I think that is where the tipping point is. And that is why I said that probably now there is a room, because, if with US 50 basis point cut and India remaining where it is, I think the RBI would have to face another problem, is a tricky part. And that would be probably the inflows coming, rupee appreciating, which can create problem for the export sector, which had already seen, some discomfort in the recent months. So I think this is where the, balancing factor is there. And that is why I said probably RBI and within MPC also, there is a divergence of view now for quite some time. So maybe probably this time RBI may prefer to start a cycle or at least giving a signal. Of course, it could be either a rate cut, or it could be, as you rightly said, there could be liquidity measures, there could be some other indication, or even the stance may change. But some action would certainly emerge. This 50 basis point cut by Fed cannot be completely go unnoticed in the RBI's policy announcement. That is my point.
That's a fair point. Thank you so much for laying down the thought process of the RBI, what your desire is and what the expectations are from the street as well. Mr. Mundra, Param also talking about the stocks that you like and the sector which is little, still has some value on offer as well. Insightful discussion this. What we'll do is take a short break with the news that the mid-cap index sell-off is now exacerbated, down almost 2/3%. And the advanced decline has flipped completely. 1,500 stocks declining for just about 900 stocks which are advancing. A lot of stocks seeing a firm amount of sell-off, though no problems for the Nifty Bank, which still holds its head above that 53,000 mark. We'll keep an eye out on the markets and a lot of individual stocks and the commodity space as well after this short break.
The National Conference has an alliance with the Congress party in these polls. Apart from the Congress, the BJP is the big national party fighting these elections, and there is a lot at stake for the party which is in power at the center. After several years, even separatist leaders are contesting elections. Engineer Rashid, a controversial politician, was released on bail and is contesting elections, and so are his supporters as independent candidates. Rashid could be an important candidate considering his strong support base and also because he had won the recent Lok Sabha election from Baramulla, defeating Omar Abdullah. Rashid's Awami Ittihad party has joined hands with the outlawed Jamaat-e-Islami. Now, why is this election important? In a way, this election can be seen as a referendum on abrogation of Article 370 and also the BJP's policies and handling of law and order in the state over the last 10 years. All opposition parties have promised to restore statehood and special status if elected. The BJP has ruled out restoring Article 370 but promised to restore statehood at an appropriate time after the elections. Union Minister Amit Shah has urged voters in Jammu and Kashmir to vote against separatism and terrorism. Let's see what the people of Jammu and Kashmir decide in these polls.
A little while ago, I got a very nice call from Kamala. No, it was very nice. It was very nice. It was very, very nice, and we appreciate that. It's a dangerous business, however, being president. It's a little bit dangerous. It's, you know, they think race car driving is dangerous. No.
Welcome back. Even as the mid-cap index is seeing some sell-off, a couple of stocks doing extremely well. Gillette is the one that stands out, has moved to the high point of trade, and that's largely on account of positive commentary coming in from its analyst meet yesterday. The street likes the prospects of growth, and their market share in the grooming segment has been the highest ever in 2024 itself. But that's about the equity markets. Let's talk about the commodities market. Manisha, after what took place overnight by the Fed, what's the commodity that you're tracking today?
Well, I'm looking at the whole gamut, by the way. You know, there was a knee-jerk reaction as soon as the 50 basis point rate cut came in. And that is because the commodity markets, well, they trade for 22 hours in a day, somewhere across the globe. And we saw immediate reaction come in for this one. So $2,600 an ounce is what the gold prices immediately gave you on screen after that. But since then, it has been a bit of a profit taking into the markets. And that is because the dollar index and the bond yields also gained up. This is after the U.S. Fed future guidance, where Jeremy Powell said that the Fed is not in a rush to continue to ease policy, and 50 basis points is not going to become a norm there. 25 basis points in the next two meetings is what the street is now working with, and that is something that the gold as a commodity or a wealth has already factored in. But what really seems to be working right now is that we already have seen ECB cut interest rates, Hong Kong cut interest rates by 50 basis points. And now the street will watch out for Bank of England and Bank of Japan monetary policy meeting in this week itself. So if you have this continued global cycle rate cut continuing, that could bring support back in case of gold prices. Western part of the world is looking at a lot of gold buying in physical sense, bonds and ETFs as well. If you look at the global ETF market itself, for the last 3 and 4 months, we've seen net inflows come into the space. Also, the net longs on COMEX gold are at the highest since 4 years. So that tells you that the long ads have just about continued. And any profit taking that we've seen in case of gold hasn't been more than $50 or $70. And that's exactly what we already have seen since the market went up. Industrial commodities as well have seen that knee-jerk reaction after the rate cut. But since then, in the New York session itself and the Asian markets right now, we have seen a bit of a decline. A 50 basis rate cut also tells you that the US perhaps is concerned about a slowing economy. Also, the kind of data that we have seen come in from China has all been on the weaker side. Unemployment numbers, retail sales, production, fixed assets, home prices, everything has seen a decline. So the street believes that going forward, perhaps China could come out with more stimulus measures and that would be supportive. But at this point in time, we haven't seen all of that work. So crude oil prices also have seen a decline while it is still trading at around $73. But remember, crude has seen a decline of 13% already in this quarter. And we also have seen the US crude inventories surge to by nearly 1.6 million barrels as the data came in yesterday, and that is weighing on. Within the metal space, zinc, copper fell by 1% overnight. If you look at aluminum, tin, they fell by 0.5% as well. So the only thing that the street will watch out now is if there is a China stimulus coming and what will Bank of England and Bank of Japan do now in this week.
All right, take that point, Manisha. Thanks a lot for that. From the Fed, it's over to the Bank of England and Bank of Japan. The impact of that on the commodities as well. We take a short break on that. On the other side, as always, our special segment, It's the Economy. Lata will get chatting with Chetan Iyer, Chief Asia Economist, Morgan Stanley, to decode India's growth picture. Stay tuned for that one.
I think bull riding, that's pretty scary, right? No. This is a dangerous business, and we have to keep it safe.
Invest.
Welcome to It's the Economy. It is an important day for the global economy. The Fed has delivered a supersized 50 bips rate cut, and you can see the celebration across Asian equity markets and even currency markets. The dollar is on the back foot versus quite a few currencies. And of course, equities both on the Nikkei, on India, on several markets are celebrating. What does this really mean for Asia? Does it give all the central banks a little more elbow room to cut rates so that they can stimulate their own economies, especially a beleaguered economy like China? Also, a growing economy like India, does it get more stimulus? For all these questions, I have with me perhaps one of the best observers of the Indian economy, Chetan Iyer, the Chief Asia Economist at Morgan Stanley. Chetan, good morning, and thank you very much for sparing time on what must be a very busy morning for you as well.
Thank you for having me, Lata.
Well, for starters, this rate cut, what does this do to the Reserve Bank itself? We're already seeing food inflation dipping. Do you think it gives RBI an elbow room to cut?
Well, I think if the RBI goes by the framework that they have laid out, which is that they want to see 4% sustainable inflation on headline basis. At this point of time, we still think that RBI will not be able to cut rates, just not because of the Fed. It's got to be more focused on domestic growth and inflation fundamentals. Also, at the same time, what we are telling clients is that if inflation is at 4.5%, which is what our base case is, RBI could still cut if you get growth somewhere closer to 6%, i.e. that it dips meaningfully below what RBI believes to be the underlying potential growth. So I think at this point of time, since our base case forecast is that inflation will be going down to about 4.5% sustainably, and growth is going to be 7% this year, it gives little room for RBI to go ahead and cut rates immediately.
Okay. Isn't there a possibility that inflation undershoots even 4.5%? As it is, the Reserve Bank's second quarter forecast is 4.4%. Going by the July-August numbers, it looks like it will not be 4.4%. It will probably be 4% or less than that for the quarter. As well, you have a huge Chinese disinflation, you have crude falling, you have probably a La Nina monsoon. Do you think there is a good chance of undershooting and therefore an opportunity opens up for a cut?
Well, so I think this quarter, if you remember, even RBI was earlier expecting it to be below 4%. Now they've revised it, but we are still at around 4%. So September quarter, definitely inflation will go down to 4%, but that would not be something that RBI can say it's durably down to 4%. We expect, and I think the consensus also expects it to go back up to about 4.5% in the coming quarters after that quarter. So it will be difficult for, I think from that context, RBI to go ahead and cut rates. But if we are wrong and inflation does go down to 4% sustainably, I think that will definitely open up the room for RBI to cut rates. And even if RBI cuts rates, look, we are only talking about a 50 basis points of rate cut. So I don't think there is a lot that interest rates can do now to boost growth.
Okay, Chetan, let's discuss growth as well. What has not been discussed much is that the FOMC dot plot has brought down the GDP forecast a smidge from 2.1 to 2%. It has brought up the unemployment rate rather substantially from the earlier 4% in June to 4.4%. Is there a chance of global growth slowing and that impacting India?
So I think US is on a very strong footing right now. And to the extent to which what we think the Fed has done is tried to cut the risk of causing further slowdown out of restrictive monetary policy, it does give us the confidence that the US will be seeing soft landing. And look, right now, the third quarter number, according to Atlanta Fed, is tracking at 3% Q-on-Q. And it would be nearly around 3% on a year-on-year basis. That's a very strong growth rate that the US is going through right now. And in that environment, the Fed is cutting rates. So we are of the view that the US growth will be around, as it decelerates, it will still be around 2%, which is a pretty healthy number. And that will mean that the global growth environment will remain stable. It's not great because Europe is not doing well and China is also not doing well. But to the extent to which what we have as support from the US, that should still be maintained going forward.
Okay. More pointedly about the India story before I come to China. You all recently upped your forecast a bit. Where is that confidence stemming from? I mean, after all, we are seeing unemployment going up in the US and in India as well. If you look at the August numbers, both personal vehicles, PVs, and commercial vehicles, CVs, actually fell. It was only two-wheelers that did well. So and even PMI manufacturing has peaked off. Those services is doing well. So where is this confidence of upping India's GDP forecast?
Well, so we were a little bit lower than RBI. So we were at 6.8% and we raised that to 7%. The way we did the math is that, the 6.7% number that we got for the last quarter had some negative effects of the election-related impact on government spending. That was about 20 basis points of shortfall because of that. And agri output was also somewhat weaker considering what's going on in terms of the area under coverage. We think the agri output could also go up. And so you'll get about a 40 basis points increase in growth rates from 6.7 to about 7.1 from the next quarter itself. And so that's what has made us lift our forecast. In terms of the drivers to growth, you are right. You're getting somewhat mixed signals as far as consumption is concerned. We got earlier the development where rural consumption was lagging. Now rural consumption is improving. So I think that's one big factor that is giving us the confidence that the growth recovery is broadening out. And at the same time, if you hear from our industrials analyst about the breadth of CapEx story, there is enough evidence that now private CapEx is also picking up. So we are seeing this broadening of recovery from urban consumption to rural consumption and from public CapEx to private CapEx. And the best metric is, GST numbers. They continue to be pretty robust. If you adjust GST numbers by deflator, GDP deflator, which is running at around 3%, you get a similar number as far as real economic activity is concerned.
Okay. take your point. The RBI is, after all, standing steadfast on its 7.2 number. We will know, of course, in October when the monetary policy report comes, whether they're changing their mind. But Chetan, I'm going to ask you a couple of unfair questions on the economy, on Indian economy, because I know you don't speak these numbers, but even if you can give me a directional answer. Do you see rupee appreciation? What is the range your team is working with? And yields. Indian yields have tracked the US yields. So even if you think the Reserve Bank is not cutting, we're already at nearly 675 on the 10-year. What is your team telling you in terms of the terminal rate for the 10-year by end of the year or in the next 12 months?
So look, Lata, the framework is what I can share with you. So the framework for INR, what we are highlighting to investors is that if the dollar is weak, INR will underperform because, if you look at real effective exchange rate, it's at the upper end of the band that you would see from a 10-year mean perspective. And we think that in that sense, on a real effective exchange rate basis, rupee has appreciated a lot and it's a bit on the firmer side. And if the dollar weakens, RBI will intervene and not let the rupee appreciate, just as what we are seeing right now. Actually, a lot of the other regional currencies appreciated a lot, but INR did not. So that would be the approach that we would follow. And if the dollar strengthens, then rupee will outperform because RBI will then correspondingly again intervene to ensure that the rupee doesn't see significant depreciation. So I think that's the framework that we are operating with. As far as rates outlook is concerned, I think that's predicated on our view. The strategists are pegging their view on our view on the policy rates. And that I mentioned, we are not expecting any policy rate cuts from the RBI.
Okay. Well, actually, today the Chinese currency has appreciated decently after the rate cut in the US. So coming to China, India has two worries. One is this massive Chinese disinflation or disinflationary force in global markets likely to ebb at all. I mean, they're selling steel below cost, according to Tata Steel, $50, $60 below their own cost, as will EVs, solar panels. Is this disinflation likely to ebb at all? And now with the Fed cutting rates, does China have the elbow room to stimulate its economy with a monetary or fiscal stimulus? And therefore, do we get good news out of the Chinese economy?
So I'll answer the first question first, and that will help us answer the second question as well. As far as the deflation outlook is concerned, the approach that Chinese policymakers are taking is trying to defend their real GDP growth in the context of this massive slowdown in the property sector by putting in more investment in infrastructure and manufacturing. What they are thinking to themselves is that if you think from the long-term perspective of the country, you have to invest. So while they have a big downturn in demand because of property sector, they're trying to defend it with these two areas of investment. Now that is resulting into excess capacity creation and therefore a bigger deflation problem. And I just recently put out in a report that, when Japan had a similar dynamic weighing on its economy in 1990s, Japan accepted lower real GDP growth. So its growth went down from 5 to 6% to 1%. But what China is doing in terms of defending that real growth and still targeting around 5%, that's resulting into this problem of excess capacities. And therefore, we don't think that the deflation problem in China is going to end anytime soon. In fact, it looks like it's going to be worse than Japan in 1990s. And sorry, Lata, I forgot your second question.
Yeah, will they be able to stimulate because they have now, more elbow room because of the Fed cut? Will China cut?
Yeah, I think it will definitely help. So we are expecting them to take up some more rate cuts and cut reserve ratios, required reserve ratios, but that will be only a marginal help. I think the fundamental problem that China has is that of deflation. And for that, we are recommending that they need to support consumption growth with increase in social welfare spending. They will never do the direct transfers that the US did, but they can definitely increase social welfare spending and support consumption growth. But for that, you don't need really further cut in interest rates. It's just a fiscal policy decision that the government has to make.
Fair point, fair point. Just a last, final and a quick answer. Basically, Fed cut positive for Asia?
Sorry, question is?
Fed cut. Positive for Asia, is it?
It is. It is positive for Asia in the context in which the Fed is cutting rates. Of course, if growth is decelerating hard and Fed is cutting rates, that's not necessarily positive, because then the downside from growth will overwhelm the upside from lower rates. But in the current context, and with our base case view that the US will go through soft landing, this is definitely positive for Asia. Because remember, Lata, actually, not India necessarily, but all the other countries in the region, they have their inflation below central bank's target for a number of months now, and they've been holding it back only for the Fed policy response. And so now as the Fed has begun to cut rates, and that too decisively, that gives them the elbow room to cut interest rates and ensure that their growth does not have to be taking a bigger hit.
Okay. Take your points. Thank you very much, Chetan Ahya, for spending time on what must be a busy morning for you and parsing the impact of the Fed's rate cut on India and on Asia, particularly China. Thank you very much for joining us. So with that, it's curtains on Bazaar with the news that the mid-caps are deep in the red, but the bigger indexes are holding up. Let's see how the day pans out. Wrap up on Bazaar. Chartbusters coming up.
So when India, which is a very big abuser, he happens to be coming to meet me next week, and Modi, he's fantastic. I mean, fantastic man. A lot of these leaders are fantastic. You have to understand one thing. They're 100%. These people are the sharpest people. They're not a little bit backward. They are at the top. You know the expression, they're at the top of their game, and they use it against us. But India is very tough.
T-Street's frontline indices touched new record high following the Federal Reserve's decision to cut rate by 50 basis points. Nifty trades above the 25,500 mark. The mid-caps underperform.
Alco beverage stocks like United Spirits and Radico Khaitan climb, but Radico Khaitan is off the day's high after the Andhra Pradesh government clears a new liquor policy facilitating the retail sale of liquor by private players.
Info Edge zooms in trade today, up now almost 2.5% after brokerage firm BofA upgrades the stock to a buy rating, raises the target price all the way from 51.85 to 9,000 rupees, citing a dominant traffic share with no major disruption risks ahead.
Brainbees Solutions trades almost 2% higher after BofA Securities and Morgan Stanley initiate coverage on the stock, citing good revenue, CAGR and margin expansion expected from first cry.
NTPC surges 3% as CNBC-TV18 News gets confirmed. NTPC Green Energy files its papers for the IPO. On the other hand, IRIDA too climbs more than 2%, almost 2%, after the government approves dilution of up to 7% equity stake in the company via a QIP.
Hello and welcome. You're watching Chartbusters here on CNBC TV18. I'm Hormuz Fatakia. With me is Mangalam Malu. Another day, another record high. We are cheering a lot more of the Fed rate cut than the Wall Street did itself. But it's a weekly expiry today, so a slight bit off the day's high from profit booking at higher levels.
Slight bit off the day's high. We're seeing the mid-cap index come off considerably. So let's see where that goes, because for the third day running now, we have nearly 15 to 1700 stocks on the exchanges declining versus 700, which are expanding as well. So we'll keep an eye out on that. But for all the market technicals, let's quickly welcome Sachidanand Uttekar. Sachi, your index trades and your individual stocks, if you could tell us.
Good morning, Mangalam. Good morning, Hormuz. Clearly, I think we have got a very decent decline in the markets, and the support is very well placed, somewhere close to around 25,450, 25,400. This is a base that we are expecting for the next move to unfold, and that's why we are recommending building long positions here. The Nifty is currently trending very close to this particular base of 25,450. So I think keeping a stop loss somewhere close to around 25,410. We are recommending building long positions close to 25,450, 480 kind of a zone. On the higher side, there's a good possibility that we may again swing back towards 25,650, 25,700 zone during the day itself. So overall, the trajectory remains on the positive side, and we continue with our buy and decline strategy.
And what about specific stocks, Sachidanand?
Well, on the stocks front, we have seen that the Nifty Auto Pack has been very consistent, and if you look at some of the constituents, they are showing signs of reversal here. M&M is the first counter which is showing a sign of change. After 3 months of a corrective move from a declining channel formation, the stock is exhibiting signs of strength. If you look at the weekly data itself, we saw a very strong positive crossover in its 5 and 20 exponential moving averages at the beginning of this particular week. Even if you look at the RSI, it has started trending confidently on its weekly scale, and the stock is now comfortably trending above its 5-week exponential moving average support. So we are expecting that this particular rally may continue towards 2930, 2960 kind of a zone, and that's why we are recommending building long positions here with a stop loss somewhere close to around 2810 on a closing basis. The second stock on our radar has been Maruti. Now, if you look at the last 6 weeks, the stock was consolidating between 12,100 to 12,400. But its RSI has already given a breakout on the daily scale. Plus, if you look at the short-term averages, even there is a good conversion, so which is indicating that there could be a possible momentum in the play. So we are expecting that this particular stock may see directional momentum towards 12,800 kind of a zone, and that's why we are recommending building long positions in Maruti. One needs to keep a stop loss at 12,280 on a closing basis.
Take that point. Thank you so much for joining in, Sachi, and giving us your calls on the index as well as individual stocks. Take a short break. On the other side, we have an important and an exclusive conversation lined up for you. Srideep M. Kesavan of Heritage Foods joins in to discuss the company's business outlook, the recent approval of investment in their ice cream plant as well. A rare conversation. Stay tuned for that.
Jammu and Kashmir is witnessing its first polls in the last 10 years, and what has changed on the ground is historic.
Time for an exclusive conversation here on CNBC TV18, a rare one as well. This year, one of the biggest movers has been Heritage Foods, the dairy producer and retailer. The board has now approved a proposal to set up an ice cream plant in Telangana. Plans to invest about 200 crores in that plant as well. But not just the ice cream business. If you look at, the overall business of the company, what's the outlook? We have Srideep Kesavan, who's the CEO at the company, joining in to discuss the company's business outlook and capex plans, which are in the pipeline. Thank you, Srideep, for joining in. A pleasure speaking with you. Let's get the ice cream business out of the way first. 200 crores is what the board has proposed to invest. It comes on stream by November 2025. What are typically the asset turns that you get in an ice cream business? Last quarter, you did about 31 crore of revenue from ice cream. So how much does this plant add, and what's your overall target in terms of revenue coming in from the ice cream business?
Thank you very much. Good morning, and thanks for having me on your show. Yes, yesterday our board approved a capital investment of 204 crore rupees in investing and commissioning an ice cream plant in one of our existing facilities, milk processing facilities in Hyderabad. This comes at a time when we are actually maxed out on our existing capacity and we're looking at scaling our business. Answering sharply to your question on asset turns, over a period in time, this investment will help us scale our current ice cream business, which is around 100 plus crores, to more than 600 to 700 crores. That's our expectation over the next 4 to 5 years. And for the capacity to be fully utilized, it'll take us at least 5 or 6 years. In the coming 5 or 6 years, we should be able to do that.
Srideep, good morning. Thank you for joining in. I'd like to speak to you. Just a follow-up to that, how do you plan on funding this CAPEX, 1 and 2? How has business looked like in this quarter so far? What have been the demand trends that you're witnessing? And what have been the average, say, procurement prices for milk so far this quarter?
Unfortunately, I won't be able to give you any specifics about the current quarter. But if you have followed our first quarter results, you know that the company is on a good trajectory, and this is not just a one-quarter performance. If you look back to the last 9 or 10 quarters, the company has actually led growth for the dairy industry. Actually, we've been one of the fastest growing dairy companies in the private space, or actually listed space. So the momentum is very good as far as the business is concerned. And answering specifically to the question on procurement prices, I think we are witnessing a good amount of stability in the rural economy. And it is not just to do with dairying. Actually, if you look at the agricultural commodity space itself, the commodity prices are relatively stable. We are seeing good prices given out to farmers, which means that the farm economy is actually looking really good. Dairy prices are really good. It is profitable for the dairy farmers to participate in dairying today. And the monsoon has been really good. And across our markets, we are seeing planting happening on time, and we're seeing a lot of green fodder. So all in all, actually, it is looking a good and a stable period for a dairy business.
All right, good and a stable period for dairy business. So let's get in some more numbers out of the way. You can't talk about this quarter. I'm sure you can talk about, the targets for this year. The last quarter, for the first time, you crossed 1,000 crore per quarter in terms of a revenue run rate. Should we annualize that and look at close to around 4,000, a little more than that, when it comes to the entire year's revenue? And while you talk about that, also give us a sense of where you expect margins to be in this year because of, 1, stability in procurement prices, and secondly, increase in proportion coming in from your value-added products.
Yeah, thank you for that question. The business actually has been trending a mid-teens kind of growth rate for quite some time. And it is not something that has happened only in the Q1 of this year. So I think that we should expect that growth momentum to continue. I cannot give any specifics, but I think our recent past performance in the last 8 to 9 quarters is testimony to the fact that we can continue that growth momentum going forward as well. So a mid-teens kind of growth is what we expect out of the business. And that happens because our value-added products are growing upwards of 20%. In Q1, we ended with 38.5% of our contribution from value-added products. You must be aware that Heritage is an integrated dairy player with a full range of value-added dairy. Ice cream is just one of the product clusters that we play in. We are quite strong in the dairy food space with curd and paneer, which is actually growing very well for us. and we continue to see growth in paneer as a category. Drinkables is another area where we are seeing a lot of growth. In fact, just 6 months back, we had we had infused capital to create a facility to pack aseptic cartons. So we have milkshakes and cold coffee and lassis in cartons today, which is also expanding really well. Sometime back, I think it was in the month of June, we launched ghee-based laddus, which actually strengthens our position in the dairy sweets category. And now we have ice creams. Ice creams also has been growing robustly for the last 3 or 4 years. In fact, COVID was an inflection point, and the industry as such.
Srideep, sorry to cut you in due to paucity of time. I wanted to ask you one very important question on margins. First, on the gross margin bit, you're heading towards your FY21 levels of around 25%. What is the outlook there? And do you see double-digit margins by the end of the year? Is that a possibility?
I would say that the Q1 margins will be, we should be able to sustain the Q1 margins. Because like I said, the milk prices at a farm level is stable. That means that the margins would continue to remain interesting for us to drive growth. At this point in time, we believe that we need to invest in the market to drive growth. We're at a stage, if I can talk about value-added dairy. In India, we are still at a very, very, very nascent stage. Many of the categories are in single-digit penetration as households are concerned. So we continue to invest to drive long-term growth, and we will be able to deliver the bottom line similar to Q1.
All right, take that point. So 9% sort of margin should continue for this year. Final question from our end. There was a marked shift in the way the street looked at your stock, largely after the election outcome. So just wanted to know, what could the tailwinds from a favorable policy or political environment be for players like you right now?
See, we are a business that is run professionally and independent of the political or, whatever is the regional scenario. In fact, as a company, we are based in Hyderabad, as you know. Hyderabad is our headquarters. So Telangana happens to be our largest market. So I don't think that there is any relationship between the two.
All right. Thank you for clarifying that, Rare Voice, and giving us good growth outlook out there as well. Wish you good luck for the year and the years coming ahead as well. With that, we take a short break, come back, focus on the macros, the Federal Reserve's big interest rate cut decision, and how past cycles have impacted markets. Stay tuned for that.
Of Article 370 has taken place, and also the fact that J&K has been divided into two union territories, which is Ladakh and Jammu and Kashmir. Around 23 plus lakh voters will exercise their franchise in the first phase, where around 219 candidates are going to these polls, and they are contesting and trying their luck. And there's a stiff competition that is going to take place. We are in Bijbehara constituency, where Iltija Mufti, Dr. Mehbooba Mufti, along with the NC candidate, is participating, and this is something which is seeing a larger participation of people. You'll see the voters are queued up at this polling station in South Kashmir, and also that parts of Jammu are also witnessing these polls. 3 districts of Jammu, which has a tough competition, where BJP has fielded some candidates which are considered strong in those areas. But in Kashmir, there's an alliance between the National Conference and the Congress, and similarly, the PDP is going solo, while the BJP is aiming and trying to get its first seat in Kashmir, because they haven't been able to win any seats, so they're trying to get their first seat in the Kashmir region as well.
The big rate cut from the Fed overnight. What is the impact of that on our markets? The Economic Affairs Secretary Ajay Sept says he does not see any significant impact on inflows in India. How has it been in the past? Hormaz joins in to tell us more about that. Hormaz.
The Federal Reserve has done what it assesses the good for the US economy, the largest economy in the world. And I see it as a positive for the global economy, including for the Indian economy. As far as your question about flows are concerned, it is a 50 basis points cut from a high level, from the high level. So I don't see that making any significant impact on the flows. You have to see how the things develop going forward. RBI Monetary Policy Committee of Reserve Bank of India will take a decision at appropriate point of time. Right. And my sense is that their decision is based on what is good for the Indian economy. We should not read too much into the event which happened yesterday.
The Fed has finally cut, much awaited, much anticipated, but the market has seen a buy the rumor, sell the news sort of a reaction to it, and yet it has marked the start of the latest easing cycle by the world's largest central bank. So how have the markets generally reacted in previous cycles? Now here we are considering returns from the first day of the first cut or the hike till the last day of the last cut or the hike. Now go back to 1990 when the world was on the cusp of the Gulf War. Fed began easing and continued to do so for the next 2 years until September of 1992. Almost 18 times is when the Fed cut rates. The reaction is there to see, and during this 2-year period the Nasdaq was up 23% and the S&P 500 and the Dow Jones also seeing double-digit returns. A couple of years after that, the Fed chose to bring rates back to normal to a certain extent, and starting February of 1994 until the next year the Fed raised rates 7 times, and the US markets did not react well to that, seeing low to mid single-digit negative returns. Now the US in the mid-90s is on the cusp of a dot-com boom, but it hasn't happened yet, and during this 6-month period between July of 1995 to January of 96, the Fed cut rates thrice and the market on expected lines cheered the move with double-digit returns. Now to ensure that the economy does not overheat, the Fed raised rates once in March of 1997 before easing again a year later. By then the US markets began to deliver outsized returns, as you can see with the Nasdaq here, and that period also coincided with the Asian financial crisis. Now the dot-com boom finally arrived and the Fed began to raise rates at the turn of the millennium. Between June of 99 to May 2000, the Fed raised rates 6 times, and while the Dow and the S&P 500 didn't do much during this period, the Nasdaq for obvious reasons was up almost 40%. 2001 was a tough year. The dot-com bubble burst. 9/11, the Fed had to cut rates 11 times during this period, and yet the markets did not respond in kind to such a move. That 11 cuts were followed by 2 more between November of 2002 and June of 2003. The Nasdaq in response outperforming here as well. And the global financial crisis by then arrived in October of 2008, and the Fed took a big decision to bring rates down to 0. And in this cycle, the overall gloom around the global economy shows up in these returns by the US markets. The Fed kept rates at 0 for 7 long years, and when they finally decided to hike in December 2015, the global markets had a taper tantrum. The period until December 2018 saw 9 rate hikes, but by then the market had matured enough to know that this was on the cards. The Dow and the Nasdaq saw returns of almost 30% during this period. And come 2020, when COVID-19 struck, the Fed once again in a span of 2 weeks drove rates back down to 0. But then the extent of the uncertainty was such that the markets fell to almost 20% in just 2 weeks before embarking on a never-seen-before bull run. Things returned to normal by 2022. The Fed has yet again embarked on raising rates almost 11 times until July of last year, resulting in mid-single digit returns here. And since then, the US markets have been on a tear with returns of almost over 20% for almost every broader market index in anticipation that the Fed will ease sooner or later. The Fed has eased now, but that easing has in turn resulted in some unease for the street on the road ahead.
All right, take that point, Hormaz. Thank you so much for putting all of that into perspective. With that, we are out of time on this edition of Chartbusters. But that's not all. Don't go anywhere. Take a short break, come back. We continue our Fed coverage. On the other side, an exclusive conversation with Chris Wood of Jefferies coming up.
I support Israel's ability to defend itself. And I support the need for Palestinians to have dignity, self-determination, and security as we move forward and get a two-state deal done. But right now, the thing we need to get done is this hostage deal and the ceasefire deal. We need a ceasefire. We need the hostage deal. I've had direct conversations with the Prime Minister, with the President of Israel, with Egyptian leaders, and with our allies. And I think we've made ourselves very clear this deal needs to get done in the best interest of everyone in the region.
Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Sonal Bhutra, and we're waiting for that mega exclusive interview with Chris Wood and what he's made of the Powell booster shot, the outsized rate cut of 50 basis points delivered by the Fed yesterday. Let's take a quick check on how markets have reacted. Well, in the morning, it was a gap-up opening. The Nifty first crossed 25,500, went on to scale a new peak of 25,612. But from there, we've lost about 100 points from the top on the Nifty. Still holding up in the green for the benchmark indices, but again, 100 points gone from the session highs for the Nifty and even for the Sensex. The problem is there is absolutely no momentum in the mid-cap space. The mid-cap index is now down nearly 1%. The small-cap index is a bigger cut. The advanced decline ratio stands at about 2 stocks advancing for 5 stocks declining, and the gap between the two is only widening. Now, the reason why the momentum in the market is faded is IT. Now, IT opened straight away with a gain of about 2.5%, recouping some of yesterday's gains. So pull up the Nifty IT index, but now the Nifty IT index is down in the red. So that's problem number one, 1/3 of a percentage point. But what's holding up in the green are FMCG names. NTPC is, of course, the top gainer. But as promised, let's cut across now to Prashant, who's in conversation with Chris Wood, the global head of equity strategy at Jefferies.
Hello and welcome to this special program. I'm sitting down with someone who's regarded as one of the world's foremost equity strategists. I'm sitting down with Christopher Wood at Jefferies, and what a day to sit down with him from the sidelines of the Jefferies Investor Conference here in Gurgaon. Chris, great to have you with us here. Thank you very much for your time. I said what a day to sit down with you because we're sort of coming out of this 50 basis point rate cut from last night. What do you make of it? I know you were expecting 25, but here we've got 50.
No, I'm genuinely surprised by the size of the rate cut because it's contrary to the messaging of the Fed going into the meeting, which is that the economy is okay and the employment market is weakening, but only gradually. So, yeah, if you talked to me yesterday, I would have said 25 basis points. I think there was an article in the Wall Street Journal suggesting it might be 50 at the weekend, so that was probably the clue that they were going to go bigger. But bottom line is contrary to the messaging going in. But the key point here is what the Federal Reserve believes is the neutral rate. So my guess that is probably in the 3 to 3.5% range. So even if the US achieves the soft landing, so to speak, we're probably going to be at between 3.5 by the middle of next year. But in terms of the short term, I'm surprised I'm surprised it's 50 basis points.
Do you think it's got a political angle to it as well, with elections in November?
My guess, given the fact that whatever they might argue today is quite, anybody who can read and listen is contrary to the messaging going into the meeting. So my guess at the margin is political. Because it's pretty clear that probably the vast majority of members of the Fed would prefer Donald Trump not being elected.
I see. And
I'm sure the Republican candidate will view it as political.
But does it help at the margin?
Maybe. I'm not sure it does help. Maybe at the margin.
Okay. I want to come back to the U.S. political sort of elections season in just a bit, but we don't see 50 basis point cuts without a crisis. Either very apparent or, I mean, something which they're worried about. But
there could be conspiracy theories that they know something and the economy is much weaker than which is a risk of them cutting 50 basis points yesterday, actually. But my guess is they actually genuinely believe the economy is okay. So that's why I think the motivating factor is political. And there clearly are some members of the Fed who are very political. Their former New York chairman, Bill Dudley, has been calling aggressively for a 50 basis point rate cut. If I remember correctly, he was the guy who once wrote an article calling on the Fed to manage monetary policy in a way that could stop President Trump being re-elected in the previous election. So I think there have been quite a lot of people calling aggressively for rate cuts, saying the Fed's behind the curve. But that's not the message transmitted by the Fed chairman, Mr. Powell.
Do you believe the economy is solid?
I believe the economy is obviously the economy is okay right now, but I still believe there is a risk of a U.S. downturn because of the big lags in monetary tightening in this cycle. So if you look at a chart in my presentation I gave this week, there's a chart of M2 nominal GDP growth, which had a huge explosion back in 2020 when they printed all that money in the pandemic. And actually, while M2 growth has slowed sharply in the intervening period, while the Fed has been tightening, if you draw a trend line from 1997, the M2 to nominal GDP ratio has only just gone below the trend line, which is a long-winded way of saying that in liquidity terms, the monetary tightening is only just beginning to bite. And you know, the labour market is weakening. All we need for the Fed to be cutting 50 basis points every meeting is one unambiguously bad labour market
data.
Yeah.
And you get another 50.
Yeah, but then the market will be discounting 50 basis points every meeting.
Okay. The Fed themselves in the dot plot is saying that there'll be 2 more 25 right, this year, in 2024. At this point, that seems likely, or think it'll be more than that?
Yeah, but I don't really pay any attention to the dot plots. What's important is the data.
Okay.
I mean, the dot plots are important in the sense of what the Fed think, but I wouldn't invest any money on the dot plots.
Okay. So let's assume that it's a normal kind of an economy, maybe a little slowing at the margin, but no crisis, nothing panicky. And you have these rate cuts which have started. Let's just assume it's 50 now and then maybe another 50 through the end of the year. What does it mean for asset classes like equities?
Well, it's good news it should be good news for emerging market equities, because in most emerging markets, particularly here in Asia, central banks all year could have cut rates for their own domestic reasons based on the level of real rates and inflation. But in the vast majority of the cases, they chose not to cut rates because they were worried that they might undermine their own currencies. And in the specific case of Indonesia, which has the central bank has a currency stability mandate, they actually raise rates despite very high real rates. So basically, all these central banks will now have room to cut rates, and hopefully their currencies don't get hit. So far, basically, the dollar has been in an increasingly clear weakening trend. Yeah, so that's basically good news for emerging markets.
So EMs more than US?
In my view,
in
yes.
an easing cycle?
Yeah, in my view, yes, because in the specific case of the US, the interesting point is how resilient the US listed companies have been to the Fed tightening cycle. And that is explained by this extraordinary statistic that the net interest payments of the US non-financial corporate sector have declined sharply in this Fed tightening cycle, which is counterintuitive, but it's the reality. And that's because the big tech companies have been earning 5.5% on their cash, where they used to earn 0. And it's because the investment-grade corporate sector in America did a very good job locking in bond yields when they were low, refinancing their debt. So if the higher rates actually were positive for them on the where the lower rates will help is the SMEs, because they don't issue bonds. And that's the big surprise. SMEs in America have been paying between 9 and 10% to borrow money for the last year. And that's why I'm genuinely surprised how resilient the labor market has been. Yeah, because they employ most Americans.
What about India, Chris? I mean,
well, in the case of India, the RBI can cut rates like
later this year?
Well, I mean, all Asian central banks can cut rates today, including the RBI. But my colleagues here, we believe the RBI is not, not going to be aggressively cutting. I.e., the RBI is going to behave in a different way from the Fed. And actually, the RBI in recent months has been actually counter-cyclical because they've been doing these preemptive regulatory measures as regards the banking system. And so I would assume the RBI will cut rates once before the end of the year, but I could be wrong.
Okay.
And they can cut rates because...
That's the consensus. First cut by December of this year. I
think the RBI will be coming under criticism if they haven't cut rates by the end of the year, because if you look at the level of inflation, particularly core inflation, is below the level of rates. So you have positive real rates. But obviously with the stock market at all-time highs, huge domestic flows going to the stock market, the RBI doesn't feel under massive pressure to cut rates today.
Yeah, absolutely. Chris, what about flows into India? Because the market here has been marching to the sort of drumbeat of local investors putting in money, and that number has sharply increased. It's about $4 billion regularly a month coming into mutual funds. It was about $2 billion a month before elections. So actually post-elections, the number has gone from $2 to $4 billion a month. I remember you were surprised when the market here, barely shrugged in response to the election.
That was a big surprise. That was a big surprise to me.
And of course, after the capital gains.
That's actually the biggest surprise to me was the second.
Yeah.
So after the election, clearly it was only one-day sell-off. But then I think the market's reaction was explained by the fact when I came to Delhi shortly, it was clear that everybody believed this government could last 5 years with the two minority parties. So that became more explicable to me. But I have to say, I'm genuinely astonished by the resilience to the capital gains increase, which is quite material, most particularly as the week before I met many domestic institutional investors, and they were not expecting the capital rate gains tax increase. So I find that...
and many of them were very vocal that markets will be hurt.
Yes, I would have been too, so we've all been completely wrong. So the only explanation is that the domestic households who are investing through these monthly installment plans have become convinced, in my view correctly, that India is a good long-term equity story and don't want to be scared out of the market. That's the only... And the big story of India this year is these domestic flows.
Yeah. But what about foreign flows? You said that easing cycle is great for EMs. India is an emerging market. Foreigners have stayed away.
But on a relative basis, if you're investing, if you're an EM fund manager, after this 50 basis point rate cut yesterday, the markets you're going to want to add positions to are places like Brazil, which have 11% nominal rates, 5-6% real rates, so huge potential to cut rates. Markets in Southeast Asia, like Indonesia, Philippines, which are traditionally very sensitive to lower US rates, weaker US dollar. So India is not the obvious place to put your money in today because, one, it's expensive, and two, the RBI is in no hurry to slash rates.
But haven't, you've been at the conference, you've been speaking with a lot of foreign investors who are here. What's the sense you get about India? Yeah, it's expensive, but it's been expensive. You could have made the same argument 3 months, 6 months, a year ago.
The people obviously the people here are already invested.
Right.
And so their issue, they're not too hung up on the valuation. I mean, they're all concerned about the valuation.
We're talking about incremental flows into the Indian market. I mean, what's the sense you get on that? I mean,
well, my sense is yes. The problem for the foreign fund managers as a whole is that they are underweight. Based on our latest data, based on the top 30 global emerging market equity funds, they're now marginally underweight, which is not where they want to be, because most of them would agree with me that this is the best long-term story. But they're underweight. They've become underweight from a de facto standpoint. One, because they've been reluctant to pour money in because of the high valuations. Two, because this is a very important point, the neutral benchmark weighting of India has just gone up a lot, which has made them become underweight by market performance. But there's an additional issue. There are two sectors where foreigners have traditionally most invested in India have ironically been underperforming, i.e. IT services and banks. So
Yeah.
So in the last year, many foreign investors, particularly value-orientated investors, would have gone into the banks for the first time because they came within their valuation range. But you know, they're not the hot areas of the market. The hot areas of the market in India have been areas like industrials, infrastructure, real estate, energy, defense. These are the areas which have been driving the market. That's not the area traditional emerging market investors have been investing in.
So you don't think that foreign investors are going to come back to India in a big way?
Not in the immediate term, but the good news about this is the really positive point to take away is any major correction in India, like say 10%, in my view, will be viewed by foreigners as the opportunity they've been waiting for to add.
Are you still expecting a 10% correction?
No, I'm not. I'm just saying that's...
someone said 5 is the new 10 and maybe 2 is the new 5.
No, in my view, I've got a agreed and fair long in the India portfolio. I'm not going that defensive in it.
Okay.
So, because the point is I can afford a correction. I've got very good performance. But my portfolio is heavily in energy, real estate, capex plays, but I have got the bank, so that's, I suppose, the conservative part of my portfolio.
Okay, okay.
But the real issue for foreigners, I think the more foreigners know about India, the more specialized they are in the market, the more relaxed they are on the valuations. It's just the generalists are the more concerned. And global investors, as opposed to global emerging market investors, barely own Indian equities at all.
So
I'm talking about global funds.
Right, not EM funds, but global funds.
They barely own India at all.
At all?
Yeah, literally. They don't own India.
So it's a strange kind of a position, right? I mean, because you're saying is the best long-term story.
Many global investors will agree that India is now the best story, but there's a practical issue that if you only invest in India via ADRs, you have extremely limited choices. Because of the lack of ADRs quoted offshore. Unlike in China, there are many ADRs. And the second practical issue is you want to invest in India in a sort of more real manner, you have to get FII approval. And that is a regulatory obstacle, right? That requires a real commitment. So most global funds have not got FII status.
Is that such a big issue? I mean,
yes, that's an issue. Don't underestimate that.
Yeah.
So a big fund management company could have their global emerging market fund with FII status, but their global fund may not have it. And then this capex increase, or capital gains tax, will now become will now put them off.
You know, in your note, I think the last but one note, you did mention that you put in that capital gains, and you said, well, that worries you.
Now, that personally, I don't believe in capital gains taxes on equities because people have already earned the money and they're risking. They should be encouraged to invest in equities. Now, obviously, you can deduct the money you lose, but that's just a philosophical point. So obviously, the government's raising.
No, but did you mean that in the context of where India is in terms of the political?
Well, no, that is an issue because in most Asian markets, you do not pay capital gains tax. But be you domestic or foreigners. But there's another technical issue where if you're running a dedicated Indian fund, or you have to make a provision for that capital gains tax, apparently, even if you haven't sold the stock. You see what I mean? So if you're a fund manager, you're kind of starting behind the benchmark.
Because of this?
Yes.
Okay.
So that is actually a negative, yeah. That's a negative for people trying to do dedicated Indian funds offshore.
So do you think this? I mean, India's weight has gone up, right, in the benchmarks. But do you think foreign funds will stay underweight for some time? I mean, that underweight position can actually even widen if local investors continue to put in money and the market continues to do well.
The direction of travel is foreign ownership is declining relative to domestic ownership. Fundamentally, this domestic flows are just extremely positive. And we estimate Indian households have 6% of their assets in equities. Though none of us are expecting the recent pace of flows to, by every law of logic, they should slow down. As you say, it's remarkable they've picked up since the election.
I mean, it's $4 billion a month now on a regular basis.
But from a macro standpoint, you know, at this conference last year, we were arguing that we were in the early days of a capex cycle, but you couldn't really show data comprehensively proving that. Actually, the best evidence we were in the early days of a capex cycle a year ago, 15 months ago, was that capex stocks were rallying.
Sure.
But there wasn't the actual data. But now there's real data highlighting that the capex, private sector capex cycle's underway.
But do you think, in a lot of ways, across sectors, I mean, stocks are already pricing a lot of this in India? I mean, capex stocks, for example.
So tactically, you would be a bit more cautious.
You would be.
Yeah. But I'm not. I've got these long-only portfolios, and I believe this. See, the last time India had a capex cycle, which I would say was like from 2002 to 2009. India massively outperformed the rest of Asia in that period. I remember it clearly. So if this capex cycle is happening, structurally, I want to remain invested in the stories.
Even if they go through periods of underperformance, but eventually it'll... I mean, it's a great story.
Plus, we have the residential property story, which
you've been very bullish on.
Yeah, and we don't think there's
You did highlight that last quarter there was a bit of a slowdown, but
but that I would view all that as a pause to refresh. You know.
Okay.
So we've gotten good news of if there's a weakness to the residential property story, which has been dramatic here, right? And, if there's a weakness, is very much focused on what they call the high end, which I suppose in the US, well, it depends what city you're in.
The premium end has done very well. Yeah. You're saying that perhaps sees some...
Well, what I'm saying, if you're going to criticize it, you will say it's very vulnerable because it's just the high end going up.
Okay.
But I would say, in response, well, I would have to admit that's true. I would say that's normally how property cycles work. They start with the high end and they gradually trickle down. And in that sense, rate cuts would help because if you go under 200, to use dollars, if you go under $2,000 for a unit, you're probably going to get to levels of more rate-sensitive buyers. And so if rates go down 200 basis points here or 150 basis points, that's going to increase the number of people who can afford it.
Right. So for
I've heard that I think I heard this week that inventory in the top 7 cities is at a 14-year low.
Yeah.
So if that's true, we can definitely keep going for another 4 years.
In terms of this cycle, in terms of real estate build-up?
Yes, because we've just entered our 4th year of an upturn.
Okay. So you're saying another 4 years?
Obviously, we take it a year as it comes, but given the fact that we had a 7-year downturn, given this multi-year inventory low, given the fact that India builds far fewer residential units today than even China, given its current problems builds, you know, there's no reason to think why this suddenly blows up.
So, tell us the sectors or places that you're most bullish on now, Chris. If somebody is trying to put fresh money to work here, what would you?
Put it in today. So I'm not taking out. I've got 19% in real estate stocks in my India portfolio.
Okay.
Now,
what else have you?
If I was starting the portfolio today, I might be a bit nervous putting 19%. But given the fact I have 19% that done well already, I'm not going to actually reduce them.
Okay.
But if I want to have a more cash, let's say I can't own cash, but I want it to be more tactically cautious. Because I've got more short-term tactical considerations, and you want to own the stocks which are more neo-cash proxies, which I would say are like the banks or the consumer staples.
So I mean, there perhaps there's a little bit of underperformance. I'm not sure. Banks have valuation comfort. Consumer staples maybe not so much.
No, but they're still, because we've got. I think we have evidence now that the rural economy is finally picking up, right? So I can see a case for adding to those tactically.
But if you were looking at slightly beyond the very near term?
Looking beyond the near term, I'm sticking with my current portfolio.
Okay.
So the issue
which is 19% real estate, what else?
No, it's big in capex plays and energy.
Okay.
And if any real correction in those areas, I'd be looking to add.
Okay.
Because I'm quite heavy in the banks, but the whole infrastructure story here in India, the energy story, these seem to be at the centre of the action and the centre of the capex cycle.
Sure.
It's just very positive for an economy if you have both a residential property upturn and a private sector capex cycle going on. So the way I look at it conceptually is that the government in the last 10 years has spent a huge amount at the central government level building capex, which has been the big driver of the fiscal deficit as opposed to transfer payments.
Sure.
So that has that's been the enabling factor for the economy, which should give the private sector confidence to invest. And we are now, in the last year, seeing that actually happening.
Absolutely.
Yes. So whereas a year ago, talking to people in the government, they were saying why isn't the private sector investing? So I was saying, don't worry, the private sector capex stocks are going up.
Yeah.
But obviously, if you're a government official, the stocks going up is not. You don't trust the evidence.
Absolutely. Chris, just one last point. You were cautious, right? You're a bit cautious. We've got another round of elections, state elections coming up. Are they going to be important? Have you heard that as feedback from investors? They're watching it closely.
On the big stage, obviously we're seeing handouts, right?
Right. Across states, I mean.
Yes. So that's obviously. That's another reason to maybe add to consumer staples. Tactically, long term, that's not so great, but that just means maybe the incumbent has a chance of winning where everybody thought they were going to lose.
But would it make a difference? Even if the ruling party were not so much...
that will create some negative noise.
Because, some argue that the general elections barely caused a bump, so why should this matter?
Well, I kind of agree with that.
You do?
My message, what I picked up talking to government-related people this week is rather than passing lots of laws, the bigger focus seems to be on doing away with a lot of these regulations, which are a legacy of the what they call the license Raj. I think there's clearly a case for a bonfire of regulations to promote business.
That sounds like Elon Musk in America.
Yes.
Who wants to do the same?
Yeah, that's exactly right.
Absolutely. Chris, it's wonderful to speak with you. Thank you for sitting down with us. Appreciate your time here on CNBC-TV18. It's a pleasure.
Thank you.
Thank you.
Welcome back. You're still tuned into Trading Hour. Well, the Nifty has come off, of course, from the highs around 140 points on the Nifty. From the highs of the day, it's up around 100 odd points, which is seeing a lot of pressure. That's the mid caps and the small caps. So the mid cap index, that's down almost 1,000 points right now. It's off 1,400 points from the highs of the day. The high made was around 60,200 today. And from there has been a big slide that we are seeing. Even the small cap index is down 2.5% as we speak. So big cuts that we are seeing across the board in the mid cap index. Not very enthused by the rate cuts that we have seen, and that is something that is reflecting in these two indices, and the broader markets continue to be under pressure. But it's time to shift focus to the commodity space now. Manisha Gupta is joining in today, and today, Manisha, we are focusing on zinc. Tell us more.
Well, I'm looking at zinc prices, which even after a bit of a decline overnight after the US Fed meeting, are even now trading at a 3-week highs. Well, if you look at the year 2024, the high for this year has been $3,100 a ton. We did see a low of around $2,300 as well. But currently, we're looking at prices trading at $2,900 a ton. Well, the all-time high clearly was in 2022 at $4,600. So we are off those kind of numbers right now. Well, a few factors which are supporting zinc prices right now is the stimulus measures expectation from China, because all the data that has come in from China for the month of August and until mid-September has been on the weaker side, with expectations that China perhaps will do something more here. The second is Orda Zinc Norway smelter. The expansion now is getting delayed to 2025. So that means that the supplies would not come, which the street was accounting for in this year itself. The third thing is that the global zinc market seems to be tightening right now, because in the month of June, you are looking at surplus of 8,700 tons, while in the month of May, it was at 44,000 tons. So clearly, that is what the reaction that we have seen come in the prices already. If you look at the China zinc refined production for the month of July, also has seen a decline by more than 10%, also adding support to prices. Well, the LME inventories have continued to gain, though, up by nearly 2.5% on a month-on-month basis. But the street does believe that going forward, as we see infrastructure and demand within steel as well, so for galvanization as well, you could be looking at zinc demand continuing higher, and the support thus could continue.
Thank you very much for that, Manisha. We'll get into a break. On the other side, we'll discuss market technicals. Sudeep Shah from SBI Securities joins in on the other side.
Today is National Voter Registration Day, and we are asking you to please join us in going to iwillvote.com to check your status and vote early like we do.
We are voting for Kamala Harris and Tim Walz because they are fighting to protect our reproductive freedom, our planet, and our democracy.
We can't let extremists control our lives, our freedoms, and our future. The only way to stop them and the dangerous Project 2025 agenda is to vote and elect Kamala Harris.
Vote like your life depends on it, because it does.
Go to iwillvote.com and make a plan to vote early.
Love you guys.
Welcome back. Still tuned into Trading Hour. A lot of stocks which are buzzing around in trade today in the broader markets on the back of brokerage notes, news updates. So let's get started with that. BrainBees Solution is surging after positive commentary coming in from BofA Securities. Mangalam is joining us now with more details on this. Mangalam, what does BofA say?
Well, it's a recent listing and 2 initiating coverages on this one already. The issue price was 465 and Bank of America Securities has initiated buy with a target price of almost 770 rupees. They're saying that the company is well positioned to post 21% revenue CAGR. In fact, they expect the EBITDA to compound at 57% as well. And international and global bees business can actually be big optionalities. In fact, we also have Morgan Stanley initiating coverage and they have a higher target price than Bank of America. So 818 rupees, saying that this is a quintessential play on the first cry business. So as a result of which the stock earlier was higher, but in line with the mid-cap index currently of highs.
Okay, thank you very much for that. By the way, big news coming in from the telecom sector and negative news. The Supreme Court has rejected the telecom company's plea by Vodafone Idea and Bharti Airtel on the recomputation of the AGR dues. Remember, the telecom companies, both Bharti Airtel and Vodafone Idea, went up to the Supreme Court in a curative petition saying that there are mathematical errors in the computation of AGR, annual gross revenues. They even sought a waiver of the penalty amount. The street was very hopeful that this would play out. In fact, we saw the stock price of Vodafone Idea go up to levels of 19 rupees. It was not a base case in most of the investor analyst expectation, but the street was hopeful. Now, this being rejected by the Supreme Court is a big setback. Now, AGR dues remain unchanged. For Vodafone Idea, it stands at a massive 70,000 crore rupees. The company themselves were hoping that it could come down by 50%, which would reduce the cash flow burden, which starts on the company from next year, H2 of FY26, October of 2025. That's H2 of FY26 is when the cash flows after the moratorium ends begin for Vodafone Idea. And analysts believe that in the absence of any relief on this, which is now the base case, it's going to be difficult for the company to meet its cash flow requirements. So that's the news. Just in case you've tuned in now, the Supreme Court has rejected the telecom company's plea, both Bharti Airtel and Vodafone Idea, for a recomputation of the AGR dues, which means AGR dues remain unchanged. That's a big amount and companies will have to repay it. This was the final relief, the legal recourse, right? They had gone to the Supreme Court before, it was rejected, and then they filed a curative petition. Not often the Supreme Court even hears the curative petition, but in this case, they heard it, which is why the street was hopeful. That said, history does tell us that the instances of a curative petition being positive are fairly rare, but, Bharti Airtel will still be okay. It's cash flow. It's a much bigger company. The cash flows are fine. So Bharti Airtel did see that initial dip, but you can see buying emerging because the street is very bullish on Bharti Airtel. One of the recent target price was nearly 2,000 rupees. But for Vodafone Idea, it's a big setback. In fact, we have Balaji Subramaniam, the IFL telecom analyst at IFL, and we've been talking to him about this particular development. Balaji, hi, morning. First, weigh in with this setback for telecom companies. Big news.
Hi, Rima. Thanks for having me on the show. I think this was something which the street was expecting in terms of the relief coming through. With that, that possibility now looking remote based on what the Supreme Court has done. It does look like the climb for Vodafone will get stiffer because if this relief had come, the potential relief could have been to the order of magnitude of around 35,000 crores, which would have resulted in rupees 5 per share in terms of valuation upside. And the other thing was that once the moratorium gets lifted later next year, the annual outgo would have been probably lower by around 8,000 crores. So now, with this relief not coming in, the cash flow position of Vodafone would be a bit more difficult compared to what would have been the case if the relief had come through. As far as Bharti Airtel is concerned, they would have also benefited from a favorable outcome on the case. But net, even otherwise, the other way to look at it is that more challenges for Vodafone Idea means there is potential room for further revenue market share gain for Bharti Airtel compared to what it would have been if the relief had come through. So I would think it's a slight positive for Bharti Airtel, despite the fact that they wouldn't be getting this relief, but it would be negative for both Vodafone Idea and Indus Towers.
One word answer. AGR dues for Vodafone Idea were about 70,300 crores, right? And for Bharti?
That is right.
And for Bharti Airtel?
So for Bharti Airtel, it's around 36,000 crores.
36,000. Balaji, do hold the line. We've got Ashmit. He's joining us more on the phone line for the latest here. Ashmit.
So again, a big setback coming in, primarily, of course, for the two companies, the two listed players, Bharti Airtel as well as Vodafone Idea. Both these companies had moved the apex court and had filed a curative application. In this curative application, both the companies had cited similar grounds, cited arithmetic errors. They had pointed out that the demand that was arrived at by the DoT was in fact preliminary in nature, that there are computational errors, there are instances of double counting of certain subheads, and that is what has led to this gargantuan amount culminating with the AGR demand. These were some of the concerns raised. Now, importantly, they had mentioned this matter before the Chief Justice. They had sought for an open hearing. They had sought for a hearing where the lawyers can make their case. However, this matter was taken up. Curative petitions is the norm. It's taken up in isolation within the chambers of the judges. No lawyers are present there. The applications are present, but the lawyers are not. The judges decided this matter within their chamber. The judgment has just been uploaded. It very clearly says that no case has been made out. The Supreme Court has gone through the applications that were made by the telecom companies, have gone through the concerns raised. But so far, the short point that the Apex Court is putting out, that no case has been made out for reconsidering the decision on AGR. There is no grant of relief. The application by the telecom companies have been rejected. So with that, the Supreme Court finalizing this AGR decision, this AGR saga, which has lasted for a better part of 2 decades now, the Supreme Court having the final word and saying that the AGR demands will stay, they have been upheld, and that there will be no change in the quantum of demand that was originally decided by the Apex Court.
That's right. Thank you so much, Ashmit, for joining in now. So this is the final nail in the coffin, and there'll be no changes to the AGR amount that is due by these telecom companies as well. Balaji, coming to you, for a lot of investors who were bullish on Vodafone, thinking that there could be some relief coming in for the AGR dues. The FPO price was 10 rupees per share. We saw the stock go as high as 19 rupees a share as well. What do you suggest the investors do now? Do you think there is any other trigger for the stock, or now it will continue to see issues because of the cash flow problems that this particular judgment has brought in?
See, I think it's a little too premature to kind of do what exactly happens, because the debt funding part is also pending. The equity raise is largely done, but the debt raise is still underway. Now, what happens to the debt raise round because of this adverse verdict in the AGR case, that remains to be seen. And if the debt raise doesn't come through, the capex plan of 50 to 50,000 crores, which Vodafone Idea had announced for the next 3 years, that would also potentially come under pressure. So, all those are moving parts, and even otherwise, Vodafone Idea would have required seamless execution, if one were to be very bullish at rupees 15 plus stock price levels. So my sense is that till clarity emerges on all these, the stock might remain weak.
What was your base case, Balaji? In terms of a target price for Vodafone Idea, 15 rupees?
So my base case target price is 17 rupees, and that includes rupees 5 relief from the AGR verdict. So that now might get completely knocked back, and the rest is also contingent on the funding happening, including the debt funding, the execution of the capex program, and subsequent arrest in terms of the subscriber losses.
Hard for Vodafone Idea to go ahead and get that bank funding?
Anyway, this kind of throws the spanner in the works. So otherwise, what would have been pretty straightforward now gets complicated because of this.
Okay, all right, Balaji, thank you so much for joining in today with your quick thoughts. That's the big news flashing at the bottom of your screen. The Supreme Court has rejected the recomputation of AGR dues by the telecom companies, which is Vodafone Idea and Bharti Airtel. Vodafone Idea.
I think Indus Stars is the stock you also need to focus on, because Indus Stars has slipped 10%. Remember, this is a stock whose part of its fortunes are tethered to that of Vodafone Idea, the strength of Vodafone Idea. So Indus Stars too is now down 10%, and also Indus Stars has been a big outperformer. Year to date, even after the correction, it's still up 93%. So negative news for Vodafone Idea, Indus. For Bharti Airtel, yes, it's a negative news, but maybe in this, there is also an opportunity for the company to go ahead and increase market share at the expense of Vodafone Idea. And we should pull up Reliance Industries too, as the owner of Reliance Jio. They don't get affected, they don't have AGR dues, but they could benefit from an increase in market share.
Okay, all right. Thank you, Rima, for explaining that for us. And thanks to Ashmit as well for joining in with all those important details. The sector continues to be in focus. But it's time for a short break now. When we come back, we'll get you more on the markets on the other side. Stay tuned.
Barely a few months ago, this spot was bustling with shoppers, and your shopping experience was incomplete without being shoved, jostled around, or stepped on at least a few times. Ranganathan Street has long been the heart of Chennai's retail capital, T. Nagar. But this neighborhood is hardly recognizable anymore. The transformation started soon after tunneling work for Phase 2 of the Chennai Metro Rail began earlier this year.
It's the smaller retailers who have taken the bigger hit. In nearby Badaparani, 3 metro stations are being built on the arterial Arcot Road. Hardware, textile and electrical stores in these neighborhoods say their footfalls have come to a grinding halt, and some fear the losses they're suffering may spell the end of their businesses.
We have incurred losses of 50% since the metro rail construction began, and these roads were turned into one-ways since customer footfalls have dropped drastically.
I make just enough to pay rent and meet household expenses. Business has been gravely impacted since metro rail construction began.
I have faced losses of at least 3 to 4 lakh per month. I am unable to repay loans and my debt is piling up.
High street stores have also taken a hit. Shopkeepers say the pain has been compounded by the fact that the months running up to this have seen tepid growth in sales volumes in key retail markets in the south. 3% in May, 5% in June, and 2% in July. Experts say the absence of alternate infrastructure in Chennai has compounded the problem.
Unfortunately, in a city like Chennai, there are no alternative areas for customers to come in, park their cars, or come in and access the stores. But my guess is that if the speeding up of infrastructure happens, which is the way it is done in the other cities, things can be much easier.
But speed may be hard to come by because some portions of the Chennai Metro Rail could run into delays on account of trouble with land acquisition and funding. The Tamil Nadu government has already decided to single-handedly bankroll the ongoing phase of the transit corridor in the absence of central sanctions. So the June 2026 target to complete the project has already been pushed to December 2026, and many residents feel further delays cannot be ruled out. In Chennai, Jude Sanath.
Make informed decisions with comprehensive analysis. on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with
Welcome back. The mid-cap index is still down over 2%. There is pressure in Vodafone Idea and Industars, and that's big news breaking on your screen that the Supreme Court has rejected the AGR recomputation plea, which was put forth by the telecom companies. There's going to be a cash flow impact for Vodafone Idea, and Industars too has fallen. PN Guardgear continues to react adversely for the second day in a row, so profit booking 10% lower circuit over there. Bajaj Housing Finance too is now at 156, second day of cuts. The high on Bajaj Finance earlier this week was 188.5. But Sudeep Shah is now the head of technical and derivative research at SBI Securities, is with us on the show. Sudeep, markets got what they wanted, right? That 50 basis points rate cut, but you can see that we're unable to hold on to the high levels, and there is a big correction seen in the mid and the small cap sector.
Good morning, Reema. Absolutely. I've seen what's happened is that post that initial move early morning and testing a fresh life high, Indian markets have followed the US markets, which also rose yesterday night before that rate cut, and then it witnessed profit booking. So I feel from the current levels, if we see, firstly, if we talk about Nifty, I feel the support comes around closer to 25,250, 25,300 zone. And because of Bank Nifty, which has outperformed, we feel that Nifty could take support somewhere closer to 25,250, 25,300, and then consolidate from here on. So for Nifty, this is an important support. And for Bank Nifty, 52,600, 52,500 is an important support. And we feel from this current level, Bank Nifty could be bought on dips and it could head higher to 53,500, 53,700. And if we just speak about Nifty Midcap now, this is the first day after, I guess, from 8th of August that we have seen such a steep fall. And with this fall, Midcap index has not also broken its say last 7-8 days of the trend which was on the upside. It has even broken its 20-day exponential moving average, and now it's heading a bit lower, closer to 57,300, 57,500. So I feel in the next few sessions it would be a clear demarcation between the large caps and the mid caps, and large caps would continue to hold an upper hand, and we should concentrate more on the large cap side and quality mid caps.
Okay. So quality mid-caps, that is something that a lot of market experts have been talking about as well. By the way, the Nifty is down 200 points from the highs as we speak. Sudeep, what are your technical bets in a market like this? We are seeing everything which is coming off the highs of the day. 91 of the 100 mid-cap stocks are trading in the red right now.
Yeah, so one stock which we like is ICICI Lombard. Now, ICICI Lombard was in an uptrend since mid of May, from 1550, 1560 levels all the way up to 2300 levels, 2250 levels, and post that it witnessed some kind of a profit booking from higher levels. But since last 3 days, we are seeing strong traction in this stock from the support zones. And today also, while there is a lot of selling pressure in the mid caps, this stock is standing strong. And we feel from the current levels, ICICI Lombard can be bought with a 2130 stop loss for a target of 2250. And this could regain its original momentum, which it was witnessing in the last several months. So I feel ICICI Lombard is one of the top picks. And the second stock that I like is from the FMCG space. Now, the FMCG space since morning is still holding well. And within the FMCG space, I feel Nestle has given a good breakout now. It has given a 4-month breakout. And from the current levels, this could be bought with a stop loss of 26.10 on the downside. And the targets could be placed closer to 27.20 and 27.50 levels on the upside.
Since yesterday, there have been a lot of buy calls on Nestle India. If you pull up that 1-week chart, even yesterday the stock was higher, and so many of the experts we spoke to had recommended it. Thank you, Sudeep, for joining in. With that, it's a wrap on Trading Hour from the entire team. Thank you for watching.
TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence, and in-depth reporting that makes CNBC-TV18 India's #1 business news brand. Foreseeing change, growth, and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC-TV18, your trusted partner and investment ally.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros, and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18, weeknights at 7 p.m.
We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%.
Markets see profit booking from morning record highs. Mid-cap sees selling, FMCG, auto and financials clock gains while energy and industrials drag.
The US Federal Reserve kicks off a rate cut cycle with a hefty 50 basis points reduction, its first in over 4 years. But experts don't see big cuts from the RBI and not before the end of this year.
The Supreme Court has rejected pleas filed by Vodafone Idea and Bharti Airtel for recomputation of the AGR dues. The move is a big blow for cash-strapped Voda Idea, which will now find it tougher to compete with its stronger peers.
Andhra Pradesh's new liquor policy gives a boost to liquor makers by facilitating retail sales by private players. This move is seen as boosting volumes in the high consumption market.
Jefferies' chief strategist Chris Wood tells CNBC-TV18 the Fed's rate cut of 50 basis points is higher than expected, most likely due to political motivations. And while he sees emerging markets gaining, he expects higher capital gains tax in India, putting off global investors.
Good afternoon. You're watching us here on Halftime Report. I'm Mangalam Malu. With me, Ekta Batra. And as you can see, for the markets, it's all but in the red right now. There have been two halves of the first half of trade so far. The first half was when the Nifty actually went ahead and hit a record high along with the Sensex and other indices. Thereafter, we saw sharp bout of profit taking, which started from the mid-cap end of things. Remember, this week itself, the mid-cap index is lower. And as we speak, is trading at lower levels. 2,000 stocks on the National Stock Exchange currently in the red for just about 380, which are in the green. The Nifty too holding in the green by just the skin of its teeth. As you can see, the crisscross lines far apart right now. The Nifty Bank below 53,000, the Nifty below 25,400. Hi, Ekta.
Hi, Mangalam. Yes, absolutely. It's maybe buy the rumors, sell the news, which is turning out to, turning out in the second half of the trading session, something similar to what we saw in the US markets. For the mid-cap index, like you mentioned, that's a steep cut of around 2.2%. We also have the other indices, such as the small cap index, which has shown a cut of over 2%. Even the Nifty micro cap index, which is down over 2% as well. As you can see, 2.4% hit on that particular index. So as you can see, maybe people are taking profits of those huge gains that they've probably seen in specific stocks today. But let's talk about one particular broader market company. We have Wockhardt, which is the first management on the show. The company's investigational drug, Zanich, or WCK-5222, has demonstrated its ability to cure a complex case of meningitis. It was used on a compassionate basis. To discuss this and more, the possible out-licensing opportunities, we have with us Habil Kharakiwala, the chairman of Wockhardt, who's joining in now. Dr. Kharakiwala, thank you very much for taking the time out. Just wanted to start by getting a sense about how WCK-5222 or Zanich, which is basically an antibiotic, a high-level antibiotic which is used in ICU settings. How did it help a patient with meningitis? What was the kind of recovery that we've seen in the patient? How long did it take?
This patient was put on all other known antibiotics, including some of the newer ones, which were not effective. Finally, a compassionate use was, it was given Zenix, and the patient was completely cured, and it was given for 3 weeks, and then there were no sign of the Pseudomonas organism at the end of the period, and then it has been discharged. Actually, meningitis is a really life-threatening disease problem, and one of the advantages of Zenix is it crosses blood-brain barrier, and that's why Zenix was very effective, and it has a very high coverage against resistant organisms.
Well, Dr. Kharakiwala, I just wanted to understand that now it's been used for meningitis. It's already been used on a compassionate basis for over 30-odd patients, I understand, and that includes one in the US as well. What has been the recovery of all of these patients? And now we're talking about these patients, say 3 to 4 months or maybe a couple of months to a year down the line as well. Give us a sense in terms of where these patients stand post the usage of WCK-5222.
All these patients, 35 of them, the success rate was 100%. And there was no trace of original organism when the treatment was completed. And the duration of treatment was somewhere a minimum of 7 days and a maximum of 70 days. And this clearly suggests that the drug is extremely safe, in addition to be extremely effective.
Okay. Well, you know, Dr. Khurakiwala, it sounds like a miracle drug. It sounds like exactly what probably the world needs when it comes to AMR or antimicrobial resistance. So what is stopping approvals at this level, you know, and maybe more commercial use? You've used it compassionately on 30 plus patients. When can we see it more commercialized? And out-licensing opportunities based on the kind of data that you've shown, companies should probably be lining up outside your door.
I think we are at the stage of completing phase 3 clinical trial, which is a global clinical trial. And this should get over in the next 2-3 months. And then we would be in a position to file globally in US and other countries. And that will happen after about 4-5 months of completion of clinical trial. So we expect to be in a global market sometime in 26.
Okay. So in the next 6 months, you'll be in the global market, is what you're saying?
26, I say.
26. Yes, you get that right.
Next about 18 months or so.
Okay. Could you give us a sense of the potential of the drug in terms of market value and also the out-licensing opportunities out here? What is it that you can, you know, garner from this?
See, in US alone, there are about 700,000 patients where our drug will be effective and where no other drug is working. And similarly, India, it is more than 1.1 million patients. Therefore, the opportunity for this molecule is extremely, extremely large. And based on this data, we would be looking for a licensing opportunity sometime middle of early next year. And then we'll see and tell you what happens actually.
Would you be able to hazard a, you know, you've given us some indication, 700,000 patients in the US. Would you be able to hazard a guess on the size of this drug? I mean, it can be a broad range.
But the cost of this drug in US on the current basis of a new drug antibiotic is introduced is roughly about $8,000 to $10,000 per treatment.
Okay. That's the current antibiotics which are used in the US or in an ICU setting.
But the newer ones. But your
drug is showing more efficacy.
Far more. There is no comparison. Earlier you used the word, it looks like a miracle drug. It is indeed a miracle drug because it has a breakpoint of 64, which is given for a drug in 100 years.
So basis the numbers that you're talking about, it seems like it could be anywhere between a $5 to $6 billion opportunity in the US alone.
I am not making any comment on this point in time, but I've given the number of incidents as well as the kind of price points there.
Sure. Dr. Khurakiwala, just coming back to that out-licensing opportunity, just based on the kind of statistics that you're providing, I'm interested to know whether pharmaceutical companies have already approached you or not to probably tie up for this particular drug based on the kind of data that you've shown.
To get the optimum value in licensing, it is important that we complete phase 3 clinical trial. That is a major milestone, and when by the time we file to FDA, that is the time we would like to open up and appoint a merchant banker. We are in the process of appointing a merchant banker, and then explore the possibility.
So as of now, there's been no approach. As of now, there's been no pharmaceutical company, say Indian or global, that's approached you for a potential deal on this.
I think a number of pharmaceutical companies had approached us a few years back. And then we had a challenge on valuation, and therefore nothing has happened. Because our perception of the molecule is what actually has come out. And I think we would be better off once we complete the phase 3 clinical trial and then approach them through merchant banker.
Okay. Now, just quickly, before we wrap up this conversation, when are you expecting approval from the DCGI, which is the Indian authorities? And when are you expecting approval from the US FDA? Give us specific timelines of these, because US FDA, you have a QIDP status there as well.
So US FDA, as I mentioned earlier, we expect in early 26 because of QIDP status, and the other countries will be a little later. As far as India is concerned, the DCGI has given us a permission to undertake a meropenem-resistant clinical trial in small number of patients. And this clinical trial also is getting over in next 2-3 months. And then we will be applying to DCGI. And probably we might be able to introduce in India at least about a year ahead of our international foray.
Okay. Just before we wrap up, Dr. Khurakiwala, I wanted to know, what is the downside risk of this particular drug? You've only spoken about the upside. What is the key risk that you're working with on the downside, that this entire analysis or situation that you've put out in terms of US FDA approval, DCGI approval, doesn't come through?
I don't believe there is a downside, because in fact this compassionate use is a far more rigorous than the clinical trial we are undertaking have done. So, and the fact that on a 35 patient, we have saved 35 lives, and we had 100% cure rate, and also that the drug was proved very safe for as long as 10 weeks. Now, antibiotics are not generally given for more than 2 weeks. In rare cases, it is given long. Yet some of these patients were so critical, and they were nearly on the deathbed. And therefore, the patient was saved and got a new life. So this is nearly, most of the cases, we have saved the lives.
All right, take that point. Thank you so much for joining in and giving us the outlook on this drug. Wish you good luck, and more importantly, the medical fraternity, because of the number of patients you said who are suffering from this condition, may stand to benefit from this drug. 26 months is when you expect it, 26 weeks rather, is when you expect it to be launched. In the next couple of months, you will hear from the trials, the clinical trials which are currently underway in the world right now. The stock seeing a bit of a spike on the comments coming in from Dr. Khurakiwala. Take a short break, come back, get you more on the markets and a lot more stock-specific action.
Evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond.
People of Jammu and Kashmir are voting for the first time in an assembly election in 10 years. This is also the first assembly election in Jammu and Kashmir since the abrogation of Article 370 in 2019, which gave the erstwhile state special status. A total of 9 million citizens are eligible to vote in this election for 90 assembly seats. In the 2014 election in unified Jammu and Kashmir, Mufti Muhammad Saeed-led Jammu and Kashmir People's Democratic Party had won 28 seats, which was the highest number of seats won, but fell short of the majority mark, which was 44. BJP had won 25 seats, Jammu and Kashmir National Conference won 15, and the Congress 12. The PDP and the BJP had formed a post-poll alliance, which fell in 2018 due to sharp differences, and since then the state has been under the Lieutenant Governor's administration. This time in 2024 assembly elections, there are 13 main parties fighting the election. The major regional players are the PDP, led by Mehbooba Mufti, and National Conference, led by Omar Abdullah, both of whom are former chief ministers. The National Conference has an alliance with the Congress party in these polls. Apart from the Congress, the BJP is the big national party fighting these elections, and there is a lot at stake for the party which is in power at the center. After several years, even separatist leaders are contesting elections. Engineer Rashid, a controversial politician, was released on bail and is contesting elections, and so are his supporters as independent candidates. Rashid could be an important candidate considering his strong support base and also because he had won the recent Lok Sabha election from Baramulla, defeating Omar Abdullah. Rashid's Awami Ittihad party has joined hands with the outlawed Jamaat-e-Islami. Now, why is this election important? In a way, this election can be seen as a referendum on abrogation of Article 370 and also the BJP's policies and handling of law and order in the state over the last 10 years. All opposition parties have promised to restore statehood and special status if elected. The BJP has ruled out restoring Article 370 but promised to restore statehood at an appropriate time after the elections. Union Minister Amit Shah has urged voters in Jammu and Kashmir to vote against separatism and terrorism. Let's see what the people of Jammu and Kashmir decide in these polls.
A little while ago, I got a very nice call from Kamala. No, it was very nice. It was very nice. It was very, very nice, and we appreciate that.
Investing.
There's been some respite for the markets from the lows. The Nifty was at one point, threatening to break into the red, but now from there on, it's seen some bit of recovery, and that's all thanks to the Nifty Bank itself. The only worry is the broader market. So if you look at, the advance decline ratio, nearly 2,000 stocks declining for just about 400 stocks which are advancing. So those crisscross lines far wide apart right now, with the red one much above the green one itself, and for the third day in this week itself. If you look at, this week, the Nifty is up just about a smidge, 0.2, 0.3%. The Nifty Bank's done well with a 2% gain. The mid-cap and the small-cap indices both down 2.5 to 3% each itself. And today as well, the Nifty Bank saw some profit taking from very close to record high levels. So the previous high on the Nifty Bank was 53,357, and today's high was 53,353. So just 4-point distance between the Nifty Bank today's high and the previous high as well. So those graphics come up for you on the screen. What's important is that it is Nifty weekly options expiry today, and the most active straddle, a call and a put together, are 25,500. The combined premium on 25,500 call and the 25,500 put are together close to around 80 odd rupees, telling you that 25,420 to 25,580 is the range, the broad range that the street is expecting in terms of expiry, and which explains why we saw a recovery from the lower end of the market today back within that range of 25,420 to 25,580 itself. Just keeping an eye out on a couple of stocks. A lot of long unwinding on Vodafone Idea, so keep an eye out on that one. Serious amount of short positions built on Indus Tower as well. Vodafone Idea, in fact, is sub 11 rupees, which was the FPO price at which the company raised money recently. So that's a concern. And two stocks which may enter F&O ban. We have Chambal Fertilizers and SAIL as well. So both are the stocks that we will keep an eye out on. But while we're talking about all the other stocks, remember Bajaj Auto hit its fresh all-time high today of 12,054 rupees. Remember, earlier this year, in March itself, Rajiv Bajaj, the MD of Bajaj Auto, said when they had come up with their buyback plan that he thinks the fair value of the stock is 12,000. Lo and behold, 12,000 is here. Today, the stock has crossed that level. So first listen into that snippet of that conversation, and then perhaps we get in Rajiv Bajaj to give us an updated target price, so to say, on Bajaj Auto.
In terms of fair valuation, I mean, without taking any names, all I would say is that in my head, I have a basket of companies that I think Bajaj Auto can be compared with in terms of its performance, in terms of its PE, in terms of its future prospects, let's say, etc. And frankly, to me, although the stock has moved up from 4,000 through 6,000 to 8,000, in my head, and as I said, I'm a layman in these matters, something closer to 12,000 sounds fair value, as you called it. So who knows, there might be another buyback in the near future.
Okay, all right. That was in March of 2024. In fact, let's now cut across to Parikshit Luthra for an exclusive conversation with Bajaj Auto's MD Rajiv Bajaj. Parikshit.
Right, Mr. Bajaj, thank you very much for joining us right now. Yes, in that interview to us in March, you had given us a prediction, maybe jokingly at that time, thinking that 12K might be the right fair value for the stock. What do you think has driven the growth of the company till this point?
It's funny, Parikshit, because when I actually joked about my retirement, people took it seriously. And when I spoke seriously about the fair value of the stock, you seem to suggest I was speaking in jest. But coming back to your question, after I said what I said at that time, Rakesh said to me that both he and our CFO Dinesh received many calls from analysts, and the common theme was the question that what is it you guys know that we don't, So that question comes back to my mind right now, that what is it that they know now that has made 12,000 the price for this stock? And to me, really, it's, we've executed well on all those things that you and I discussed. The freedom is out there in the commuter motorcycle segment. The new Pulsars are doing really well in the sports segment. As you may have seen, I think you were there day before when Rakesh rolled out the new Triumphs in the premium segment. You know how well the Chetak is doing. You know how well the three-wheeler electric has done in the last 6 months. And while with exports, we are still missing out on Nigeria, but the rest of the world is holding steady. So, as I had said before, we are really firing on all cylinders.
Right, and HSBC has raised its target price from 11,000 to 14,000. That's an increase of 27% for the Bajaj Auto stock. How do you think things will move on from here? And your thoughts on HSBC's latest report?
Well, what I'd like to say in that context is this, that if we step back and kind of look at the big picture of the domestic two-wheeler market, then, there's many ways to segment it depending on what attribute one is looking at. But one very simple, almost simplistic way, Parikshit, is to just break up everything into the commuter space and, let's say, the sports space, So in the commuter space, I would count about 700,000 motorcycles, as I did before when we discussed the freedom. But I was also add to that about 500,000 to 600,000 scooters, because scooters are essentially just city commuting vehicles. So that's a market size of 1.2 to 1.3 million vehicles each month. And the balance 300,000 motorcycles are, let's say, the sports segment. So if you look at our position till last year, for example, in this humongous domestic commuter segment of about 1.2, 1.3 million vehicles, what was our presence? Our presence was just about 40,000 vehicles, primarily with the Platina motorcycle, and we had virtually no scooters to speak of. Chetak this time last year was perhaps 4,000 or 5,000 vehicles a month, I think what has happened in the last 6 months, the most significant development now is that both the Freedom as a CNG motorcycle and the Chetak as a electric scooter have both really gained enormous traction. I had said to you earlier this month that after doing close to 10,000 vehicles last month, I'd like to think we can do closer to 20,000 this month. We are hoping to hit 20,000. It's going to be a bit of a struggle, it seems, but we won't be very far from it. Chetak, we are at full tilt as far as capacity is concerned. We had just about crossed 20 and we are struggling to push it above 20. So suddenly from a situation 6 months back when Freedom was not yet in production and Chetak was just about ramping up, you might well see a September in which both put together would be about 40,000 vehicles or a little more. And I think suddenly, at least we feel this, I don't know whether the street sees it like that, that suddenly between these two brands, we have this enormous runway stretching from now 40,000 Platina and 40,000 of this. So let's say 80,000, 90,000 vehicles a month, all the way up to 1.2, 1.3 million. And, it's a marketing effort aphorism that in any segment, the market leader has 40% share and the number two would typically have 20% share. So even if I were to look at it from a 20% opportunity, the question we are asking ourselves within Bajaj Auto now is that in the domestic commuter space, can we do 250,000 vehicles between the Chetak and the Freedom? And why not? So now that's not something for which, you can ask me whether we have a timeline and we have a capex plan. It's not, as crystallized as that. But I think that is the potential before these two brands, and perhaps that is beginning to be sensed.
Okay, so in March you had, and clearly you were well aware of where things will move on in the next 6-7 months. So you said in March that the fair value is around 12,000. Heart of hearts, what are you now hoping for in terms of the next fair value?
Well, again, as I said in March, that I'm quite a layman in these terms. But again, if I go back to both seeing our own situation internally, that we've really executed quite well in the last 6 months. So we've materialized a lot of the potential and are well on our way, as opposed to 6 months back when it was still, kind of just brimming with potential. And if I were to again compare with the new market scenario, because the market has also moved up, so that's no credit to us. And if I look at the basket of companies I was comparing with, then it seems to me as ludicrous, perhaps as 12,000 sounded at a time when we were closer to half that number. It seems to me that something closer to 20,000 is not out of the reckoning. At least in mathematical terms, one can justify it. Of course, the subjective, qualitative, and the sentiment side of things is a different matter.
All right, 20,000 on Bajaj Auto is the new target coming in from Rajiv Bajaj himself, saying that may sound ludicrous now, but given the quantitative parameters and the growth targets that the company has, along with the overall upliftment in the market itself, 20,000 is the target. So he had told us 12,000. The stock was closer to 7,000-8,000 odd in March itself. And now, as the 12,000 mark is here on Bajaj Auto, almost here, he's speaking about 20,000. Let's see whether that happens or not, but keep an eye out on that one. There has been a recovery for the markets. Take a short break, come back, focus on another important discussion. We have the medical devices industry as it's seeing its strong PE interest. What's keeping this industry abuzz? We have a special discussion lined up for you.
It's a dangerous business, however, being president. It's a little bit dangerous. It's, they think race car driving is dangerous. No. They think bull riding, that's pretty scary, right? No. This is a dangerous business, and we have to keep it safe. So when India, which is a very big abuser, he happens to be coming to meet me next week, and Modi, he's fantastic. I mean, fantastic man. A lot of these leaders are fantastic. You have to understand one thing. They're 100%. These people are the sharpest people. They're not a little bit backwards.
Welcome back. Over the last few weeks on Halftime Report, we've been talking about increased private equity investments in certain segments. And this is our special segment where we put you ahead of the curve on what are these underlying opportunities. We've spoken about the consumer space, we've spoken about media, we're speaking about the medical space as well, investments in healthcare, wellness, etc. And today we're talking about the medical devices space. Ekta, first roundup of the opportunities and the sector itself.
Well, yes, it's an interesting space. The medical devices industry is seeing strong PE interest. There have been around 59 private equity transactions in the Indian medical devices space since 2017, with PE deals in the space surging by around 3.3 times compared to pre-COVID-19 levels. Now, some of the prominent deals have included Warburg Pincus investing around $210 million in Merrill Life Sciences, which is one of India's largest medical device manufacturers, $300 million in ophthalmic equipment manufacturer Appasamy Associates. Additionally, Samara Capital has invested around $150 million in stent manufacturer SMT, and one of the most notable and recent has been KKR's acquisition of Healthium from Apex Funds, valued at over around $800 million. Now, Indian companies have largely focused their efforts and consequently deal activity on medical consumables and mid-range medical equipment. Medical consumables primarily encompass single-use or disposable products like syringes, IVs, surgical blades. Higher-end equipment produced by Indian companies includes stents, ventilators, X-ray machines and diagnostic equipment. So why is there such strong interest in the medtech space, particularly in medical consumables? The Indian medical devices market is valued at around $11 to $12 billion, and it's amongst the fastest growing globally, with an estimated CAGR of 10 to 12% from 2024 to 2030. Now, within this market, the medical consumables and implant segment is projected to be worth around 4 to 4.5 billion, growing at 10% CAGR. Currently, India is one of the top 10 manufacturers of medical consumables worldwide. Indian manufacturers benefit from lower production costs, skilled labor, and competitive pricing, which has led some investors to liken the sector to the generics industry of the 1990s. However, there are challenges and trends to consider. Investors emphasize the need for companies to enhance their technology capabilities and be mindful of competition from China, which is considered a decade ahead of India in this space. Additionally, India's ability to move into higher tech sectors where multinational corporations hold an 80 to 90% market share, such as specialized devices and high-end surgery accessories and consumables. So while investors expect strong private equity interest in the medical devices sector over the next 5 to 10 years, one cannot rule out pharma or healthcare companies throwing their hat in the ring as well. A recent example has been Alchem tying up with US-based Exactech to manufacture their joint replacement implants in India, to Mankind having been potentially interested in Healthium as well. Let's wind this down with the near-term deal potential pipeline. Possible deals could revolve around the acquisition of India's largest cardiac stent manufacturer, SMT. KKR, TPG and Alchem are reportedly in the race to acquire the company. Other anticipated deals include Everstone's plan to merge Translumina with Everlife Holdings, a distribution platform, and eventually list the merged entity. Additionally, medical equipment manufacturer Scanray, which counts notable investors such as Arun Kumar of Strides Pharma amongst its backers, is another name to watch out for in terms of potential M&A.
All right, so that setup that we've seen for the medical devices itself, let's keep an eye out on that, and let's take a short break. On the other side, we'll have important guests joining in as well to discuss the opportunity here in terms of investments and some of the challenges in terms of scaling up as well. Stay tuned.
are at the top. You know the expression, they're at the top of their game, and they use it against us. But India is very tough.
Welcome back. Well, let's continue our conversation about the medical devices industry and the kind of PE interest that we've seen. To talk more about it, we have Kevan Movdawala, healthcare sector leader and partner EY, Ernst Young, India. And we also have Anish Bafna, MD and CEO, Healthium MedTech, who's with us. Anish as well as Kevan. Thank you very much for joining in. Kevan, you know, we've had these conversations for a long time. We've moved from talking about hospitals to now medical devices. Right. Medical devices is seeing a lot of private equity interest. Give us a sense in terms of why and how much more can we see?
Sure, I think there are two or three things, and we've got to look at it from the demand-supply side, right? So on the supply side, traditionally it's been an MNC-dominant system with a very fragmented Indian supplier system. Right. Now that's changing. I think the number of companies who've scaled more than 100 million are almost 4 times what it was in the past. The Indian companies have been growing at late double digits versus MNCs where the growth has been slower. I think the big catalyst is on the demand side, where hospitals want to embrace Indian products given institutional pricing pressures, changing business model towards mass healthcare, penetration of Ayushman Bharat, right? So I think that's really driving this shift. Interestingly, we spoke about private equity money, 60 transactions, close to 3.5 times interest compared to pre-COVID. And I think the last point Ekta I'll cover is that, we are still a minuscule percentage of the global market today. We are 1% of the global exports. China is 10x of us. So the generic pharma story, which has worked well for India, I think med devices is going to see that headroom. So very soon we are going to be Make in India, made for the world. And I think the vision for the sector is to move from a 3 billion to a 25 billion industry over the next 5 years, actually capturing really 5% of the global market is what I see with the blend of private enterprise, institutional reforms, and also a larger ecosystem play.
So $3 billion turning into $25 billion. Anish, one likens this to how the generic market grew in India for the world as well. What from that can we learn to ensure that this growth also is a lot more strong, a lot more sustainable, and perhaps can be a lot bigger as well? What are the lessons that one should learn from that?
It's a very right sort of simile, because we are exactly where Indian pharma was about 30 or 40 years back. And currently, I think this is a transformative period for the Indian medical device industry, right? I mean, historically, the med device ecosystem has been heavily import dependent. 70 to 75% of what we use in this country is important, and that has been traditionally dominated by global multinationals. Right? With the ever-expanding healthcare provider space and network, there is an increased requirement for products to be manufactured in India, to be supplied here, high-quality products at affordable prices. And which is where you're seeing consolidation happening. You're seeing the private equity players also playing a very important role. But what we are seeing currently is the development of an ecosystem in India. A lot of players, there are about 3,000 now registered players as far as med device are concerned. And the beginning has started with surgical consumables and products that are used in infection prevention and the likes. But over a period of time, the ecosystem will get fostered. And as more components come in, as the captive consumption of the domestic market increases, we will see a lot of scale players who are able to do exactly what pharma did in the international environment, and take share from large multinationals in Europe, US, and other parts of the world.
Okay. Well, Anish, Healthium itself has had a very interesting story. It's gone from Apex to now KKR. Give us a sense in terms of how exactly the private equity money changed the course of the company, and where would you rank Healthium in terms of the products and the services that you're providing today as compared to the global peers?
Right. So, our story predominantly started in 2018. And in the fragmented market like India, the medical device industry, as I said, was predominantly multinational driven. Our vision was to create an independent Indian medtech company that not only caters to the Indian population, but creates strong products that can be taken internationally as well. And, we started through the acquisition route. We acquired 3 companies, 2 in India, 1 internationally. And over a period of the next 6 years, we were able to make 3 more acquisitions, make a divestiture. And as an organization, we've remained very focused on the surgical portfolio. So, what was earlier a sutures manufacturing company is now having 4 different verticals. We have advanced surgery, which is everything to do with wound closure. We have wound management. We have created an arthroscopy portfolio from scratch. Arthroscopy globally is about $5.5 billion market. And these are difficult to manufacture products. So, our view was India has an ecosystem in terms of the necessary skills, whether they are polymers, chemical, metals, and the likes. You have a lot of regulatory experience in this country. And if you're able to harness it, we can create a medtech company of scale. So we have arthroscopy, and then we have infection prevention. And that journey sort of has allowed us to grow the business double digit, both on the top line and the bottom line over a period of the last 6 years. We've grown our top line at about 20%, our bottom line at about 24%. And we've pivoted the company internationally, where 50% of our overall sales comes from the international market. We are now present in about 90 countries. We have about 85 patents. And all this was possible only because of the infusion of private equity money, which sort of allowed us to create this platform, both through the acquisition route and organically, and gave us sort of the funding to grow internationally as well. As we speak, we are the largest manufacturer of suture needles in the world, and 1 in 5 surgeries globally uses a Healthium product. So it's been a very interesting journey, and I really think that we've just started scraping the surface, because we cater to currently to a TAM of about $15 to $16 billion globally, and with certifications like US FDA, UMDR. The global network has really opened up for us, which is where we see a very large part of our growth coming for the next 10 to 15 years.
Right. We'll, ask you for your experience on this one as well. But coming back to you, Kaivan, one of the things is that the perception issue. Earlier, it was because it was MNC dominated, people associated MNC with a certain quality, India with a certain quality. How do you ensure that the perception of Indian quality being at par, if not better, than the MNC quality is tackled?
No, I think that's an excellent question. And I think there are 2 or 3 elements to that response. I think one is really credible data. I think Indian companies have been spending on R&D, even up to 5% of revenue, to generate data on technical equivalence. I think that's extremely critical to boost what I call hand loyalty, right? Surgeons who are getting trained at medical colleges, catch them young. I think data is one. Second is robust manufacturing capacity and capability, right? The regulations, whether it's US FDA, accreditations around EU MDR, C, I think will play a very significant role in narrowing this, perception gap. And I think third most critical is to have a very wide and deep product basket, right? Which covers at least 30% of the TAM, which gives confidence to the surgeons that these are products which are credible. And I think finally, the companies in this space need to have a very singular vision. Can I be the one-stop OT provider? Correct. Can I be the one-stop ICU provider and provide products at scale with the right element of scientific selling?
Okay. Anish, just before we wrap up this conversation, we are fantastic when it comes to medical consumables, products which are probably used outside the surgery and to a certain extent used inside the body as well, such as, say, stents. But we still haven't reached high-end medical manufacturing, which is dominated by MNCs. When does that shift happen, and will that shift happen?
Ekta, I think we are, poised for a multi-decade growth opportunity. The beginning always starts with consumables, products that are relatively easy to manufacture, that are able to harness the local ecosystem. But over a period of time, we will see the emergence of several players across subcategories who will position themselves globally. And, we have all the necessary raw material in place to make sure that we are able to make cost-effective and scaled manufacturing facilities that are able to cater to different kind of product categories in the future, right? I think the growth vector will get accentuated by this entire Make in India effort. And currently it's both Make in India and Make for the world. And what will further sort of accentuate this is our spends on R&D. If we as a company are spending roughly about 4 to 5% on R&D, and which everybody else is. So what I feel is that, our capabilities toward bringing innovative products is increasingly becoming better. We are having more collaborative efforts between industry, stakeholders, as well as the government. And the government's proactive stance to the sector becomes fundamental, right, for this kind of transformation to happen. So you're seeing a lot of work around infrastructure development, facilitating R&D, attracting FDI, promoting sectoral upskilling. So, with initiatives like PLI, the establishment of medical device parks, we will slowly see the formation of an ecosystem. But ultimately, what is very important is the captive consumption of the domestic market, right? I mean, the reason China grew is because the domestic market was very, very strong. As we are able to get a better foothold domestically and take share from multinationals, I think it's a matter of time where you will see a larger slew of products coming to the fore.
All right, Anish, as well as Kaivan, a pleasure speaking to you all on the medical devices industry. And I'm sure this is one of many conversations considering the kind of growth that we're seeing within this space. Thanks very much for taking the time out and speaking with us. Well, on that note, we need to take a short break, but we'll get you more on the markets, a lot of stocks in focus. Stay tuned.
Jammu and Kashmir is witnessing its first polls in the last 10 years, and lot has changed on the ground. It's historic polls because application of Article 370 has taken place, and also the fact that J&K has been divided into two union territories, which is Ladakh and Jammu and Kashmir. Around 23 plus lakh voters will exercise their franchise in the first phase, where around 219 candidates are going to these polls, and they are contesting and trying their luck. And there's a stiff competition that is going to take place. We are in Bijbehara constituency, where Iltija Mufti, daughter of Mehbooba Mufti, along with the NC candidate is participating, and this is something which is seeing a larger participation of people. You'll see the voters are queued up at this polling station in South Kashmir, and also that parts of Jammu are also witnessing these polls. 3 districts of Jammu, which has a tough competition, where BJP has fielded some candidates which are considered strong in those areas. But in Kashmir, there's an alliance between the National Conference and the Congress, and similarly, the PDP is going solo, while the BJP is aiming and trying to get its first seat in Kashmir, because they haven't been able to win any seats, so they're trying to get their first seat in the Kashmir region as well.
Welcome back. Well, let's shift focus to the commodity space now. Manisha joins in, and today she is focusing on zinc.
Well, I'm looking at zinc prices, which even after a bit of a decline overnight after the US Fed meeting, are even now trading at a 3-week highs. Well, if you look at the year 2024, the high for this year has been $3,100 a ton. We did see a low of around $2,300 as well, but currently we're looking at prices trading at $2,900 a ton. Well, the all-time high clearly was in 2022 at $4,600, so we are off those kind of numbers right now. Well, a few factors which are supporting zinc prices right now is the stimulus measures expectation from China, because all the data that has come in from China for the month of August and until mid-September has been on the weaker side, with expectations that China perhaps will do something more here. The second is Orda Zinc Norway smelter. The expansion now is getting delayed to 2025. So that means that the supplies would not come, which the street was accounting for in this year itself. The third thing is that the global zinc market seems to be tightening right now, because in the month of June, you are looking at surplus of 8,700 tons, while in the month of May, it was at 44,000 tons. So clearly, that is what the reaction that we have seen come in the prices already. If you look at the China zinc refined production for the month of July, also has seen a decline by more than 10%, also adding support to prices. Well, the LME inventories have continued to gain, though, up by nearly 2.5% on a month-on-month basis. But the street does believe that going forward, as we see infrastructure and demand within steel as well, so for galvanization as well, you could be looking at zinc demand continuing higher, and the support thus could continue.
Okay, all right, Manisha. Thanks very much for that. We'll take a short break. More on the markets once we're back. Stay tuned. Welcome back. Well, still under pressure for the mid-cap index, which is down around 1.4%. But there's a marginal improvement which has taken place in the advanced decline ratio. So that should come up for you. There were less than 1,000 stocks which were declining on the Bombay Stock Exchange. So there's a little bit of an improvement. Nothing really to write home about at this point in time, which has taken place on the advanced decline ratio. Otherwise, the Bank Nifty is one of the indices which is managing to hold up quite steadily. So up around 0.4% currently for the Bank Nifty. Well, on that note, we need to wrap up on halftime report. Business Lunch will take all the action ahead.
I support Israel's ability to defend itself. And I support the need for Palestinians to have dignity, self-determination, and security as we move forward and get a two-state deal done. But right now, the thing we need to get done is this hostage deal and this ceasefire deal. We need a ceasefire. We need the hostage deal. I've had direct conversations with the Prime Minister, with the President of Israel, with Egyptian leaders, and with our allies. And I think we've made ourselves very clear this deal needs to get done in the best interest of everyone in the region.
Markets see profit booking from morning record highs. The mid-cap see selling. FMCG, auto and financials clock gains, while energy and industrials are the big drags.
The U.S. Federal Reserve kicks off a rate cycle cut with a hefty 50 basis point reduction. It's first in over 4 years, but experts don't see a big cut from RBI and not before the end of the year.
The Supreme Court has rejected pleas filed by Vodafone Idea and Bharti Airtel for recomputation of their AGR dues. The move is a big blow for cash-strapped Vodafone Idea, which will now find it tougher to compete with its stronger peers.
Andhra Pradesh's liquor policy gives a boost to the liquor makers by facilitating retail sales by private players. The move is seen boosting volumes in the high consumption market.
And Jefferies' chief strategist Chris Wood tells CNBC-TV18 that the Fed's rate cut of 50 basis points is higher than expected, most likely due to political motivations. And while he sees emerging markets gaining, he expects higher capital gains tax in India, putting off global investors. Hello and welcome. You're watching Business Lunch here on CNBC-TV18. I'm Hormuz Fatakia. With me, as always, is Vinny Motiwala. Vinny, good afternoon. It was started off on a very positive note, but now we are seeing some bit of profit booking from higher levels.
Absolutely. Some bit of profit booking from higher levels, as well as seems like midweek blues, we could say, coming in for the markets. Not much of an excitement there. Look at the Nifty mid and small cap, Hormuz. We've spoken about in the last couple of days, and that underperformance for the mid cap especially is even continuing today. Look at the Nifty mid cap as of now also is down more than 1.5% from the day's highest point. We've seen a considerable fall coming in for the Nifty mid cap. Similarly for the Nifty small cap as well, almost a 2% decline from the day's highest point. So off the day's highest point is the Nifty mid as well as the small cap. Let's pull up some of the names in the mid and small cap that aren't doing well today. We have Vodafone Idea, obviously that's under pressure, and mainly this is coming in after the Supreme Court has rejected the plea for a recomputation of those AGR dues, and that is what is causing pressure on Vodafone Idea. Let's also pull up Indus Towers, Bharti Airtel. Those two also had seen some bit of a pressure. We did have Bharti Airtel give some bit of a notification that came in also that they will not be accepting this order. They say that this is not the right order that has come in, and they will be maybe giving an appeal again to the Supreme Court or maybe on that sort, something that we should be watching out for. But yes, keeping an eye out on Vodafone Idea, Bharti Airtel is what we should watch out for. Other than that, also you do have something like an Oil India, BSE, Torrent Power among the mid-cap names which aren't doing well and clearly under pressure, down almost 6 to 8%, all this in the range. And Oil India also clearly seeing a lot of pressure, Hormuz.
The Bharti Airtel order was related to some other penalties that the DOT had imposed on them, so it was not very important and not in relation to this. But yes, the Bharti Airtel is the only outlier within the telecom company, still holding on to gains. At one point in the day, the stock had almost reached 10 lakh crore in market cap, along with the partly paid shares put together as well. So Bharti Airtel is holding on. But yes, there is a lot of pressure within the PSU names in particular, and the defense names, if I would like to pull them up as well, be it HAL, be it Bharat Electronics. Most of them have corrected almost 15 to 20% from their record highs. Mazgaon Dock as well down 3%. HAL is now down 5%. Now almost nearing levels of 4,000. BEL, the latest entrant to the Nifty 50, will begin trading on the index towards the end of the month. That is also seeing some pressure in today's trading session. So PSUs under pressure. The benchmark indices are off the highs, and the pain continues in the broader markets. But the top story today is the big rate cut from the US Federal Reserve. The US Central Bank has lowered interest rates for the first time in more than 4 years and has cut its overnight lending rates by 50 basis points. Now, in the press conference addressing the media, Fed Chair Jerome Powell commented about the change in the policy stance, coupled with favorable economic data, and can aid the Federal Reserve in bringing the inflation down to 2%. Listen into what he had to say.
We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond.
Let's also listen into some of the expert opinions coming in from economists on what they had to say and make of this Fed rate cut this time as well.
But the key point here is what the Federal Reserve believes is the neutral rate. So my guess that is probably in the 3 to 3.5% range. So even if the US achieves the soft landing, so to speak, we're probably going to be at between 3.5 by the middle of next year. But in terms of the short term, I'm surprised it's Yeah, I'm surprised it's 50 basis points. Anybody who can read and listen is contrary to the messaging going into the meeting, so my guess at the margin is political.
I think US is on a very strong footing right now, and to the extent to which what we think the Fed has done is try to cut the risk of causing further slowdown out of restrictive monetary policy, it does give us the confidence that the US will be seeing soft landing. It is positive for Asia in the context in which the Fed is cutting rates. Of course, if growth is decelerating hard and Fed is cutting rates, that's not necessarily positive, because then the downside from growth will overwhelm the upside from lower rates. But in the current context, and with our base case view that the US will go through soft landing, this is definitely positive for Asia.
Fed moved because the balance of risks has now changed. They're much more comfortable that inflation is heading towards 2%, and they're a little bit concerned that the labor market has begun to soften. If you look at their own Taylor rule, right, about where rates should be, given this mix of unemployment and inflation, it should be at 3%, 3.5%. So there was this 250 basis point level shift that they had to undertake, and that's the way to understand this 50 basis point cut, that we may see more of it if the labor market slows in the coming months. Don't rule out another 50 in November if the labor market slows. But the point is that rates are now much above where conditions on the ground in terms of growth, inflation, the labor market are. The important part is the US is not slipping into recession just as yet. So they're cutting, in a sense, from a position of strength. This was a happy cut.
Well, so I think the markets will continue to favor strength. And from a global perspective, clearly India has been the strongest bastion and has been the strongest kind of island, if you may call that, from a global investment landscape. And with this environment of aggressive rate cuts, that should only augur well for a market like India and an economy like India. The reality is that global international investors, foreign investors have been underweight India. India's weight in various market indices has been kind of galloping ahead.
Well, now Economic Affairs Secretary Ajay Sept says he does not see any significant impact on inflows into India, and added that the RBI will take a call on interest rates at an appropriate time. Listen to what he had to say.
See, Federal Reserve has done what it assesses the good for the US economy, the largest economy in the world. And I see it as a positive for the global economy, including for the Indian economy. As far as your question about flows are concerned, it is a 50 basis points cut from a high level, from the high level. So I don't see that making any significant impact on the flows. You have to see how the things develop going forward. RBI, Monetary Policy Committee of Reserve Bank of India will take a decision at appropriate point of time. Right. And my sense is that their decision is based on what is good for the Indian economy. We should not read too much into the event which happened yesterday.
On that note, we're going to slip into a very short break. But after the break, we will come back and talk about the Supreme Court rejecting the pleas filed by Vodafone Idea and Bharti Airtel for the recomputation of AGR dues. More on the story after the break.
Today is National Voter Registration Day, and we are asking you to please join us in going to iwillvote.com to check your status and vote early like we do.
We are voting for Kamala Harris and Tim Walz because they are fighting to protect our reproductive freedom, our planet, and our democracy.
We can't let extremists control our lives, our freedoms, and our future. The only way to stop them and the dangerous Project...
Welcome back. You're watching Business Lunch on CNBC-TV18. And in a major setback for telcos, the Supreme Court has rejected pleas filed by Vodafone Idea and Bharti Airtel for recomputation of AGR dues. Ashmit is joining in with us to tell us more on this news update. Ashmit?
Well, first, to establish the significance of this development, let's bear in mind this was a curative petition. This was the final legal remedy that was available to Vodafone Idea and Bharti Airtel. With the dismissal of this application, that, of course, is the bigger takeaway. The bench headed by CJI, the curative petition has been dismissed by the Apex Court. That's the bigger takeaway. But, of course, in terms of understanding the significance, this was the final court of appeal. This was the final legal remedy that was available. With this decision that we've seen today, the AGR issue has been put to rest. It has been finalized. The Supreme Court has had the final word that there is no dithering, there is no changing of the quantum of the AGR demand that was first levied. Bear in mind that this judgment came back in 2019. At that time, the burden that was cast on Vodafone Idea was north of 58,000 crore rupees. Burden cast on Bharti Airtel was north of 43,000 crore rupees. Now, of course, those figures have grown dramatically with the levy of the interest component. But nonetheless, the long and short is that the contention that has been raised by the telecom companies that there are arithmetic errors, there are computational errors, there are administrative errors in arriving at that AGR demand that was levied by the DOT. That concern has been set aside. The Apex Court saying that no case has been made out. It does not feel the urgency to indulge this matter anymore. And with that, the curative petitions having been dismissed by the Apex Court and the issue being put to bed, put to rest, finalized by the Apex Court, AGR demand is here to stay.
Demand is here to stay. Ashmit, thanks a lot for that update. A significant development there for Vodafone Idea, now 14% lower, almost below its FPO price, which was 11 rupees a share. At one point, it even slipped below those levels. Now, Andhra Pradesh's new liquor policy gives a boost to liquor makers by facilitating retail sales by private players. Mangalam is now joining us to tell us the impact. Mangalam, tell us more on that.
Well, you know, the Andhra Pradesh cabinet has approved the new liquor policy, which comes into effect from October 1 for 2 years. And this facilitates retail sale of liquor by private players. Not just that, you know, it brings the status to what it was pre-2019. Add to that, you have the price of select brands, which will be brought down to 99 rupees per quarter as well. The street likes this. Why is that? Because one, it facilitates private sales, so it increases, you know, the sales of branded liquor itself. And we had the management of Tilak Nagar Industries join us just a couple of weeks ago in anticipation of this news coming in, saying that if this new excise policy was announced, volumes could actually grow by about 8 to 10% CAGR for the next 5 years. Given this policy is for the next 2 years, at least let's play that out for the next 2 years itself. We spoke to analysts as well, and they said that Andhra policy can grow volumes by about 7 to 8% in the very near term, and they see 14 to 15% volume growth for beer players and 10 to 12% for prestige and above spirits players in FY26 itself. Was this anticipated earlier? Yes, because we did see in the last 1 month a big run-up in names like Radico, Tilak Nagar, Global Spirits, and United Spirits as well. United Breweries wasn't a big participant in that, and as a result of which, that's among the top gainers today, along with United Spirits as well. So there was a bit of sell-on news happening today. This news is definitely positive from a long-term standpoint.
Okay, positive from a long-term standpoint. Mangalam, thank you so much for that update there. But let's move on. And the FTSE has announced its semi-annual review of the index changes, and adjustments will be made from tomorrow and with effect from Monday. Vivek is joining in with us to give us more details on that. Vivek?
Well, that's right. So the FTSE has gone ahead, last month they announced the changes to both the FTSE all-cap as well as the all-world indices. Remember, this is a net inflow event as far as the Indian equity market is concerned, and the rebalances will lead to a net inflow of close to $1 billion into the Indian equity markets. Now, which are the stocks, that will see the flows? Remember, we track the FTSE All World Index. That is the one which has a higher tracking amongst the analysts and which is the one that will see more amount of impact. So, almost 13 stocks will be added into the FTSE All World Index. Bank of Maharashtra, Bharat Dynamics, Central Bank of India, Cochin Shipyard, Endurance Technologies, Escorts Kubota, GE T&D, Hitachi Energy, Hutco, IRB, KEI, Lloyds Metal, as well as Motilal Oswal. All of them will come into the FTSE All World Index. Why are we highlighting it today? Tomorrow in the last of the trading session is when the actual changes will come into effect. Remember, along with that, the FTSE also has gone ahead and announced 48 additions into the FTSE All Cap Index. So they too will happen tomorrow. There have been no deletions from the FTSE, both All World as well as All Cap Index this time around.
Final hour of tomorrow's trading is when these changes will take place. Vivek, thanks a lot for that update. Time for a short break. Up next, we get you a second wave of chain explosions hit Lebanon. Details on the other side. Stay tuned. We'll be right back.
Agenda is to vote and elect Kamala Harris.
Vote like your life depends on it, because it does.
Go to iwillvote.com and make a plan to vote early.
Love you guys.
Welcome back. Now, a second round of simultaneous explosions took place across Lebanon, this time from the walkie-talkies used by the militant group Hezbollah. Lebanon's health ministry said that 20 people were killed and more than 450 were injured, while the death toll from Tuesday's pager explosions rose to 12, including 2 children, with nearly 3,000 people injured. NBC's Ralph Sanchez joins in with more details from the recent attack.
For a second day in a row, we are seeing a massive chain of explosions tearing through Lebanon. It was pagers belonging to Hezbollah members that blew up. According to Lebanese state media, it's walkie-talkies We are seeing these explosions in Beirut, the capital of Lebanon, but also in the south near the border with Israel, and in the east in a Hezbollah stronghold known as the Bekaa Valley. That's on top of the 12 who were killed. And hospitals are struggling to deal with an influx of more than 3,000 wounded people. Now, Israel's government is refusing to say whether it was responsible for these attacks, but the Israeli defense minister say the war has entered a new phase with troops and equipment shifting from the fight against Hamas in Gaza to the fight against Hezbollah in Lebanon. 2 U.S. officials tell NBC News that Israel was responsible for yesterday's attacks, and it appears that this is a new phase of that ongoing covert operation. The question is, will this cause Hezbollah to back down, or will it provoke it into all-out war?
Absolutely, concerns coming in on that front. But quickly looking at the market right now, let's pull up the Nifty charts. As of now, Nifty is holding on to gains of almost 0.2%. Yes, though it's off the day's highest point, trading around in that range in the last half an hour that we're seeing as well. Not much of an excitement, but still some bit of a gain there for the Nifty 50, 0.2%. Mid-cap continues to be under pressure. Sensex too holding on to gains of around 0.3%. Let's pull up Nifty FMCG because that's the interesting one today among the top sectoral gainers. Some bit of a green there. We have UBL, which is among the top gainer for the Nifty FMCG side. And other than that, also some of the other names like Hindustan Unilever, that's managing to hold on to some bit of a gain. We have Nestle India, Tata Consumers, all of them seeing some bit of a positive up move. And Tilakanagar Industries, like even Mangalam was mentioning, because of the AP policy, that we are watching out for the new liquor policy.
But there's a lot of pain in the broader markets as well. A couple of stocks that I wanted to highlight was Chambal Fertilizers was one of them. That's down 7.5%, down to the lowest point of the day. Now is Chambal Fertilizers is a recent exit from the F&O ban as well. So they're 7.5% lower for Chambal Fertilizers, and one more is IIFL Finance. That too has extended losses from the morning. Now it's down almost 6.5% in today's trading session. So not a good day for the broader market so far. But with that, it's a wrap on this edition of Business Lunch from Winnie, myself, and the team that put this show together. Thank you so much for watching. Midcap Radar takes the action forward.
Barely a few months ago, this spot was bustling with shoppers, and your shopping experience was incomplete without being shoved, jostled around, or stepped on at least a few times. Ranganathan Street has long been the heart of Chennai's retail capital, T. Nagar. But this neighborhood is hardly recognizable anymore. The transformation started soon after tunneling work for Phase 2 of the Chennai Metro Rail began earlier this year. It's the smaller retailers who have taken the bigger hit. In nearby Badaparani, 3 metro stations are being built on the arterial Arcot Road. Hardware, textile and electrical stores in these neighborhoods say their footfalls have come to a grinding halt, and some fear the losses they're suffering may spell the end of their businesses.
We have incurred losses of 50% since the metro rail construction began, and these roads were turned into one-ways since customer footfalls have dropped drastically.
I make just enough to pay rent and meet household expenses. Business has been gravely impacted since metro rail construction began.
I have faced losses of at least 3 to 4 lakh per month. I am unable to repay loans and my debt is piling up.
High street stores have also taken a hit. Shopkeepers say the pain has been compounded by the fact that the months running up to this have seen tepid growth in sales volumes in key retail markets in the south. 3% in May, 5% in June, and 2% in July. Experts say the absence of alternate infrastructure in Chennai has compounded the problem.
Unfortunately, in a city like Chennai, there are no alternative areas for customers to come in, park their cars, or come in and access the stores. But my guess is that If the speeding up of infrastructure happens, which is the way it is done in the other cities, things can be much easier.
But speed may be hard to come by because some portions of the Chennai Metro Rail could run into delays on account of trouble with land acquisition and funding. The Tamil Nadu government has already decided to single-handedly bankroll the ongoing phase of the transit corridor in the absence of central sanctions. So the June 2026 target to complete the project has already been pushed to December 2026, and many residents feel further delays cannot be ruled out. In Chennai, Jude Sanath.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on
Good afternoon. Welcome to Mid-Cap Radar. Mid-caps which are sulking in trade today, a big cut there, though they have recovered from the lows. The Nifty 2 of the highs of the day. Small caps also seeing big cuts. So though the Fed outcome is as some expected, looks like markets have come in for some profit booking.
Profit booking at the higher levels, we opened, I remember, but after that, it's been quite a bit of intense selling pressure. And like you mentioned, the broader end of the markets bearing the brunt of the majority of the selling pressure. But quite a lot lined up on the show. Let's start off with the top headlines. Market sees profit booking from morning record highs, mid-cap sees selling. FMCG and banks clock gains, while oil and gas, along with PSU banks, under pressure.
The Supreme Court has rejected pleas filed by Vodafone Idea and Bharti Airtel for recomputation of AGR dues. The move is a big blow for cash-strapped Voda Idea, which will now find it tougher to compete with its stronger peers. Vodafone Idea down nearly 15%.
GE T&D under pressure after promoters Grid Equipment and GE Grid Alliance announced an offer for sale in a bid to offload 11.7% stake in the company. The floor price has been determined at 1,400 rupees per share.
Wockhardt surges in trade after investigational drug Xenic cures complex case of meningitis. Management tells CNBC-TV18 they expect the drug to be in the global market in 2026 and could look for out-licensing opportunities next year.
BSE under pressure after 3 days of rally. The stock sees profit booking down nearly 5% in trade today.
Okay, those are the top headlines, but the biggest headline, of course, is what's happening with the mid-caps and the small caps right now. It's almost a 1,000-point cut that we're seeing on the mid-caps. And if we talk about the small caps, that one is seeing a bigger cut. But yes, from the lows of the day, at a point in time, we saw mid-caps seeing cuts of more than 1,100 points. It was down 2.5%. This definitely has recovered. So has the small cap index right now. Nifty up just 30 points. It's almost down 200 points from the highs of the day as well. The bank Nifty as well. It is outperforming the majority of the indices. But yes, it's up around 200 points. FMCG leads the pack in terms of movers today. So consumption themes continue to be the big talking point as well. But it's a Thursday that's feeling like a Friday today, Vivek. What about you?
Well, market bulls not feeling the same, at least in the broader end of the markets. But of course, given the fact that we have so much action happening, generally typically see so much action on a Friday second half. Now, when we're talking about the markets today, the PSU stocks have taken quite a bit of a knock. Some of the PSU names today, especially names like Concor, IRCTC, continue to see some selling pressure. In fact, the Nifty PSE index down over 2.5%. But a whole host of stocks, especially from the broader end of the universe, is what Hormaz has on his list. This is our special segment, Mid-Cap Movers. Hormaz, take us through the list.
Sulking is the word, right, within the broader markets. Even if they are recovering from the lows, they are still substantially down for a day's action, and the mid-cap index and the small caps as well. So we'll start off with the losers today, and Chambal Fertilizers is leading the losses on the mid-cap index in today's session, 7.5% lower at the lowest point of the day, as is IIFL Finance, another 7% down here. BSE, as I just mentioned, seeing some bit of profit booking today, as is Torrent Power, a recent high flyer as well. Another 5% shaved off on Torrent Power as well. Some of the AGR damage that took place in earlier this morning, but before that, the PSU stocks that are under pressure today, Oil India, HAL, barring NTPC, almost all PSU stocks are trading with losses in today's session. Even BEL, the recent Nifty entrant, will start trading on the index towards the later half of this month. As you mentioned, Vodafone Idea and Indus Towers not having a very good day at the office. Vodafone Idea at one point had slipped below its FPO price, so that is seeing some bit of a damage. But stocks that are doing well on the volume front, those will come up on your screen. And even then, the volumes, the stocks that are seeing some bucking the trend today, Rainbow Medical, Suven Pharma is one of them, KPR, United Breweries are seeing some bit of gains on very strong volumes in today's session. And lastly, some of the stocks, some of the other names that are doing well in today's session include PB Fintech, Ajanta Pharma and Campus Activewear. Back to you guys.
All right, that's an interesting list. A lot of these bucking the trend, and how. If you look at Neogen Chemicals right now, it's up 10% yet again. Remember, day before yesterday, it was Avendus Sparks initiating coverage, and the stock was up 15% then. Yesterday as well, chemical stocks did really well, and again today it's an 11% pop on that one. So just watch out for that one. There's a lot of exuberance that we are seeing in this particular name. So important to look at the fundamentals as well. But it's a good time to welcome Rachna Vaidya from rachnavaidya.in for a technical check on the markets. Rachna, good afternoon. Thank you so much for joining in. What are the charts suggesting now? Will we see a bounce back? Do you think the pressure that we are seeing from the highs could continue? Tell us more.
Yeah, good afternoon and thanks for having me here. Yes, Nifty is definitely facing some resistance at the level of around 25,600 on futures. And despite having the kind of news from the US, as it was much expected, the markets are still not behaving the way it was expected to behave. But nevertheless, once this sticky resistance of 29,550, 600 around on the futures is taken out, the rally should continue, because the chart setup suggests that the charts are quite strong and it is only a day of consolidation, nothing much. That too at the higher end of the range, so near the highs of the previous days as well. So everything appears to be good on a medium term or a few days basis. It's just that the day is not favorable for the bulls, and so the consolidation is happening over here, just as we have seen in the past few days as well. The AD ratio, etc., is not in the favor as of now. So some consolidation, after which the rally, I expect, should continue.
Good afternoon, Rachna. Thank you so much for joining us. Rachna, what are your top technical picks for the day?
Yeah, coming to my technical picks for the day, amongst the large caps, if I speak so, should be SDFC Bank and Unilever. Both of them are looking good. SDFC Bank, I believe, has formed a very good base, after which it should be continuing to rise the way it has risen in the past few days. And very soon, if somebody is willing to hold for the time period, say up to Diwali, 1st of November, then it is expected to show us a level of 1790 on SDFC Bank. And similarly, Unilever has started a move after many days, which is just the beginning for it's the first day today of the move. And Unilever can be going up to 2950 again on the futures. Coming to the mid caps, if we talk of mid caps, there are two counters which should do well. One is Jubilant Foods and the other is Voltas.
Okay, all right. Take that point. The consumption space continues to do really well. Thank you so much for joining in, Rachna, today with your picks and the technical outlook as well. We'll do one thing. We'll slip into a break. When we come back, we'll put focus on our mid-cap spotlight segment and talk about a lot more other stocks as well. Stay tuned.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence, and in-depth reporting that makes CNBC-TV18 India's #1 business news brand. Foreseeing change, growth, and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC-TV18, your trusted partner and investment ally.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC-TV18 and CNBC-TV18.com.
Investing.
Welcome back to Mid-Cap Radar. Well, once again putting the focus on a few of the telecom stocks as well as, the telecom infrastructure service provider continue to remain under pressure. Indus Tower, however, has seen a minor recovery. It saw an intraday low of close to 366 rupees a share. Stock has rebounded marginally to 390 rupees a share. The stock continues to remain down almost 9%. But moving on, the stock in focus right now is Gillette. The company has witnessed a margin structural turnaround by almost 200 basis points in FY24. Manglam joins us to tell us more.
Well, Gillette held an analyst meet yesterday, and for a category where people thought that the increasing trend of beards would impact their sales, that is not the case to be. In fact, over the last few months, if you look at it, the stock has given massive returns to shareholders, and that's largely because of a couple of things that the company has been doing, and some of them they've told the analysts as well. One, margins. They've improved structurally by about 200 basis points in FY24, led by cost savings and premiumization. They've launched a lot of new premium products as well. Male grooming, which is braids and razors, the category is a nearly 3,400 crore category, which is growing in mid-single digits. And in FY24 itself, they've had the highest ever market share for the company that they've had. The other growth vector for them is the female razor or the female shaving business, which has again unlocked a new engine of growth for them. So Venus, that product, has doubled in sales over the last 5 years and now contributes nearly double digits to the company's grooming sales itself. Then they have two other growth vectors as well. One is oral care, the other is appliances. Braun appliances now contribute 2% to the overall category in India. And in oral care itself, while the category they expect to grow at mid-single digit, remember they have launched lower price points in electronic toothbrush, which is growing much faster. So this may lead them to grow faster than the overall category itself. And to add to all of these product launches and new category launches, they've increased their reach by about 1.5 times over the last 3 years as well. So while, there could be overall headwinds for the category, the company is making decent headway out there, and that's reflected in the kind of results that the company is reporting and the stock reaction that we're seeing as well. In an otherwise wobbly market, Gillette is holding up mildly in the green.
Oh yes, it is up around 0.2%, but in a market like this, that is green enough. But thank you so much, Mangalam, for joining in with all those details. Let's move on to our special segment, Midcap Spotlight. Vamakshi is joining us, and she's focusing on GET&D. What's happening here, Vamakshi, and OFS?
Well, absolutely right, Sonal. An OFS, a proposed OFS, is the reason why the stock has declined in trade today. In fact, the promoters, which includes Grid Equipments and GE Grid Alliance, have announced this OFS. Keep in mind that back in August, the company had intimated that the promoters were reviewing the shareholding to simplify their holding structure. Back then, they had also mentioned that the promoters were considering a minority stake sale, but they expressed a strong intention to continue as the majority shareholder block of the company. Now, through this OFS, the promoters are looking to offload nearly 11.7% stake, and they also have an option to upsize the stake sale by almost 3.9%, making it a total of 15.6% in case of an oversubscription. Now, keep in mind that the promoters hold 75% stake in the company, and in case if the oversubscription does take place and the option upsizing is also exercised, the promoter holding will still be standing around at somewhere around 60%. The floor price for this OFS has been determined at 1,400 per share, which is coming in at a significant discount to the current market price. The OFS will be opening for non-retail investors today and for retail investors tomorrow. So overall, this development does not bode well for the company in terms of the supply of shares that will be available in the market. The valuations too are quite elevated for this counter, adding to additional pressure, and resultantly the stock is down and out in trading in the trading session today, trading at the lower end, that is the lower circuit.
Okay, yes, 5% lower on this one. Thank you, Vamakshi, for joining us with all those details and explaining why we are seeing that cut on the stock as well. Let's talk about NTPC. It is in focus after a CNBC-TV18 news break was confirmed. Subsidiary NTPC Green has filed DRHP for an IPO. Vivek, you told us first, and it's final now.
Well, that's right. On Monday, we told you about how NTPC was most likely going to go and file the DRHP to launch an IPO for the green energy arm or the renewable energy arm of the company was concerned. So the renewable energy arm of the company is NTPC Green Energy Limited. The company has gone ahead and filed for a fresh issue of shares where via the IPO route, they will be looking to raise a whopping 10,000 crore rupees. Now remember, out of the 10,000 crore rupees in the DRHP, it is mentioned that NTPC Green's subsidiary, which is NTPC Renewable Energy, will be using 7,500 crore to go ahead and do a debt repayment. Now looking at the FY24 financials of this particular arm, revenues of close to 1,962 crore, operating EBITDA a little around 1,750 crore, and a profitability close to 344 crore. And remember, the company has very significant and ambitious plans as far as going ahead, number one, for capex as well as capacity addition targets in the renewable space is concerned. The installed capacity currently is around 3.3 gigawatt, but the company has said that by FY27 it plans to commission 20 gigawatt, and by FY32 company plans to have a 60 gigawatt renewable energy portfolio. On the back of that, number one, what we are still awaiting is the price band for this particular issue. But remember, this unlocks significant value as far as NTPC is concerned.
Okay, so that is about NTPC. Some important news coming by, an important IPO as well, a big one that the street will be watching out for. Thank you, Vivek, for that. Let's slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned for that.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. from chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com. CNBC-TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC-TV18 weeknights at 7 p.m.
We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote.
Welcome back. Just at the flat line for the Nifty. The Nifty is up 6 points. It was very close to getting into the red as well. So it's a big cut that we are seeing from the highs of the day at least. The Nifty is at the day's low as we speak right now. It's almost a 200-point cut from the highs of the day. The high for today was at 25,612, and right now we're seeing cuts of almost 220 points from the highs. The mid caps will also come for you on the screen. There was a wild recovery that we are seeing. It was down less than 1,000 points. Now it has come back to those levels of cuts of more than 1,000 points as we speak. So the selling pressure that continues. We'll have to see what happens in the last 1 hour. That is going to be very important for the Nifty as we speak. Moving on now, PVR Inox has been in focus as the company saw strong sales this season, while Shraddha Kapoor and Rajkumar Rao stars 3-2 saw stellar numbers at the box office. Re-releases such as Rehna Hai Tere Dil Mein and SRK's Veer Zara are also drawing crowds. CNBC-TV18 Shilpa spoke to CEO of PVR Inox Pictures, Kamal Giachandani, and began by asking him about company's performance in Q2. Listen in.
Q2, July and August have been extremely strong, and as you rightly mentioned, 3 has turned out to be something which never was expected to be this much. It was always expected it would do well, but the kind of business that we've seen is beyond expectations.
Right.
Fortunately, a lot of other films have also done well. Deadpool is another case in point, a film which did really well, and the fact that it was an adult film. With that rating, for it to do that kind of business, again, augurs well for theatrical. Surprisingly, the re-releases have also done well for us in Q2. Tumbad, a recent release, film which came out pre-COVID, and it did fairly modest business, but it was always appreciated. Critically it was acclaimed, a lot of people saw it on streaming. And this is one example where there is a positive cycle between streaming and theatrical. People saw the film on streaming.
They wanted to see it.
And they loved the movie. And because the theatrical experience is so differentiated, as soon as it came out in theaters, people are back in strong numbers.
Given how the rest of the year is expected to pan out, then do you see that? Do you expect an improvement in the average ticket prices also, because that sort of dipped, and understandable because there were no big releases. But with very big releases expected, then how do you expect that trend to go forward? And while new re-releases are seeing 30 to 40% occupancy levels, how are you looking at the overall occupancy levels settling in?
I think on the ticket price compared to last year was about 258 rupees, the blended average ticket price. We will cross that.
Okay.
Will it be much higher? What percentage higher than last year? Difficult to comment at this point, but we will definitely cross that. Looking at the lineup in Q3, we feel fairly comfortable with the ticket prices where we are. In terms of overall occupancy, I think last year was about 26%. This year is also tracking around the same percentage. But I would say that the next year that the next financial year that we have, with the kind of lineup, the films which have been sort of pushed to next year, both Hollywood as well as Hindi as well as Tamil, Telugu, I think we are pretty set for a very sort of strong next financial year, much higher than what we have this year for sure.
Right.
And I think we will see numbers which would pretty much be the best numbers that we've had post-COVID.
Well, a very interesting conversation there with the management of PVR. Having a look at the mid-cap index and the small-cap index. Once again, mid-cap index now trading with cuts of 1.6%. So very significant cut seen over there. And even when you're talking about the small-cap index, that too is a significant cut. Now, Shilpa also caught up, with the management of PVR. They had something further to say. Let's listen in to those bites.
In us joining, we did not want to, like you said, touch the mantle, the existing mantle and the infrastructure that have been in the process for many years. It took a long time and it took a lot of people and a lot of ideas to get PVR Inox to where it is. So we're not here to, to restructure or change things, as they say, but we're here to bring in our fresh perspective wherever we can, to innovate on technology and definitely become that bridge between the company and this newer generation of consumers. Because the way people are consuming content today is very different from even 5 years ago.
Understanding definitely the asset, what the existing asset is, but really accentuating the brand beyond the asset. I think there are many wonderful innovative ideas that we have in the pipeline in regards to repurposing auditoriums, repackaging what the current skeleton of the cinema ecosystem looks like, adding more marketing activations as well as acquisitions of different types of film. So all in all, I guess it's finding that that differentiation between just the asset, stretching the brand a bit more, and really conveying what the new age of cinema is to the modern day consumer.
That was our colleague Shilpa, catching up with the next gen at PVR. But with that, it's all the time we have on this edition of Midcap Radar Mutual Fund Corner when we return.
And price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond.
People of Jammu and Kashmir are voting for the first time in an assembly election in 10 years. This is also the first assembly election in Jammu and Kashmir since the abrogation of Article 370 in 2019, which gave the erstwhile state special status. A total of 9 million citizens are eligible to vote in this election for 90 assembly seats. In the 2014 election in unified Jammu and Kashmir, Mufti Mohammad Saeed-led Jammu and Kashmir People's Democratic Party had won 28 seats, which was the highest number of seats won but fell short of the majority mark, which was 44. BJP had won 25 seats, Jammu and Kashmir National Conference won 15 and the Congress 12. The PDP and the BJP had formed a post-poll alliance which fell in 2018 due to sharp differences, and since then the state has been under the Lieutenant Governor's administration. This time in 2024 assembly elections, there are 13 main parties fighting the election. The major regional players are the PDP, led by Mehbooba Mufti, and National Conference, led by Omar Abdullah, both of whom are former chief ministers. The National Conference has an alliance with the Congress party in these polls. Apart from the Congress, the BJP is the big national party fighting these elections, and there is a lot at stake for the party, which is in power at the center. After several years, even separatist leaders are contesting elections. Engineer Rashid, a controversial politician, was released on bail and is contesting elections, and so are his supporters as independent candidates. Rashid could be an important candidate considering his strong support base and also because he had won the recent Lok Sabha election from Baramulla, defeating Omar Abdullah. Rashid's Awami Ittihad party has joined hands with the outlawed Jamaat-e-Islami. Now, why is this election important? In a way, this election can be seen as a referendum on abrogation of Article 370 and also the BJP's policies and handling of law and order in the state over the last 10 years. All opposition parties have promised to restore statehood and special status if elected. The BJP has ruled out restoring Article 370 but promised to restore statehood at an appropriate time after the elections. Union Minister Amit Shah has urged voters in Jammu and Kashmir to vote against separatism and terrorism. Let's see what the people of Jammu and Kashmir decide in these polls.
A little while ago, I got a very nice call from Kamala. No, it was very nice. It was very nice. It was very, very nice, and we appreciate that.
Hello and welcome. You're tuned into MF Corner. I'm Sonal Bhutra in the Mumbai studio. Today we are going to put focus on investing via the systematic withdrawal plan. It's exactly not investing, it's taking money off your investments. But what are the benefits of going ahead in this mode? Which one is better? There is SIPs, there's SWPs, but of course we compare SWPs with dividend funds. So there's a lot that we need to discuss, but because there have been recent updates about how people have been making a lot of money and investment returns have been higher via SWPs. So we are going to discuss this and more with Udayan Ade, the founder at Udayan on Money, and Rishabh Desai, founder at Rupee with Rishabh. Gentlemen, good afternoon. Thank you so much for joining in. Always a pleasure to speak with the two of you. And you know, as I said recently, there have been a lot of comments about how SWP is the way to compounding of your returns. So we need to understand whether that's the right thing or not. But before we do that, let's talk about the basics. Rishabh, let me start with you. What exactly is an SWP and how does it differ from an SIP?
Hi, Sonal. First of all, thanks so much for having me on the show. It's always a pleasure to talk to you. See, SWP, in very simple words, it means systematic withdrawal plan, right? It's an automatic method to withdraw a certain amount of money on a fixed date. Now, investors can withdraw weekly, monthly, quarterly, semi-annually, annually, and so forth, right? On the other hand, SIP is systematic investment plan, right? You're actually investing money in mutual funds in an automatic method on a fixed particular date. Now, again, this can be on a weekly, monthly, quarterly, semi-annually, and annual basis. So SWP means withdrawing money on a fixed date on a certain amount, and SIP means investing money in mutual funds on a fixed day on a certain amount.
Okay, so because we keep talking about SIPs, so I thought it's time to talk about what the withdrawal plan also would look like. Udayan, let me come to you. Now that we have spoken about the basics, SIPs versus SWPs, can you explain with an example, how would an SWP impact investment returns, say over 5, 10, 20-year period for any investor?
Thank you so much, first up, Sonal, for having me, and good afternoon, Rishabh, to you as well and all the viewers. So, SWP is something that has been more and more discussed in the past few months or the past year, and I honestly believe that SWPs are simply meant specifically for people who want to generate an income from their investments, and that sounds like a very fancy phrase, right? Who doesn't want to generate income from their investments? But the moment you start an SWP, for all intents and purposes, it is a withdrawal that you're making. It is a redemption that you're making. The only difference between normal redemption and an SWP is that in an SWP, you're scheduling that withdrawal. So, you know, for example, it's a monthly SWP, then you're telling the mutual fund house that every month on this date, I want X amount of rupees. Now, if you notice, when you're taking money out of your investment, it is definitely going to affect the compounding that could take place, right? Because think about it, you have 1 lakh invested, and you're taking out 5,000 rupees from it every single month. So for the first month, you have 1 lakh rupees invested, but for the second month, now you have 95,000 rupees invested. For the second month, you have 90,000 rupees invested. And if at that time, the market goes up, it's not going to go up on the 1 lakh rupees that you had invested. It's going to go up on the 90,000 that you have invested. So it affects the process of compounding. So as far as possible, SWPs should not be started by someone who is still in the accumulation phase of their life, where they're still working, where they're still saving for various goals. It should ideally be started by retirees. And just to give you an idea as to how it affects investment returns, so a 10,000 per month SIP, let's say you had continued that for 15 years at a 10% step up, and it grows at 12% annually. That would grow to about 85,000 rupees. But if you have an SWP that is started from the very first month of 3,000 rupees per month, and you're increasing again by 10% every year to keep up with inflation, then in that instance, you have about 60 to 65 lakh rupees. And this effect only becomes even more stark with a longer time frame. Because remember, you're taking money out in an SWP, which affects compounding.
Okay, so not the best idea if you want to return better money or higher money for yourself. Thank you for the explanation, Udayan. Rishabh, you agree with it? It is not the right thing to go about. SWP, that is, systematic withdrawal plan. With an example, if you can explain.
I agree what Udayan had to say, actually. I would like to add one point that, before starting an SWP, it's very important that the money is invested for a couple of years, right? You don't want your capital to be affected over a longer period of time, right? So, we usually tell our clients that before starting an SWP, you invest the money in the market and let it grow anywhere between 1 to 3 years. This allows your capital to grow and come in the profits, right? Once you are in profits and then you start the SWP process, your capital is safe. The systematic withdrawal amounts are also not affected, and you will also make some money over and above your capital, right? So again, see, just to give you a very small example, say if someone wants to draw 50,000 rupees per month, they will need an investment corpus of 50 lakh of rupees, right? Assuming 12% CAGR returns for a period of 10 years. This is, I'm assuming, if the investor wants an SWP for a period of 10 years. Again, the investor needs to get the assumed returns also right? See, for example, we tell our clients over a longer period of time, we expect 12% CAGR returns in equities. We tell our clients, don't pull out exact 12%, probably, pull out 2 to 4% less than the assumed returns. So this allows the investor capital to be protected, withdrawal amount to be secured, and the investor will make some kind of returns over and above of the withdrawals he or she is making, Sonal.
Okay, so at the end of the day, the balanced corpus is equivalent to the corpus that you had earlier, the capital that you had earlier, of course. So it protects your capital, but as both of you have mentioned, it would not be the best advice to do in case you are looking for higher returns as well. Udayan, let me come to you. When would an investor go for a systematic withdrawal plan?
The classic example or the classic instance where you want to set up an SWP is during retirement. So let's say through all the various retirement benefits, through your investments that you have made while you were working, you've accumulated a certain amount of money. Now, obviously, for most people who are working today, they would not get a pension. Now, in that very specific instance, what we want to ensure is that the money that you have saved up for all this time, that is going to last you for the next 30, 35 years of your life, right? Because income has stopped. So in this specific instance, I think then an SWP would be perfect. And the global average for what the safe withdrawal rate is, how much money you need to have to be able to live off that money for the rest of your life, the global number is 25 times your annual income. In India, though, that is very different. It is not 25 times. It is about 30 to 35 times your annual income that you want. So let's say you want to withdraw 1 lakh rupees. That is about 12 lakh rupees per year. And you want that money to last about 30 to 35 years. In that instance, you need about 30x of that. So that about 3.6 to 4.2 crores. And this was a fascinating study study that was conducted by two brilliant Indians, Ravi Sarauji and Rajan Raju. Wonderful study, the first of its kind in India. So while people want to withdraw 6, 7, 10% of the money, you're going to run out of money in that case, right? Because with every year, you would pull out more and more money because of inflation. So remember that number, right? Between 30 and 35 times of your annual target income is what you'd ideally want to have saved up, because you can only withdraw 3 to 3.5% in a very safe way.
So you need a lot of money to even withdraw money. That's exactly the crux of SWP here. Rishabh, let me come to you. First, when do you think one should go about it? And second, what are the benefits, if any, for any investor if they have to go ahead with systematic withdrawal plan?
Sonal, first of all, I'll come to the benefits actually. See, I mean, SWP is a phenomenal methodology, someone who wants hassle-free, quick, automatic liquidity on a regular basis, right? As mentioned earlier, there are three things what investors need to keep in mind is that to get the approximate long-term returns of an asset class, right, pull out, 2 to 4% less than the assumed returns. In this case, the withdrawal will be unaffected, capital will be unaffected, and your capital will also grow. Now, if you see, SWP works best in growth options, especially for equity products for the products who fall under the equity taxation. Because in IDCW, which is income distribution, capital withdrawal and dividend options, you are not only charged TDS, but your the money, the gains is taxed as per your tax slab. So in terms of equity, it's 20% for short term and 12.5% for long term. So I think SWP will work best in equity related products because there is a lot of tax efficiency as well. As Udayan also rightly said, I mean, I wouldn't encourage someone to go for SWP in the accumulation phase when they are young, probably in their 20s, 30s, and 40s. I think ideally people who have accumulated or grown their corpus over the period of 10, 15, 20 years, and after that starting an SWP either from equity or probably shifting the equity if they cannot stomach too much of volatility probably towards the later years. I think shifting from equity to either hybrid products or debt products and then doing an SWP would work best. But keep in mind that, of course, inflation is going to eat up, your pockets and your returns. So I think in the accumulation phase, a lot of saving and most importantly, investing in equity as an asset class needs to be done thoroughly. I mean, I encourage my clients to save at least 50% and invest that 50% of your monthly income into equity during your accumulation phase.
That makes sense. As we were pointing out earlier, you need to accumulate some corpus before starting a systematic withdrawal plan. And as Udayan mentioned, you need to have money to withdraw money at the end of the day, right? So, gentlemen, there's so much more to understand about this phenomenon, but we have to take a quick break. On the other side, we'll continue our discussion with Udayan Adye and Rishabh Desai to understand everything about systematic withdrawal plan.
It's a dangerous business, however, being president. It's a little bit dangerous. It's, they think race car driving is dangerous. No. They think bull riding, that's pretty scary, right? No. This is a dangerous business, and we have to keep it safe.
Welcome back. You're still tuned into MF Corner. We still have with us Udayan Ade and Rishabh Desai. We are understanding everything about systematic withdrawal plans, whether they are a good option and whether you should go about it or not. Gentlemen, we have discussed the basics, what it exactly is, what could the final returns look like. Udayan, let me come to you now. Suppose somebody has decided, yes, they need a monthly income, they need to withdraw some money. What is better for them, dividend funds or systematic withdrawal plan?
So, with dividend funds or income distribution cum capital withdrawal, that's the technical name, the challenge is that the money that you get is taxed at your income tax level. So that if that is in the higher tax brackets, then in that case, an SWP could be a better idea, simply because the SWP money that hits your account for balance funds, for all equity funds, that is taxed as capital gains. So for long-term gains, that would be about 12.5%, and every year you get 1.25 lakhs tax-free within that sphere. So in that case, if you're in the higher tax bracket, anything above 15%, then SWPs could be a good idea. But for, let's say, someone who's not at all in the taxable income, then straight up your withdrawals or the dividend that you get from mutual funds, that could be an option that you may pick. But remember once again, right, that the money that you would withdraw as a retiree every single year would keep going up because of inflation. And because of that, you don't want to, just set that and forget it, because you could very well in 5 years, the money that you're withdrawing, that could now be higher than your taxable limit. So now your income could be taxable at a higher rate. So SWPs for anyone above the 15% bracket, I think, makes the most amount of sense than the dividend option.
Okay, all right. So on the higher income side, it makes more sense to go for an SWP. Rishabh, let me come to you because, of course, we cannot time anything. With SIPs, we always say that you cannot time your SIPs or the markets. But when is the best time to do an SWP or systematic withdrawal plan? Is it monthly, is it yearly, or is there a specific time period that you should be looking at?
Sonal, I think the best methodology is either to do it monthly, semi-annually or annually. I wouldn't recommend clients to pull out money on a very, very regular basis. I think most of the cases, because we require some kind of money during the starting of the month for our expenses, throughout the month. So I think doing an SWP either on the first or probably last week of the month would be best. It's typically meant for those who require cash flow. See, I'm saying this very specifically, Sonal. I mean, whether you're at the retirement age or somewhere in the middle age or 30s or 40s, it is purely for someone who requires some kind of cash flow, to meet their expenses or for whatsoever reason, right? Stay invested for at least 1 to 3 years before pulling out your money, because this allows your product to go into profits and make sure that the capital is not hit. So I think SWP works best on a monthly basis, but make sure to step up, not very regularly, not on a yearly basis, but at least try to step up on a 2 to 3 year basis, so that your withdrawals are also protected, your capital is also protected, and some amount of money also grows.
Okay. Udayan, your take, is systematic withdrawal plan something that should be considered as a style of investing?
If you're not retired, right, if you're still in your accumulation phase, you're earning money, take it up as literally the last resort, because you're working hard, you're investing money, and that money is compounding. The markets have done well in the past 5 years, so you'd have seen good returns. So there's always the temptation, okay, can I take some money out to, on a regular basis? When that happens, you are again affecting the process of compounding. I am personally a bigger proponent of, if you need money, then set up a redemption. Don't set up a systematic redemption. So it's not a redemption that hits your account every single month, unless, of course, you're in a position where, let's say, you have been laid off from your job or you can't work and now you need to generate some kind of income from your investments. At that time, go ahead. But for meeting specific goals, like, right, let's say you want to go for a vacation, you want to buy a car, you want to fund the down payment of your house, in that case, just set up a straight up redemption for that amount. And that is, working with someone who understands your finances, whether it's a mutual fund distributor, whether it's a registered advisor, they can help you out with this process more, because as you get closer to a goal, you want to move some of that money into a safer asset. But SWPs, typically for people who just want to generate income. But remember, it's going to affect the compounding process, and you're going to end up with lower returns over a period of time, because at the end of the day, you're taking out money that could have grown in the future.
Makes sense. And as you rightly explained, it will impact the compounding that you see if the money stays in your account. So redemption is better than with systematic withdrawal, so to say. And as Rishabh also said, it really depends on the situation, the profile, and what you want to do with that money at that point in time as well. So Rishabh, you mentioned that, you know, maybe the first of any month, the last day of any month, and also depending on what kind of money you want and the inflation. So should one increase their SWP basis the market condition? How can one go about it and change the amount? Or do you think it can remain stable over years?
I mean, if you let the money grow for some years and then start to pull out, I think it will remain the way it is. I don't see much of step up needed in that way. But of course, see, inflation. See, today the headline inflation is quite lower. I don't deny the fact. But again, investors should keep in mind that, you know, my expenses and my lifestyle will be very different from your expenses and your lifestyle. So my inflation figure and your inflation figure will be, of course, very different. See, retail, for a retail or probably a middle class or a lower middle class, you know, the inflation would be, say, 4 or 5%. But for an HNI or an ultra HNI, you know, the inflation can go as high as anywhere between 10-15%, right? So it first of all, you really need to accumulate money. We are not a very pension friendly country. I mean, in corporate sector, we don't get any pension after our retirement, and even in the government companies and whoever are government employees, they also don't get that substantial amount of pension. Looking at our lifestyle, you know, that we want to explore a lot of things in life today. So I think, you know, venturing towards a little bit of a simpler lifestyle, you know, people who have limited resources, you know, budgeting well, and Udayan also has correctly said that rather than going for an systematic withdrawal plan, I think probably punching in redemptions from time to time, say probably during a bull market, that would work best. You know, probably if you have decent amount of income, other sources of income during a correction period or a bear period, I wouldn't suggest, you know, to pull out money or to reduce units during the bear period. On the other hand, if you have some kind of money in hand, cash in hand, you know, pump in more money during bear market. That will help you accumulate more units. You know, that will help you, you know, your money grow over a longer period of time during the bull run. So number one, I think systematic withdrawal plan should be done, you know, has to be kept as a last resort for people who are young, who are in their 30s, 40s, and make sure that, you know, don't go overboard in pulling out money. You can step up on a 3 to 4 year basis, or probably 2 to 3 year basis, but try to step up anywhere between 5 to 7%, probably not more than that.
Okay, all right. So both of you have made it clear that it's better to see redemptions than do a systematic withdrawal plan, because that would not tinker with the compounding that you're seeing, and also you can phase it out or you can pace it over different market cycles as well. So that is clear, but still taking it ahead for the benefit of our viewers, then is it good, say, for a particular category or a mutual fund, or this is across the industry, that, you know, you should not go for systematic withdrawal plan for any of the categories, so to say, be it debt or equity?
So typically you can set up an SWP. You're allowed to set it up across any category, whether it's an equity fund, an index fund, a balanced fund, a debt fund. But what do you really want to do, right, when you're getting hands-on with your money? Because remember, in an SWP, I again keep saying you're withdrawing money from your investments. Now, if it's in an all-equity portfolio, which is a volatile asset at the end of the day, in the past 40 out of the past 44 years, the Indian stock market has dropped 10% in every calendar year. So keeping that in mind, if you start an SWP from an all-equity portfolio, it's going to be much riskier, because there is a chance that, you know, the markets are down 10%, 20%, even 30%. We have seen those times, right? And at that stage, if they linger at that lower level for a while, then you're pulling out money at a lower unit rate, or when the markets are low. So again, you're going to erode your capital very fast. So in that case, when we are working with our clients, what we usually recommend is you opt for an SWP from a very diversified balanced portfolio. So that has equity, that has bonds, that has gold. This can be done through balanced funds. This can be done through multi-asset funds. But it's very important, even then, to have equity in your portfolio, because, you know, as Rishabh was also saying, that the inflation that we see reported on the TV, in the newspapers by the government, that is inflation for the lower middle class or middle class population of India. For a lot of people, that would be around 8, 10, 15%. So just to give you an idea, if the inflation is 8%, what you can buy with 1 lakh rupees today per month, you'd require about 2.25 lakhs in 10 years, about 4.5 lakhs in 20 years, and 10 lakhs per month in 30 years.
Got it.
So you want that return to be above the inflation rate, and that's why you need that injection of equity, but keep it around 40, 50% higher if you're a very experienced investor.
Got that point, gentlemen. It was such a pleasure to have both of you on the show and talk about systematic withdrawal plan. There have been a lot of policies, or I would say a lot of myths floating around as well. So it's good to get clarification from experts as to how to go about this particular phenomenon. With that, we'll take your leave on MF Corner today. Stay tuned for Closing Bell to take you through the last hour of trade.
We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond.
People of Jammu and Kashmir are voting for the first time in an assembly election in 10 years. This is also the first assembly election in Jammu and Kashmir since the abrogation of Article 370 in 2019, which gave the erstwhile state special status. A total of 9 million citizens are eligible to vote in this election for 90 assembly seats. In the 2014 election in unified Jammu and Kashmir, Mufti Mohammad Saeed-led Jammu and Kashmir People's Democratic Party had won 28 seats, which was the highest number of seats won, but fell short of the majority mark, which was 44. BJP had won 25 seats, Jammu and Kashmir National Conference won 15, and the Congress 12. The PDP and the BJP had formed a post-poll alliance, which fell in 2018 due to sharp differences, and since then, the state has been under the Lieutenant Governor's administration. This time, in 2024 assembly elections, there are 13 main parties fighting the election. The major regional players are the PDP, led by Mehbooba Mufti, and National Conference, led by Omar Abdullah, both of whom are former chief ministers. The National Conference has an alliance with the Congress party in these polls. Apart from the Congress, the BJP is the big national party fighting these elections, and there is a lot at stake for the party, which is in power at the center. After several years, even separatist leaders are contesting elections. Engineer Rashid, a controversial politician, was released on bail and is contesting elections, and so are his supporters as independent candidates. Rashid could be an important candidate considering his strong support base and also because he had won the recent Lok Sabha election from Baramulla, defeating Omar Abdullah. Rashid's Awami Ittihad party has joined hands with the outlawed Jamaat-e-Islami. Now, why is this election important? In a way, this election can be seen as a referendum on abrogation of Article 370 and also the BJP's policies and handling of law and order in the state over the last 10 years. All opposition parties have promised to restore statehood and special status if elected. The BJP has ruled out restoring Article 370 but promised to restore statehood at an appropriate time after the elections. Union Minister Amit Shah has urged voters in Jammu and Kashmir to vote against separatism and terrorism. Let's see what the people of Jammu and Kashmir decide in these polls.
A little while ago, I got a very nice call from Kamala. No, it was very nice. It was very nice. It was very, very nice, and we appreciate that.
To reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point.
Nikkei is trading with gains of over 2%. The rest of the markets are absolutely flat.
Markets essentially viewed the meeting with some degree of hawkishness.
They want to make sure that they keep it near full employment.
They've approved a new liquor policy which starts from the 1st of October for the next couple of years.
The Nifty closing in on 25,500. There we go. We actually had 25,500 for a bit.
I think what matters more than the quantum of whether this was 25 or 50 is why is the Fed cutting?
Our base case view that the US will go through a soft landing.
I'm genuinely surprised by the size of the rate cut.
No case has been made out for reconsidering the decision on AGR.
When I spoke seriously about the fair value of the stock, you seem to suggest I was speaking in jest.
Mid caps, which are sulking in trade today, a big cut there, though they have recovered from the lows.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal Studios in Mumbai.
Good afternoon and welcome to another edition of Closing Bell. I'm Surabhi Upadhyay. With me in the studios today is Mangalam Malu, and what we have is a very interesting market. And it's not often that we say this, Mangalam. India being a rank underperformer. Look at Asia, the way markets have reacted to that big bazooka 50 basis points rate cut. Asia has been all up and about. Europe is trading positive. Even US futures right now, for what it's worth, Nasdaq futures are up almost 2%. Dow, S&P 500, all futures are up. We've seen a bit of a pause, brakes being slammed, and some profit taking today.
I reckon it was also because of the kind of outperformance that we've seen in the past as well, right? So maybe the street is looking at free money coming in or money coming in at a lower price from the Fed and deploying it to markets other than India, which perhaps may not be as expensive as India is. Be that as it may, it could also be routine profit taking for our markets. It's a day of two halves. If you look at it from the highs, the Nifty is corrected about 200 odd points. We've had the mid-cap index take the sharpest knockdown, down almost 1,500 points from today's trading high as well, which is a record high. The Nifty Bank went within 4 points of a fresh record high, and from there as well, it saw a bit of a sell-off. So let's see how it pans out. What are you spotting in stocks? I reckon, 1,900 stocks on the obverse side as against 500, which are gaining a lot moving around.
Yeah, I mean, the bears have chosen quite a day to kind of come out and announce their presence, because otherwise, when global markets are rejoicing that US money seems to be getting cheaper with this rate cut. Anyway, for what it's worth, I mean, the Nifty, at least it's bounced back above the 25,400 level. That's one way of looking at it, because the lowest point was actually below that mark. So let's see what the next 1 hour brings. It's also Thursday, which means you have the weekly options expiry that will play out. So let's see if there's some sharp changes around 315. For what it's worth, a couple of stocks on the way up. There's a fair bit of a consumer play, both on FMCG, and if you're counting auto as consumer, then a bit of that as well. So NTPC, Lever, Maruti, Titan, Bajaj Auto, Tata Consumer, these are names on top. And had it not been for the Bank Nifty, I mean, despite all this, the Bank Nifty is still retaining a much better looking gain than the Nifty. And had it not been for the banks, then of course the picture for the Nifty would have been very, very different. So even now, Kotak, for instance, HDFC Bank, the big boys are still fighting for the bulls. Reliance, ITC, these stocks are still holding out in green. So let's see. I think it might be an interesting last 1 hour.
It'll be a very interesting last 1 hour. You said what a day that the bears have chosen to announce their presence. I say, what a week the bears have chosen to announce their presence, at least in the mid-cap end of things as well. Because, even if you look at the mid-cap index fall from days high, close to around 900 points lower right now, and the broader market's advanced decline ratio, those lines come up for you. It's the third day running where we have over 1,500 stocks on the NSE declining. And give or take everything this week, if you look at it, the Nifty is still up 0.2, 0.3%. So marginally in the green for this week. The banks are doing a lot better, of course, led by private sector banks. So the Nifty Bank is up 2%. The mid-cap and the small-cap indices, both of them down 2.5 to 3% this week itself. And that's at an index level. So a lot of stocks seeing a lot more pressure. I'll be interested to see how the Nifty Bank performs from here on. Is there a risk of A bit of a double top on the Nifty Bank. The previous high was 53,357. Today's high was 53,353. So those are a couple of factors that I'll be watching out for. And on the Nifty weekly options expiry itself, this afternoon the trade was the 25,500 straddle, which is a call and a put together. Now with the market having corrected from the highs, it's come down to 25,400. What's the premium on offer of the 25,400 call? 20 rupees. If you look at the 25,400 put as well, that comes up for you. The premium is close to around 10 rupees. So you sell both the 25,400 call and put. The range that you're playing for expiry will be 25,370 at the lower level, and on the way up 25,430. Do we stick in this narrow band, or do we break down or break out of it? Will be something that will determine the course of the next hour of trade.
Absolutely. So let's watch how this goes. By the way, I mean, just to name one or two stocks before we get to the strategies, some of the news-based stocks are seeing very sharp moves today, and you'll hear more about them in the program. So Vodafone Idea and Indus Towers, absolute slam dunk on these names, thanks to the fact that the Supreme Court is not looking at any sort of a relief now. It's dismissed that curative petition, and those stocks have seen a lot of price damage in the course of the afternoon. There's IIFL Finance, on which there's continued regulatory uncertainty, and Bloomberg put out a story saying that maybe some of the rating agencies could be cutting their rating on IIFL Finance, so that stock's under pressure. And more names, I mean, case in point would be Bajaj Housing. Fantastic listing, but now there is some caution and some money coming off the table. 7% down on Bajaj Finance as well. So it's just a glimpse into the kind of mid-cap correction that we're seeing today. So how should you be positioning yourself for the next 1 hour, the last 1 hour? We have Mitesh joining in as always. Mitesh, good afternoon. So yeah, it's not really played as per script for the bulls, at least not till now. What's your advice for the moment?
So, one, I think there were signs of market going into consolidation, but with the Fed event, I think the gap up was much bigger than what I had anticipated. And therefore, it was a bit surprising. But, I think as Mangalam was also highlighting, the Bank Nifty, which is the one which has been kind of index up for the last 5 sessions, was meeting its all-time high. The highest ever closing is about 53,100, and the highest is about 53,350 levels. And today we got a high of 53,353. So very clearly, it was a index which was carrying the weight of Nifty. It was an index which had rallied for 5-6 days, was overbought, was meeting the earlier highs. I think there was a good chance of profit booking happening. That is what has happened. It doesn't look like a kind of any kind of negative setup, but just I think a mild pullback to the hourly and 2-hourly averages could take place, and therefore the consolidation which I thought started yesterday appears to have started today. And I would still believe that till the Bank Nifty now breaks into fresh highs, I think you might see the markets go through 1 or 2 days of mild choppiness and some pullback. On the stock side, sorry. Go ahead. So having said that, on the stock side, the index, which is rallying is, the stocks which are rallying is ABFR, and I think, that's now close to its earlier highs. Very good pattern over here. Buy with a stop below levels of 327 and look for a target of 346, 347 to begin with. And on the sell side is ABB. Disclaimer that we have some put options positions, so there's vested interest, but ABB appears to have broken down the recent lows of 74.20, 74.50 zone, and now it's trading just around those levels. But I suspect the setup is negative, so sell here. Keep a stop above 75.20 and look for a target of around 7,200.
I want your thoughts on 2 stocks in particular. One is Pidilite. Pidilite ended lower in yesterday's trading session because crude prices were higher. Now it's seen that dip being bought. Pidilite currently has moved to the high point of trade. Consumer stocks generally are doing well today. That's one. And the other one is Jubilant FoodWorks. It's been in this, it's a sleeper hit. From its lows, it's rallied about 60%. And come what may, the stock continues to hold in the green, at least in the face of the choppiness that we're seeing in the markets over the last couple of weeks. At least we've seen some strength here in both Jubilant Food and Pidilite. Do you have a view?
So Mangalam, Jubilant is something which I've covered on the long-term chart basis. The stock has recovered and turned very, very positive on the long-term charts, and I suspect I'm looking at a target of around 780 to 800 over here, and eventually the highest ever monthly closing of 805. So that should be tested. So the 780, 805 is the target range for Jubilant. My only worry is that this is a 6 monthly candle which is on the positive side. So the stock in the short to medium term is very overbought. So here I would want to buy into it, but on a mild decline. I believe that 620, 630 range on the downside will hold. So any 20-30 point decline, I think the stock should be added gradually, and Eventually, I think in the next 4 or 5 months, it could possibly meet the earlier highs of 800 plus levels, and then we might even look at higher levels. Pidilite is something which has also had a good trading rally. In fact, if you look at all these stocks, the Pidilite, Asian Paints, in the last few weeks they've moved up generally, and Pidilite also made a high of 3,300 before now correcting to about 3230, 3220 levels. But the structure is positive. Keeping yesterday's low of 3160 as a reference point, I think the stock can be bought from a trading perspective around 3200 with a stop below 3160, and a retest of 3300 could be there, and possibly even higher levels could be tested. So positive on both, and would want to buy both on slightly lower levels.
Okay. All right. Got that, Mitesh. Thanks very much for it. Actually, in the mid-cap market, I'm just trying to spot winners. One pocket that's looking interesting is actually the snack makers. Gopal Snacks on a day like today about 6% higher. Pratap Snacks is actually moving higher now, about 3.5% on that stock as well. In the morning, Bikaji was up. Let's see if Bikaji is still retaining that gain. But quite interesting. So some of these names, I think maybe hunger stocks are in focus. So there's Alcobev, we'll talk about that as well, Mangalam. And then the snack makers not doing too bad today.
In economics, they say, there are products which are corollary products. If the price of X goes up, maybe the demand for Y goes
will also
down
go up.
as well. So Alcobev stocks, they're doing extremely well. So maybe snack stocks are
rising in tandem
positively for that as well. Because he was actually up 6% yesterday as well. This morning did well. So these stocks are doing well, but it's the Alcobev stocks which are doing a lot better in today's trading session. Don't have United Spirits and Radico Khetan's today's move, make you feel otherwise, largely because one, there has been an important development out here. What is that? The Andhra Pradesh cabinet has gone ahead and approved the new liquor policy. The new liquor policy was something that the street was widely anticipating. It starts from October 1, allows the retail sale of liquor by private players, basically putting into effect the rules that were there pre-2019, and price of select brands will also be brought down below that 99 rupees per quarter mark itself. How much can that move the needle by? For a company that has a fair amount of sales coming in from Andhra, something like Tilak Nagar Industries, they said that, if this is announced, then maybe for the next 5 years, they can see volumes compound by around 8 to 10%. We spoke to analysts as well, and they said that, this policy can grow volumes for 7 to 8% for the alcohol bev players, and FY26 itself could see 14 to 15% growth for beer and 10 to 12% growth for P&A spirits itself. The reason why the stocks are selling off today is because in anticipation of this news, they had seen a big rally, and the mid-cap index also is in a bit of a profit-taking mood itself. Before this news came by, Global Spirits was up 51%, Radico Khetan was up 33% in the month preceding this, United Spirits was up 10%. The only underperformer here was United Breweries. Yeah. And today, that's the one that is reacting most positively as well. So if you pull up, the intraday chart of United Breweries, you'd see that there is a big outperformance today as against the underperformance that we had seen in the last 1 month itself. So maybe sell on news for all the other stocks, and United Breweries, because it hadn't rallied, is now participating.
Absolutely. I remember that conversation we had with Karan Taurani as well. I mean, even he singled out this one stock as having the valuation comfort because it's not moved up, and probably better prospects in the second half of the year with beer consumption as something to keep in mind. And stocks up about 4% today. Well, let's take the conversation forward with Deven Choksi. He's joining in to discuss some fundamental ideas. Deven, so I don't know, Alcobev stocks or Namkeen, Bhujia, chips, do you like anything? I'm not talking about the products, but the companies in the stocks. Anything in your coverage, anything that's on your radar?
Good afternoon, Surbi. Alcohol I don't drink, so I can't say I like it. And snacks I do eat, but I think they're too expensive to buy. I guess but Deven, probably not as expensive as the market or the stocks, right? These days you can buy the product, but buying the manufacturer's stock is usually a problem because of market valuations. But anyway, let's talk about these. Let's talk about the names here and whether they make sense to you. Yeah, I think most of the items, which are listed market, they are expensively traded. And if you look at some of the names, I think their performance, the growth, I think that you see on a quarter-over-quarter basis or even for that matter year-over-year basis, I think the profit growth is not very consistent. I think that is what in general I come across, this particular pattern. And that's what I'm not fully clear about. Okay, I agree with one particular aspect that in current environment, the input costs likely to remain lower because most of the commodity prices
are likely to behave well in the current environment. If that is so, then certainly I think there is a good chance that these companies would probably have relatively better profit margin to talk about. As such, on the other side, the top line growth is not doubted because top line growth is related to the consumer's wallet and consumer is spending money. So from that perspective, most of the next stocks I think are likely to show top line performance far better. Bottom line performance will have to be validated with the current cost structure, which is like slightly more favorable at this point of time.
That point, Devin, thanks a lot for that. And you know, I speak on behalf of Devin as well. People like me and Devin are very dangerous for people who drink. Why is that? Because while we will not partner you in the alcohol, session, both of us are compulsive munchers of all the snacks that are there on the table. So while you can enjoy your drink, if there is bhujia, if there are any sort of namkeen, if there is any farsan, both Devin and I will finish it. We may not look like it, but we definitely are compulsive munchers out here. Devin, in particular, I wanted your thoughts on Bajaj Housing Finance. Why do I say that? Because, you know, you've been quite vocal about its valuation differential with all the others, etc. The last 2 days, the street has seen some sense or rationale in, booking some profits or the gains that we saw over the first 2 trading sessions of the stock itself. In the last 2 trading sessions, it's down about 10-12% odd. At what point does it become a little more attractive for you?
Yeah, so I think if you have to take, in perspective, the first 2 days of listing and now, in first 2 days of listing, probably a lot of grey market transaction had to come up for square up. Because maybe the market was not anticipating, grey market was not anticipating the kind of subscription that the company received. And as a result of which, the sellers committed themselves, which ultimately they had to short cover and probably pay it off. So that's where probably you saw a surge in the stock price. I think that's well explained here. But on the other side, the valuation-wise, the company remains far more expensive at this point of time. Even if you factor in 30% rate of CAGR growth in the loan book, you still find that the valuation 3 years from now is 3.5 times price to book value for the housing finance business in this case. I'm not worried about that particular 3.5 times price to book value, particularly when I see the company with the multiple revenue model stream that they have. On one side, they have got the mortgage-based revenue model. On the other side, developer finance model, lease discounting model, and loan against property model. Except the mortgage-based model, in rest of the models, they have a real good ability to command better price at the time of lending. And assuming that this company at 160 rupee price, they have to, suppose if they have to offload 3% of their stake in the company at this point of time, probably we are talking about around 4,000 crores of rupees that they would get. The serviceable cost of the equity is only on 10, balance 150 is non-serviceable. So to that extent, they can actually expand the NIM very fast. That's a good possibility for this company, and that's where this company deserves to get the premium valuation. But it is already priced in at 3.5 times price to book value. That is what I would like to put across. Definitely very comfortable buying into this company whenever the opportunity comes along from the investment point of view at a little lower price.
Okay, so well, that's a view on some of those names. Let's move to the other big story of the day, and that's coming in from the telecom space. Like we told you, stocks are reacting very, very sharply. And this happened after the Supreme Court pretty much delivered a blow to the hopes of telecom players with respect to any relief on the AGR dues and the way those dues are being calculated. So the Supreme Court has pretty much struck down that curative petition, saying that there's going to be no change in the adjusted gross revenue or the AGR dues. And all of those stocks have been down quite a bit. The companies had, of course, moved court with that curative petition, saying that there was an error in computation. Well, it was not upheld by the apex court. As you can see, the Bharti Airtel is, of course, reacting a little positively, and different dynamics at play here. Perhaps the market believing that Vodafone's further loss could be Bharti and Jio's gain. But the ones where the sharpest reaction is playing out is, of course, Vodafone Idea. And the other one is Indus Towers. Pull up Indus. It's been down 10% since that verdict came in. So what happens now, and what's the word on the street? Let's go across to Hormaz for more. Hormaz, plenty of price damage here.
Oh, well, it is. And it's even the case, right, for Vodafone Idea. It's not had a very good month whatsoever. And it's almost down 19% now, the biggest single day fall that the stock has seen since January of 2022. And as you mentioned, right, it was because this news came that the Supreme Court has dismissed that curative petition when it comes to the AGR dues. They had filed this petition saying that there has been an error in computation. But the Supreme Court said that they have not made any case for themselves, and hence these petitions are dismissed. Now, as of date, Vodafone Idea's current AGR dues are around 70,300 crore rupees. It's a massive sum for Vodafone Idea. And just in anticipation of this verdict from the Supreme Court, a lot of brokerages had pinned hopes that there might be some relief, and thereby leading to some bullish commentary on Vodafone Idea. And I have Citi had written a note on the 29th of August. They had mentioned that any potential relief can boost its stock price by 5 rupees a share. And even Balaji Subramaniam, who we spoke to after the verdict, had mentioned that if such a move would have transpired, then the Vodafone Idea share price could have received a 4 to 5 rupee boost as well. However, just a few days before this verdict, Goldman Sachs on the 6th of September had said that the fundraise that Vodafone Idea has done will not be enough to protect market share. They also said that their cash flow will remain negative until FY31, and as a result, they had a price target of 2.5 rupees. So it'll be interesting to see that these bullish calls that came in on Vodafone Idea in anticipation of this, what happens to that now when the news comes in tomorrow. As of now, there are 22 analysts who have coverage on the stock. 13 of them have a sell recommendation. 4 of them have a buy rating. Be interesting to see how the street reacts to it tomorrow, especially the sell side analysts. But for now, 20% down on Vodafone Idea stock, below its FPO price of 11 rupees, the biggest single day fall since January of 2022.
Absolutely, take that point, Hormaz. The biggest single day fall in a long time, also below the FPO price. In fact, from its 52-week high, which it had hit post the FPO had happened, closer to 19 odd rupees, the stock has now almost halved. Devin, how should one look at this? Because Vodafone always was fraught with a fair amount of risk, and one of those important risks has played out. Telecom, until Vodafone saw some signs of life, was just one clean player, that was Bharti Airtel. Then, of course, there was Reliance, but that had other parts of the business as well. What are your thoughts here? Does everyone else's loss result in one person's gain, or should you still look at Vodafone as a hopeful after the big correction that it's seen from the top?
Mangalam, for a while, I think if you just keep aside this 31,000 crore worth of erroneous calculation amount, I think for which the petition was filed, I think still the total amount of dues pertaining to dues pertaining to AGR is about 70-odd thousand crores for Vodafone Idea, and I think a total debt of around 12 or 40,000 crores. No doubt they have raised money through right issue, but still I think this is a large sum of money. On the other side, I think when I see the business strategy, I'm not at all sure. I think which have been earlier also expressing the same point. The 4G implementation, I think, which they are currently doing is probably yesterday. I think today is 5G reality and tomorrow is 6G. I think majority of the large operators, including Jio, including Bharti, have been preparing for the next level of 6G implementation going forward, and they have created the infrastructure ready for themselves. Today, Vodafone and BSNL kind of companies talking about 4G in order to just protect the customers, I think, which they otherwise lose out. I think I'm not getting that part clear, because the amount of money which will be required to spend, I think, for implementation of the next generation of network is going to be equally challenging. As I see it, I think next 5 to 6 years, I think Vodafone Idea, BSNL kind of companies would continuously demand cash for implementation of different projects and I think technology. So to that extent, I think I'm not convinced on the fundamentals of this particular company. They would be cash-hungry businesses. As against, I think the cash-producing business like Jio, which is producing about 60,000 crore worth of EBITDA. So one would like to stay with the business, I think, which is producing positive EBITDA, vis-a-vis, I think, the one which is not producing that EBITDA kind of a situation.
Okay. All right, Devin, we will leave it on that note for today. Thank you very much for joining in. You have a good rest of the afternoon. And we look forward to our next conversation. We need to take a break. On the other side, key excerpts coming up from our conversation with Jefferies' Mahesh Nadurkar.
Jammu and Kashmir is witnessing its first polls in the last 10 years, and lot has changed on the ground as historic polls because application of Article 370 has taken place, and also the fact that J&K has been divided into two union territories, which is Ladakh and Jammu and Kashmir. Around 23 plus lakh voters will exercise their franchise in the first phase, where around 219 candidates are going to these polls, and they are contesting and trying their luck. And there's a stiff competition that is going to take place. We are in Bijbehara constituency, where Iltija Mufti, Dr. Abeba Mufti, along with the NC candidate, is participating, and this is something which is seeing a larger participation of people. You'll see the voters are queued up out at this polling station in South Kashmir, and also that parts of Jammu are also witnessing these polls. 3 districts of Jammu, which has a tough competition, where BJP has fielded some candidates which are considered strong in those areas. But in Kashmir, there's an alliance between the National Conference and the Congress, and similarly, the PDP is going solo, while the BJP is aiming and trying to get its first seat in Kashmir, because they haven't been able to win any seats, so they're trying to get their first seat in the Kashmir region as well.
Investing.
There's a fresh bout of selling that we're seeing in the market right now. The Nifty is holding in the green with just about 32 odd points. The stocks which are falling from the highs, Apollo Hospital is currently at the lower end of today's trading range. We have Dr. Reddy's, which has come down lower as well. Bharti Airtel, which was doing well too, has come off the highs. Alongside that, we have ITC and Reliance, both of them weighing down on the Nifty. So making the last hour of trade extremely crucial to track. But on the sidelines of the third India Forum for Jefferies, Prashant caught up with Mahesh Nandurkar and started asking him about his views on the FII interest in India, especially in light of the recent purchases that they've been making. Let's hear that out.
We have more than 200 overseas investors, and that actually makes it the largest ever conference by any investment bank in terms of the number of foreign investors participating. At the same time, we also have 100 plus corporates as well, and very, very senior level representation, from the chairman and the founder level, and strong representation from the government ministers and other industry experts as well. So the feedback that we're getting from interacting with the investors is that, just the sheer numbers, first of all, tell you that there is a lot of interest. And we are seeing interest coming into India, not just from the traditional India dedicated funds or emerging market fund managers, but also global mandates as well. But clearly while the interest is at an extremely high level, at the same time there are some concerns around the valuation. So nobody denies the fact that the economic story, the corporate earnings growth story is looking very strong, and very strong on an absolute basis, very strong on a relative basis as well, because especially now with the expected slowdown in the US economy, the differential growth for India's GDP, the differential growth for Indian corporate sector EPS growth is looking even better. Okay. The key question is whether market is already factoring that in. And what has happened is, with a big surge of domestic liquidity, the foreign investors have been looking out for an opportunity to invest, and that opportunity has been denied to them so far.
Do they feel a little left out?
I think they do, because what has also happened is that the number of stocks in the benchmark, if you look at MSCI India, which is the very common benchmark followed by many foreign investors, 5 years ago we had about 75, 78 stocks. Today that number is more than 150. Which means about 70 stocks have got added into the benchmark. These are all new companies across infrastructure, manufacturing, digital economy, and so on. And many of these companies and the sectors themselves, in many cases, are not well understood by many of the foreign investors. So, on one hand, you had an issue of valuations going up because of the strong domestic liquidity, and on the other hand, inclusion of several new stocks into the benchmark, which have actually outperformed the benchmark, where the foreign investors did not have enough familiarity with the sectors, with the company management, with the style of working, etc. So that has prevented them from taking active positions in many of these names. So yes, to that extent, there is that feeling of missing out.
And it kind of ties in with the point which I was talking to Chris earlier, and he was saying that if people who are foreigners who are very familiar with India, they are still okay with what's going on and the kind of surge we're seeing. But generalist FIIs at the margin who are not very familiar, valuations and what's been happening is a bit more of an issue for them. So they're staying away. I think you're echoing that in that sense, right?
True, absolutely. I think one of the biggest change which has happened in the Indian economy is the turnaround of the investment cycle. So the fixed capital formation as a share of GDP has been consistently falling from 2010 down to 2020. And at that time, a very narrow set of high quality stocks did exceedingly well. And many investors actually did very well by being positioned in those narrow set of very high quality stocks, and the multiples for many of the stocks went through the roof. But the turnaround in the investment cycle, which basically talks about the improvement in the risk appetite in the Indian economy, not in the markets, the Indian economy. The risk appetite in the Indian economy has gone up quite a lot over the last 2-3 years, with more investments in infrastructure and manufacturing, in real estate, in power and so on. Those have been neglected sectors. And so I think what we've been highlighting is exactly this big change of trend, which has a huge implication for sector and stock selection. And so my sense is that as more foreign investors take into their stride what has changed in India or what is changing in India, I believe the leadership in terms of the sector and the stocks will be very different over the next 10 years as compared to the last 10 years. A point that I've been making for some time, but it still has long legs.
And they got to get familiar real quick, right? Because otherwise they get elbowed out very fast. Because this surge of domestic money leaves little room in that sense. So
absolutely,
and that's been a problem, I guess, for a lot of locals as well, local and domestic institutional investors as well.
Yes.
Mahesh, so two things. What are they most excited about for large foreign investors? What is the worry, if there is one, that you picked up?
I think the single biggest worry is still on the valuation side, as we just discussed, and whether as I said the good news is already factored in. But outside of that, there is also some worry about the recent sort of election mandates and what kind of impact that it has on the capex activities, the government's investment plans going forward. We've already seen some changes at the state government level in terms of the policy making, and we've seen that there has been more sort of social spending and
a lot of handouts across.
A lot of handouts, it's been happening. So there is that worry that whether the similar things can happen at the central government level as well, and then what kind of impact that it can have on this. I talked about this turnaround in the investment cycle, whether that gets stymied by that. But thankfully, we had a few very senior ministers, at the conference, and they clearly allayed, those concerns. But actually, I would go one step ahead and actually highlight that one of the biggest misconception, I would say, in the Indian market today is that it's the government spending which is driving capex, and the private sector is lagging behind. Actually, that's a big misconception, in my view, because barring just one or two sectors like refining and petrochemicals, all other sectors are already seeing heavy investment from the private sector, be it steel or cement or infrastructure sectors like power and like telecom and airports and seaports and so on. And if you look at even the hard macro data, that shows you that like last year, the private corporate capex growth was up 18%. Household capex growth, which is in housing sector, which is real estate, was also up 18 to 20%. That's already there. Also, more bottom-up data like the ones reported by RBI recently, wherein they have taken together the private projects approved by banks for funding. They have not, the loan disbursals haven't happened as yet. The loans approved. And if you look at that trend, it already shows a 20% CAGR between FY19. I'm not talking FY20 because that was a low base.
Right.
If you look at the pre-COVID year, from there also it has grown 20%. So I think the common perception that private sector spending is lagging and therefore everything depends on the government, and if they slow down, what happens? I think that sort of conception.
In that sense, the fire has been lit, the spark is there, and it's going to be self-sustaining cycle.
Absolutely.
And perhaps it will last for some time, right? I mean, we are...
Yeah, so these cycles are usually 8 to 10 year cycles.
Right.
So broadly speaking, I say that 2000 to 2010 was an up cycle, 2010 to 20 was a down cycle, 21 was the turnaround. And I think, if we just go by the sheer history, and I'm not going by sheer history, there are other numbers as well, but I think this cycle should last till 2030, if not longer.
Okay. So, sectorally speaking, you were very bullish on real estate as a space, capital goods, industrials, etc. for the last many years. They've done very well.
Yeah.
But you've turned a little bit now, right? A little more. Is it just tactically turning a little cautious, or is it a more fundamental change in view?
Yeah, no.
Because stocks have run up quite a bit. Go on.
Yeah, stocks have run up. So yeah, this shift is a bit more tactical. So as I mentioned, these cycles are long, and we are somewhere in the initial or maybe the mid stages of cycle in some of these sectors, if you look at it. So I still a firm believer that the real estate cycle, the infra, the capex, the manufacturing cycle will go until 2030, if not longer. Why I'm saying if not longer, because this time the regulators have also are also acting, the government sort of policies are also acting in a very prudent manner. They're actually learning from the mistakes that we did in the previous cycle.
Sure.
Ideally, the goal of the policymakers is to avoid this boom-bust cycle. So we have a sustained but a longer-term upcycle. So yeah, so to answer your question, still very, very optimistic on the real estate and the infra capex cycle. But at some of the stock level, I believe given the huge surge of domestic liquidity has taken the valuations in some of these stocks or some of these sectors to a higher level. And I'm not just commenting on the valuations, actually I'm just commenting on the quantum of the flows that are coming in. And while I've been a big bull on this whole financialization of savings and the equity culture emergence in the Indian households, but I think some of the numbers have gone up in a big way, and I think maybe to an extent gone to a level which I feel are unsustainably high from the flows perspective. So therefore we have taken some money off the table on some of these infra capex real estate names, but as I said, it's a tactical view. The fundamental view still remains bullish from a long-term perspective.
So Jefferies is not altering its call, still remains quite favorably disposed towards capex plays and real estate among some of their preferred sectors. We'll take a break on that note, come back on the other side, and of course all the latest buzz from dealing rooms today. We'll be joined by Nimesh, and then of course some trading calls coming up with Mintesh Thakur as well. Welcome back. So we still have 20 minutes to go. The markets managed to hold on to a little bit of the gain on the Nifty. So at least that fall hasn't accentuated. Basically, 30 to 40 point up move on the index. We have Nimesh joining in. Nimesh, so the big day is finally over. The Fed reaction has played out. Excuse me. And a fair amount of underperformance here in India.
Oh, absolutely. Surbhi, looks like it's a clear day of sell-on news. We saw that happening in the US markets last night, and that's playing out in India as well. The big Fed event seems to be out of the way now. It came as a bit of a surprise, 50 basis points, but it's done now. So I guess that's the reason why you're seeing a bit of profit booking as well. While the Nifty is holding on, thanks to some sector rotation, it's the broader markets which are under pressure today. And I was talking to some larger investors, and there was an interesting feedback that I picked up. If you look at today's market as well, it's largely dragged by telecom names because of that Supreme Court shocker and the PSUs. What on PSUs, Surbhi, clearly, the leader of this bull market was the PSUs, and that seems to be under pressure now. And maybe that is why you're seeing a bit of underperformance in the broader market stocks as well. So, for a while, there was a lot of feedback from investors that maybe a time has come for the large caps to outperform mid caps. Maybe today is the first, confirmation of the same, that from here on, maybe for the time being, you will see a bit of outperformance in the Nifty. And that's also because of some bit of rotation will happen. So yesterday we saw banks participating. Today we are seeing FMCG and consumer names participating on the upside. So I guess that's likely to be the trend. From a flow perspective, again, it's a mixed day. I'm not hearing very large selling, but you might see a big sell number largely because of two pockets. One is telecom, which was little overbought from institutions of late, and of course the PSUs as well. So that's the pain point in today's market. But it looks like it's a first sign of a reversal in trend, wherein the broader markets underperform, and you see a bit of outperformance in the Nifty to continue.
It's so interesting, Nimesh, that up until now everyone was saying the PSU basket is overbought. There is a bit of a frenzy out there, etc., and that large caps have some value on offer. But when that switch happens, when it starts to see, when the market starts to see that what was being told already, people suddenly still get scared once again. That's the way the market works. What are the individual stocks that you're watching?
Well, so as I said, there is a bit of sector rotation happening, and within that, the first name in my list is Nestle. For second day running, that stock is relatively outperforming. Even in today's weak market, it's up 2%. The delivery is on a higher side, and I understand some domestic mutual funds, especially one large mutual fund, has done an active buyer in Nestle of late, and hence a bit of outperformance there. So that's the first name. The second stock is Vanberry, a small stock, but in a weak market like today, that's relatively outperforming. Last I checked, it was up 5%. The volumes are slightly on the better side, and I understand the company is likely to raise funds, preferably through a pref issue, is a buzz as far as Vanberry is concerned. The third name is Bandhan Bank. While there was high delivery marked for larger banks like ICICI Bank and Kotak Bank in the last few days, Bandhan Bank stands out today on back of very strong buy flows. So expect high delivery volumes, and there is a very high FI buying happening in Bandhan Bank at these levels. And the last name is Oracle Finance. For second day running, that stock is under pressure. The stock is already in F&O ban. We saw a 10% cut yesterday, 4.5% cut today as well. But at these levels, some bit of cash buying has started in Oracle from larger FIs. So it looks like some institutional activity on the cash side has started in Oracle Finance.
Right, Nimesh, thanks a lot for that. So those were a bunch of stocks which Nimesh has picked it bits on, and the dealing room set up as well. Good time to get in Mitesh for the reverse trade tomorrow. Mitesh, what is the tomorrow trade? Is it more short or is it on the long side?
I have in fact long ideas, though during the day we had some short calls as well. ICICI GI after a pullback seems to be recovering well. So BTST here with a stop at 2184 for targets of 2230. And Max Health is something which I would recommend as a short-term trading buy. Keep a stop below levels of 960 and look for targets of 1045.
When you say ICICI GI, you mean the general insurance business, right?
That's right. That's right.
Perfect. So we'll just flash that on the screen for you. And Max Health, you just pointed that out. It's a big up move that we're seeing on the stock. In fact, it's currently seen a bit of a spike as we speak as well. But let's move on. One of the stocks which is surging right now is Spencer's Retail. It's up 11%, and most of the gains have happened in just the last couple of minutes or so, and decent volumes out there as well. All the other RP Sanjeev Goenka owned group companies are buzzing around. The BPM service provider First Source has announced an expansion in the Australian market as well. The company will set up a new headquarter in Melbourne. Speaking to CNBC TV18, Sanjeev Goenka says that he remains steadfast on his target to increase first source profits by 2.5 times in the next 3 years and margins by 3% as well. He hints that the company could announce an important overseas acquisition soon as well. This is something we'll keep an eye out on. Listen to that conversation. We'll step into a short break, come back, and thereafter talk about the market closing.
First Source has been, over the last few years, we've been reinventing ourselves such that we can earn the right to grow. And having progressed significantly on that journey of having earned or earning the right to grow, we are now growing. US, UK, and we do believe the third major international market for us could be Australia. It's a beginning. We are enthused by what the state of Victoria offers. We are enthused by the fact that they have some large corporate presence there, and we do believe that we can make a difference in the offering that we make to companies there.
Right. Now, First Source has been bringing digital transformation solutions to companies across the board for many years now. What's going to be the quantum of your investment when you're setting up this base or your headquarters in Melbourne?
In this industry, when you talk of investments, you talk of FTEs. So you don't really talk of $1 million per se, but you talk of FTEs. So we begin small. We begin with about 300 to 500 FTEs, but we'll grow and we'll ramp it up very rapidly.
Okay, so there's a plan to increase growth and investments rapidly. But why Australia, if we were to ask you? Why did you choose this as your next destination for growth?
There are many corporates who are headquartered in Australia, and we do believe that's an opportunity that exists. It's an opportunity to be grabbed, and you don't have too many major service providers there.
Okay. Now, in terms of the jobs that are getting created, one, onshore in Australia, and does this also help you increase the flow of employees from India to Australia? How many jobs could it create in Australia, and how many jobs from the Indian market?
Typically, onshore-offshore ratios would be 1:3. And so for every job that's created in Australia, you'd expect to see 3 in India.
Right. And what will be the focus of First Source's business and expansion plans in Australia right now? You have been saying that AI and generative AI is the big priority for you right now. So can we expect First Source to work in that direction with clients in Australia?
Definitely. Definitely, and we do believe we will work on our strengths, on the basic sectors that we operate in, where we excel in. Those are the sectors that we will like to take our experiences from other countries to Australia.
Right. What kind of growth are you expecting in the Australian market? You've already been present in US and UK. How significantly do you expect Australia to contribute to First Source's business in the coming years?
I think over a period of time, we do expect Australia to become a significant contributor. The last quarter, First Source gave the highest growth in revenue terms for the industry, and which we've never had in the past. So it just proves that we are growing faster than the industry. Whether we will continue to be the fastest or not, I don't know, but we will continue to be amongst the fastest growth rate companies in the sector.
Right. Any acquisitions that are on the cards for First Source?
Inorganic growth is a way of life, as much as organic growth is. And as we speak, there are different conversations going on with different companies. So fingers crossed, hopefully soon.
Okay, maybe we can nudge you a little more. Is it going to be in the AI space?
Just wait.
Okay.
Just wait. Hopefully soon.
Hopefully soon. All right. If we were to ask you about within different business solutions that you're offering right now, which ones are you most bullish about, or you expect the company to focus on in the greatest possible manner over the next few years?
You know, we do...
The number one priority, maybe.
I don't think I'm going to single out just one priority. I mean, if I had to take one objective for FirstSource, it would be a growth in margins and a growth in revenues. We do expect margins to grow by 3% over the next few years, and that's our target. And that's what we are working on very, very consciously. And to have significant growth in our revenues organically plus inorganically.
We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond.
People of Jammu and Kashmir are voting for the first time in an assembly election in 10 years. This is also the first assembly election in Jammu and Kashmir since the abrogation of Article 370 in 2019, which gave the erstwhile state special status. A total of 9 million citizens are eligible to vote in this election for 90 assembly seats. In the 2014 election in unified Jammu and Kashmir, Mufti Mohammad Saeed-led Jammu and Kashmir People's Democratic Party had won 28 seats, which was the highest number of seats won, but fell short of the majority.
Welcome back. Spencer's Retail, the stock is up 10%. We were talking about it. We understand that, the commentary that has come in on Spencer's Retail from Sanjeev Goenka to an interview on money control itself. He suggests that they are likely to break even by March itself. And also, they've too have announced their foray into quick commerce with 30-minute deliveries. And 30-minute deliveries is something that, a lot of these other players are looking at as well. And that's caused a bit of a flutter among all the retail players too. So look at Avenue Supermarts. That too has recovered about 4% from lows, currently moved to the high point of trade. So just keep an eye out on, legacy incumbent retailers, brick and mortar retailers, looking to up their ante with 30-minute to 2-hour deliveries as well, and some of them even giving express deliveries at no delivery cost attached. So as a result of which, we are seeing these stocks gain some traction. Amrish Baliga joins us now. Amrish, do you track Spencer's? What are your thoughts on Spencer's at current levels?
No, in fact, I don't track it closely, but the sort of news which is coming out as far as this quick delivery is concerned, I think that's positive. And the other thing is about the profitability, which Mr. Goenka talked about. I think both these are positive, because of which, even in a market like this, we have seen the stock moving up. But then I think this will be only sentimental. I mean, until we really start seeing that in black and white, I don't think we can see a major up move. But then, yes, temporarily, yes, I think you can see possibly a bit more due to the momentum.
Okay, got that. Amrish, hi, good afternoon. Day of correction for the for the broader markets. But, if you talk about the large cap space, one stock that's done really well, unlike a lot of its other PSU peers, is actually NTPC. I guess the market's getting excited about this renewables IPO, right? Anything green, it has a right word, the right sound, with the market lapping up these ideas. What's your sense, I mean, on the base business itself and how you would look at the renewable side of it?
In fact, I've been liking NTPC for a while, especially because of the sort of a focus which they have on green energy, and because of which, I mean, I also have a pick today, which is from a similar space, which is SJVN. I mean, it's been recently been declared a Navratna company. Like I said, basically renewable power. I mean, they have about 12 projects, which works out about 2,500 megawatts and 2 transmission lines in operation. And a decently large expansion plan is underway. In fact, they have 4 hydro projects of about 1,500 megawatts, 1 thermal of 1,320 megawatts, and about 11 solar power projects of close to about 2,000 megawatts. And if you see in the next 2 to 3 years, SJVN's capacity will go up from 2,500 megawatts, which was as of FY24, to 10,000 megawatts, which is 4x the FY24 capacity. And if you look at the longer term plans which they have, they're talking about 25,000 megawatts by 2030, about 50,000 megawatts by 2040. So this can be a long-term multi-bagger story. But then if you're talking of the next year or two, I mean, again, we can expect their subsidiary, which is a green energy arm, to come out with an IPO, just like what NTPC has recently announced. So FY26, I mean, I expect the revenues to grow by about 3x compared to FY24, and EPS projected is about 8 rupees. So my target for SJVN is 160. And as far as NTPC is concerned, I mean, there my target is about 480, 490.
Right. Just before we, head to close, a quick word on Gillette, if you track that, because, that stock was holding up in the green for most part of today's trading session. They held an analyst meet yesterday speaking about long growth, levers for the company, including premiumization and the female products, which are doing extremely well for them as well, which now contribute in double digits to their grooming range.
Yeah, but then see, unlike in the past, I think there is a decent amount of competition which is coming up from some of the existing players. You have those new boys on the block. So, I mean, I really don't think that the sort of premiumization which they had in the past and they could get that valuation, I don't think that will happen going ahead. So, I'll really not buy into the story at this point of time. In fact, if it moves up because of this, it could be possibly a selling opportunity for those who've been holding for a long time.
Okay, all right, got that. Amrish, thanks very much. Shorter chat today, but appreciate you being with us and giving us some perspective. We are winding down the day, and the day is going to end with a gain which is a lot lower, a lot lesser, a fraction of how we started. I mean, the opening gap was almost 200 points up, and now we're going to go home with just about a 70-point move. Nonetheless, it's not as bad as the lowest point of the day, so that's something to kind of hold on to. Talk about the large cap screen on the upside, NTPC, the stock that we were just discussing, and banks have really ensured that there's no wider decline. Bank Nifty itself is up about 0.6%, one of the best performing indices of the day. And if you look at some of the constituents, Kotak Mahindra Bank, HDFC Bank, there's a fair amount of green out here. Then you had, of course, a lot of consumer stocks to thank for the fact that we're still closing in green. Nestle, Tata Consumer, HUL, even ITC, last I checked, still up about just about 0.25%. Some of these names on the positive side as well. Maruti, Bharti Airtel, Bajaj Auto, these are some of the auto names which have had a good day, even Tata Motors for that matter. So auto and consumer, two good parts of the market along with banks. What didn't work? PSU, and more PSU. So BPCL, ONGC, Coal India, a lot of these stocks were lower. And even IT, second day running, I mean, in the morning, these stocks were looking okay. But by the afternoon, by the close, we have a cut of about 0.5% to about 1.5%, depending on which stock you're looking at. TCS being down a whole 1%.
Well, for the mid-cap index, it ended lower, but you can say it ended down, but not quite out, because from the highs of the day, it corrected about 750 points. From the lows of the day, it actually recovered about 1,100 points as well. So there was more recovery than decline from the lows, and that's something that the street would take note of. The Nifty as well, the expiry happened right in the range that the option writers were positioned for as well. Among the top losers on the mid-cap end of things were Vodafone, Idea and Indus Tower. Of course, the Supreme Court news not helping the cause of these telecom players. Then you had Chambal Fertilizers down about 8% as well. And then we did see some decline in a couple of these PSU names like Hindustan Aeronautics, etc. On the way up, the big gainers in the F&O space in particular were United Breweries, the Andhra liquor policy aiding their cause. We also saw some traction in Jubilant Foodworks, which ended about 3% higher. AU Small Finance Bank, and then a couple of these mid-cap ITs actually outperformed the large-cap ITs as well. And that was the word that came in from someone like Nilesh Shah as well, who said that mid-cap IT is a better place than large-cap IT. So First Source and Persistent Systems. Of course, we heard from Sanjeev Goenka on First Source. Then from the absolute broad markets, the small cap indices, we had big gains coming in these snack makers, Gopal Snacks, we had Pratap Snacks doing well. Spencer's Retail also on the QCOM foray did well. But on the way down, we had Bajaj Housing Finance down about 7.5% down for the second day running. And also PN Gadgil, after the stellar listing that we saw in the earlier part of the week, the stock ended about 8% lower today and off its 52-week high, down 16%. All in all, a weak session for the mid-cap index, which continues, but not as weak as the lowest point of the day would suggest.
Okay, and with that, it's curtains on this edition of Closing Bell. Many thanks for being with us. But to see you just after this small break. Markets Forward coming up next.
Sensex and Nifty hit record highs in intraday trade after the US cut rates by 50 basis points, but both indices gave up some gains in late trade. Mid-caps continued to underperform.
The Supreme Court rejects pleas filed by Vodafone Idea and Bharti Airtel for recomputation of AGR dues. The move is a big blow for cash-strapped Vodafone Idea, which will now find it perhaps tougher to compete with its stronger peers.
Andhra Pradesh's new liquor policy gives a boost to liquor makers by facilitating retail sales by private players. The move is seen boosting volumes in the high consumption market. It was a day of two halves. First one, the joy coming in from the Fed's 50 basis points rate cut, and thereafter some bit of profit taking and cold towel treatment for the markets. You're watching us here on a fresh edition of Markets Forward, your go-to show where we aim to get you all the key data points to gear up for the next trading day. I'm Manglam Malu, with me Surbhi Upadhyay. Hi Surbhi.
Hi Manglam, that's a nice description, the cold towel treatment, right, for what was a very hot, highly anticipated move, that 50 basis points rate cut. Well, we have a lot to cover as we go over the next 20 minutes, and we'll start, of course, with the market action because that big event is finally out of the way. It did end with that 50 basis points rate cut, but guess what? India has really underperformed, a lot of major global markets today. So let's just start by taking a look at the market action. What we had at the open was about a 180-point gap up. What we had by close was just about a 50-60 point move on the Nifty. But actually, that's not too bad because intraday, the Nifty had slipped even below the 25,400 level. It was a lot of firefighting that came in from a lot of the frontline FMCG stocks, from a lot of banks. Actually, the Bank Nifty was doing very well today, along with some autos. Because of these sectors, we didn't see a wider fall. But on the other side, IT, for instance, didn't quite perform as per script. And there was a lot of profit taking on the PSU side of the market. All the large PSUs, even the mid-sized PSUs, they were down and out, in quite a fashion. But Manglam, I guess the bigger, standout, noticeable move today was in the mid-cap space with a fair amount of red.
Absolutely, there was a serious amount of red. In fact, for this week itself, the mid-cap index is down about 2.5%, taking today's downtick into account as well. The small-cap index itself was down about 3.5% for the week as well. For the fourth trading session in a row, the broader markets have seen more decliners than advancers. In fact, if I remember correctly, between 1,500 to 1,700 stocks have declined on a daily basis for the last 3 or 4 trading sessions on the trot. So you have, the crisscross lines coming up. They opened with a fair amount of criss. Thereafter, there was a cross. And now we have more stocks in the red than the number of stocks which were in the green today. But having said all of that, the market did respect important levels. 25,415 is where the Nifty's final close was. The street was positioned for the Nifty weekly options expiry. Mind you, today was that day as well where we had the weekly options expiry. The street positioned itself for a 20-point range around that 25,400 mark itself, and the market respected that. The Nifty Bank conquered that 53,000 mark, went way above that within 4 points of a fresh record high, and thereafter saw a bit of a correction from the top, still held on to close above that 53,000 mark. So that's a positive. And the mid-cap index too, at one point was down almost 1,600 points from the highs, but from the lows, it did see a recovery. As the intraday chart tells you, towards the end, there were some people who were still believing that this is just routine profit taking, and perhaps thereafter pulled in some long positions as well.
Absolutely. So I guess down but not out. And given that while we were trading, US futures also turned positive. Let's see if indeed we have a positive close on Wall Street tonight, if the US market can finally make up its mind about whether this is a good rate cut or a bad rate cut. And
just to add one more point, yesterday before we went into the Fed event, we had the India VIX which spiked to levels of 13.5. As we closed today, the India VIX fell below that 13 mark. We fell about 6 percentage points lower as well. And that's a positive because, key events are out of the way. The market, despite the volatility that we saw, did not show it in the India VIX or the volatility index.
Absolutely. So I think, a day of digesting this big news, this big event, maybe we get back to the usual sort of print from tomorrow. So let's tell you what the lineup on the show is like. We'll, of course, get you all the key movers and shakers of the day, all the stock-specific action with Hormuz in just a bit. Stocks in focus include Vodafone Idea, Indus Towers and NTPC. We'll tell you why a lot of these stocks were buzzing. Also, along with them, a fair amount of the Alco-Bev names like Tilak Nagar Industries, they were on the radar. So we'll tell you more about all of these stocks and the reasons behind those moves in just a bit. And then the events to watch tomorrow as well. But first up, today's movers and shakers. Hormuz, over to you.
Well, there was some bit of profit booking, recovery from the lows, but the eventual tick in the broader markets at least was in the red. And can't not talk about Vodafone Idea, which sprung out of nowhere and suddenly became the stock of the day. 20% lower, closing below its FPO price as well, the biggest single day drop since January of 2022. And that has has now had a cascading effect on Indus Towers as well. At one point, the stock was down 14%, but that saw some recovery from the lows of the day, eventually ending 9% lower. All these Alcobev stocks, as you mentioned, some of them did well, some of them didn't do very well, and Radico Khaitan was one of them. But some profit booking because the stock already in anticipation of this had rallied close to 30% in a month. What continues to rally though is Neogen Chemicals, and that was up in an otherwise weak broader market, 15% higher today. Now the stock has risen almost 40% in the last 6 trading sessions. The index, the sector under pressure though was PSUs. Profit booking continuing there. Almost all, barring NTPC, almost all the PSE index constituents ending lower, anywhere between 3 to 5%. Fertilizer stocks also saw some selling in today's session. Almost every other fertilizer name also seeing losses of anywhere between 3 to 8%, with Chambal leading the losses there. And lastly, some stocks that were bucking the trend in today's session in an otherwise weak market. KPR Mills was one of them. Asahi India and PB Fintech ending almost at the highest point of the stock has now almost doubled from its IPO price. Back to you guys.
Right, take that point, Hormaz. Trust you to pull out some unusual movers in trade as well, along with the usual suspects. There were a lot of them, as you pointed out as well. So let's welcome, Amrish Baliga and Shilpa Raut, our experts for the day. Amrish, of course, independent market expert. Shilpa Raut joins in from Prabhudas Leeladhar. Gentlemen and lady, we start with Shilpa first. Technically, what did you make of the market move today, and where do you think it's headed from here?
Manglam, I believe, it was on expected lines. We had the target of 25,300, 25,500, 600. So this range has already, it's already done and dusted. So some sort of profit booking after the event yesterday was, well on cards, but it is a happy ending for the market as of today because the levels are respected, the gains are protected. So I believe even from here, if we continue to hold these levels, so levels of 25,800 to 26,000 for Nifty, and likewise Bank Nifty, if we hold 52,800, 54,000 should be the next target.
Okay, all right. Got that. Shilpa, stay on. We'll come back to you for some more questions. Let's straight away get to the first major stock of the day, and that, as Hormaz just told us, has to be what else but a Vodafone Idea. Now, the big blow came in from the Supreme Court because the Apex Court rejected some of these companies' curative petition, which was filed with the company saying that there was a calculation error made by the government in calculating AGR dues, adjusted gross revenue dues. Now, the reason why Vodafone fell off so substantially was that the market was hoping that this review will give a relief, at least a part relief on its dues to the company, but that is not to be. Hormaz, back to you. Then what does it mean for the stock? What's the word out there?
Well, it'll be interesting to see what comes out from the sell side tomorrow morning when they come out with their reports on Vodafone Idea. But as you mentioned, it was a big blow for them compared to the other operators like Bharti Airtel or Reliance Jio. The Supreme Court dismissing the petitions. As you mentioned, again, the AGR dues currently standing at over 70,300 crore rupees for Vodafone Idea. But in anticipation of this verdict, a lot of these brokerages had come out with some optimistic notes on Vodafone Idea. Citi was one of them, and they said that although Vodafone Idea is a high-risk, high-reward stock, but any potential relief on this aspect could boost its stock price by as much as 5 rupees a share on the upside. And even we spoke to Balaji Subramaniam of IIFL Securities after the verdict, and even he mentioned that if there was a relief, it could have boosted Vodafone Idea stock price by 4 to 5 rupees a share. But not everybody was bullish on Vodafone Idea ahead of this. Goldman Sachs had come out with a note last week. They mentioned that their fundraising that they have done is not enough to protect the loss in market share. Their free cash flow is likely to remain negative until FY31, and they had a 2.5 rupee price target on Vodafone Idea. Remember, it was this note that had started the downfall in the Vodafone Idea stock price a couple of weeks back. So as of now, 22 analysts have coverage on Vodafone Idea. 13 of them have a sell recommendation and only 4 of them have a buy rating. It remains to be seen what comes out of this, whether there are any more downgrades that are in store for Vodafone Idea. But as of now, the biggest single day fall since January 2022 for Vodafone Idea.
All right, that's on Vodafone. Amrish, your thoughts, telecom, is it a one-horse race now? Because Vodafone seems to have, fallen off the cliff, almost halved from its recent highs. And as a result of which, even Indus Towers, which was becoming an investment bet because Vodafone was seeing better prospects, has fallen about 8-9%. Your thoughts here?
Well, that's true. I mean, if you look at the judgment which has come today, is clearly negative for Vodafone as compared to Bharti because, they still have those deep pockets. The question which comes to everyone's mind right now is the survival of Vodafone. But then, if we look at a slightly broader, from a broader angle, would the government want only two major players in the telecom sector, or they would still need to have the third player? Which was sort of a story which was there in the last couple of years, and I still believe that the government would like to have the third player, who may not be too strong, but still is there to provide some competition. So if we go with that theory, yes, I think there could be something worked out going ahead to ensure that a Vodafone idea survives. What we have seen in the past 3 to 4 years. So keeping that in mind, possibly. There may not be too much more downside from here. Surely I don't go with the Goldman Sachs view that the stock will fall to 2.5 rupees. Possibly we could see levels of 8, 9, but may not be too much below that. Because after having poured in, a decent amount of money from the promoters as well as the other shareholders, I think they will still try and raise some funds. There could be some SOPs coming from the government to ensure that the company survives. And clearly, I don't think the government would like to, kill the hen which, lays golden eggs. I'm talking of the sector overall, the telecom sector.
Okay, got it. So that's a view on Vodafone idea coming through. Let's move on to the other big story. Now, Andhra Pradesh's new liquor policy gave a boost to some of the liquor stocks today by facilitating retail sales by private players. But you'd say if you check these were stocks actually down. You look at some of the other names like United Breweries, that was a stock that was reacting very well. Tilak Nagar Industries was reacting well. On a down day, some of these stocks managed a bit of green. So what's the story here and what's the potential gain, Mangalam?
The big story here is that the Andhra government, the Andhra cabinet has finally approved a new excise policy, and this comes into effect from October 1 for the next couple of years. This was anticipated by the street, and as a result of which, ahead of this news coming by itself, a lot of these stocks had seen a rally, and that explains why the sell-on news played out today. What does this do? This allows private retailers to go ahead and, or alcohol retail to be facilitated by private retailers, and also the price of select brands would be brought down to 99 rupees a quarter, so that aids the mass brands for a lot of companies as well. We had earlier spoken to a larger player out here, which was Tilak Nagar Industries, said that this could increase their volumes or compound their volumes by about 8 to 10% over the next couple of years. And analysts as well, concur with that view, 7 to 8% sort of volume growth for Alcobev players. To just drive home the point of the profit booking and the run-up ahead of that, you look at the last 1 month chart of, say, something like a USL, which was up 10%, saw some profit taking today. It was a mild profit taking because the run-up was just about 10%. If you look at something like Tilak Nagar Industries, you look at Radico Khaitan, you look at Global Spirits, all of them were up anywhere between 30 to 50% over the last 1 month itself. So maybe some profit taking wouldn't have been ruled out, but because Tilak Nagar gets nearly 30% of its sales from Andhra, was still a mover on the way up, and United Breweries were the top gainer largely because it had underperformed all its other peers in the past 1 month or so.
Absolutely. Even that stock was in sharp focus today, and it managed green on a day where there was a lot of profit taking going on in the mid-cap market. Let's quickly go back to our guests for a view on this. Amarish, Alcobev stocks, any preferences for you?
The day of the election, it was, very clear that over the next couple of months, we will have, a revised policy as far as liquor is concerned in Andhra. So, based on that, we had seen a decent move in most of the stocks, which are basically would benefit from the Andhra policy. And they are clearly Allied Blenders, Radico Khaitan, Tilak Nagar, and to some extent, United Spirits, because again, here we are talking of the lower end of the of the products. But then since it's announced today, I think we have seen some sort of a correction. But then overall, I would say it's quite beneficial, especially for Tilak Nagar and then for Allied Blenders. All right.
Thank you for that, Amrish. Let's get to another stock of the day. It was the top Nifty gainer today. NTPC gained over 2% after CNBC-TV18's newsbreak was confirmed. Their green subsidiary, which is green energy subsidiary, NTPC Green Energy, has filed its papers for the IPO, resulting in potential value unlocking out here as well. Vivek joins in with the details. Vivek.
Well, that's right. So NTPC's renewable arm, which is NTPC Green Energy, yesterday went and filed the DRHP to launch an IPO. What is the company looking to raise? As per the DRHP, it's going to be a fresh issue of shares where the company will raise close to 10,000 crore rupees. So significant fundraise coming in as far as NTPC's renewable energy arm is concerned. What is it that they are raising funds for? So one of the subsidiaries of the company, that is NTPC Renewable Energy, will use close to 7,500 crores of the proceeds from the IPO for debt repayment. Now, talking about the financials of NTPC Green Energy is concerned, revenues of close to 1,962 crore in FY24, operating EBITDA of close to 1,750 crore, and a profitability of 345 crore. Now, looking at the capacity, the operational capacity right now is 3.3 gigawatt, but the company has a very aggressive as well as an ambitious target as far as going ahead and installing further capacity. So renewable capacity additions of 11 gigawatt planned in FY26, FY27, the company expects to reach close to 20 gigawatt, and by 2032, the company has a stated renewable energy capacity addition target of close to 60 gigawatts. So the runway here is very long, and again, this is going to be an important development as far as NTPC is concerned, given the fact that it could see significant value unlocking from this particular development.
Right, with that, we'll take a short break. On the other side, we will get your top market and corporate voices we spoke to earlier today, and also, more importantly, key events that you need to watch out for tomorrow. Stay tuned.
Welcome back. Well, the United States Federal Reserve kickstarted the much-awaited easing cycle with that 50 basis points rate cut today. In a conversation with CNBC-TV18, Chris Wood of Jefferies says that he was a bit surprised with the 50 bips rate cut. Take a look at his view.
But the key point here is what the Federal Reserve believes is the neutral rate. So my guess that is probably in the 3 to 3.5% range. So even if the US achieves the soft landing, so to speak, we're probably going to be at between 3 and 3.5 by the middle of next year. But in terms of the short term, I'm surprised I'm surprised it's 50 basis points. Anybody who can read and listen is contrary to the messaging going into the meeting, so my guess at the margin is political.
All right, on the one hand, there was Jefferies, the other, there was JP Morgan as well. We spoke with Sanjay Mukim, who believes that investors will bet on the FMCG sector in India because stocks have underperformed for a while. Also speaks about the rural market play where there has been a fair amount of recovery. Hear him out too.
India, if you look at the behavior of stock markets, is a very mean reverting market. And because of the flow of liquidity, investors are always on the lookout for nice quality stocks that have underperformed for a while. And FMCG fit that bill very nicely, right? And then you have companies coming out and telling us on the margin really that things in rural India might be getting a little better. So to your question, I'm hesitating to give you a right answer. Are we seeing conviction that things are getting better at lower income consumption? Not yet. Okay. It's more of a hope trade. That's right.
Okay, so those are two big market views. Let's now come to a big corporate voice. Rajiv Bajaj, MD of Bajaj Auto, had earlier this year told CNBC-TV18 that he believes that 12,000 would be a fair value for the Bajaj Auto stock. Today, the stock actually hit that level. We caught up with Rajiv Bajaj once again. In fact, Parikshit was in conversation with him. And Mr. Bajaj said that the company has been doing really well, and he wouldn't rule out a stock price value of 20,000 over the next 6 months. Take a look.
We've really executed quite well in the last 6 months. We've materialized a lot of the potential and are well on our way, as opposed to 6 months back when it was still, just brimming with potential. And if I were to again compare with the new market scenario, because the market has also moved up, so that's no credit to us. And if I look at the basket of companies I was comparing with, then it seems to me as ludicrous, perhaps, as 12,000 sounded at a time when we were closer to half that number. It seems to me that something closer to 20,000 is not out of the reckoning. At least in mathematical terms, one can justify it.
20,000 out there, upgrading his target price, so to say, on the stock, as brokerages would do it. But, let's wrap up on this edition of Markets Forward. But we don't leave you without telling you some of the key events to watch out for. Vinny Motiwala is here with the lists. Vinny.
So yes, what we're watching out for in terms from Japan, we're watching out for the CPI data as well as the rate decision from the Central Bank of Japan. That's going to be very important in terms of a move that will be coming in, especially after Fed cutting rates. Let's move on and also talk about Hong Kong. We're watching out for the CPI data there as well. On the domestic front, what we're watching out for is that Godfrey Phillips, the board, will be considering bonus issues. So let's watch out for that meeting. Other than Mankind Pharma as well as Saturn Credit, both the board members and both the boards will be meeting to consider some fundraise plans. So important to watch out for what is the amount of the fundraise and the use of this as well. Moving on to some of the other important stocks that we should be keeping an eye out on because they will be going ex-dividend. We do have names like Mrs. Bector Foods, we have EMS Limited, Gujarat Fluoro, as well as Gopal Snacks, Nalco and National Fertilizers, which will be going ex-dividend tomorrow. So keeping an eye out on that. And important AGMs on your radar that you should have is BEML. That is an important one. CCL Products and Max Healthcare are some of the important AGMs that we're keeping an eye out on tomorrow.
Okay, all right, Vinny, thank you very much for that. So, busy Friday lined up ahead. And with that, it's a wrap on this edition of Markets Forward. Many thanks for being with us. Back with more news and updates in just a bit.
I support Israel's ability to defend itself. And I support the need for Palestinians to have dignity, self-determination, and security as we move forward and get a two-state deal done. But right now, the thing we need to get done is this hostage deal and this ceasefire deal. We need a ceasefire. We need the hostage deal. I've had direct conversations with the Prime Minister, with the President of Israel, with Egyptian leaders, and with our allies. And I think we've made ourselves very clear this deal needs to get done in the best interest of everyone in the region.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Sensex and Nifty hit record highs in intraday trade after the US Fed cuts rates by 50 basis points, but both indices give up some gains in late trade. Mid-caps continue to underperform. India's Economic Affairs Secretary says the Fed rate cut is unlikely to impact foreign inflows into India. Many economists do not foresee big rate cuts from the RBI, at least until the end of this year. Bharti Airtel and Vodafone Idea lose the final legal remedy available in the AGR case. Supreme Court rejects curative petition filed by the companies alleging calculation errors by the government. Both companies owe more than 1 lakh crore rupees to the government. First Source is reinventing itself, says Sanjeev Goenka, as the company enters Australia and New Zealand. Goenka also says First Source will hopefully announce a new acquisition soon.
We've really executed quite well in the last 6 months. We've materialized a lot of the potential.
Shares of Bajaj Auto hit a lifetime high, crossing 12,000 rupees. Rajiv Bajaj says shares can hit 20,000 rupees as exports are doing well, and Freedom and Chetak have gained traction. That's an exclusive. Government investigates allegations of unsafe and exploitative environment at audit firm EY after the death of a 26-year-old employee. The mother of the deceased blamed extreme work pressure for her death. Within 4 months of joining the company, EY calls it irreparable loss and says it has provided assistance to the family. After pagers, more communication devices used by Hezbollah explode across Lebanon, killing 20 people and wounding 450 more. Israel declares the start of a new phase in the war. Prime Minister Modi reiterates the promise to restore statehood for Jammu and Kashmir at his first election rally in Srinagar amidst tight security. Accuses Congress, National Conference and the PDP of trying to divide the state.
Ultimately, I think society will benefit for what is, in my humble opinion, electricity for the 21st century.
Artificial intelligence is the electricity of the 21st century, says Vallabh Shah, the chief digital evangelist at Salesforce. Exclusive interview coming up. All right, let's start with the market action. Sensex and Nifty hit record highs in early trade as a 50 basis point rate cut by the US Fed fueled a rally, but markets did give up some of those gains but still managed to end in the green. Mid-caps continued to underperform with the index ending in the red. On the other hand, financial stocks saw healthy gains with the Nifty Bank Index adding almost 300 points. And the top story this evening, the United States Federal Reserve kick-started its much-awaiting easing cycle with an interest rate cut after over 4 years. It handed out a hefty 50 basis points cut against a widely expected 25 basis points cut. Speaking at a press conference later, Fed chair clarified that nobody should assume that this is the new pace for reductions going forward. He said that Fed committee has greater confidence that inflation was moving sustainably towards the target of 2% set by the central bank. He also stressed that the Fed's goal now is to keep inflation stable while simultaneously ensuring unemployment rate does not tick higher. Back home, India's Economic Affairs Secretary maintained that the supersized rate cut by the Fed would not have any significant impact on FPI inflows. Market experts and economists maintain that a rate cut by the RBI, if any, may not happen before the year end.
See, Federal Reserve has done what it assesses the good for the US economy, the largest economy in the world. And I see it as a positive for the global economy, including for the Indian economy. As far as your question about flows are concerned, it is a 50 basis points cut from a high level, from the high level. So I don't see that making any significant impact on the flows. You have to see how the things develop going forward.
All Asian central banks can cut rates to date, including the RBI. But my colleagues here, we believe the RBI is not, not going to be aggressively cutting, i.e. the RBI is going to behave in a different way from the Fed. And actually the RBI in recent months has been actually counter-cyclical because they've been doing these preemptive regulatory measures as regards the banking system. And so I would assume the RBI will cut rates once before the end of the year, but I could be wrong.
So it will be difficult for, I think from that context, RBI to go ahead and cut rates. But if we are wrong and inflation does go down to 4% sustainably, I think that will definitely open up the room for RBI to cut rates. And even if RBI cuts rates, look, we are only talking about a 50 basis points of rate cut. So I don't think there is a lot that interest rates can do now to boost growth.
But I do think the RBI will want to see a little bit more data. So we actually think in October they'll still hold their gunpowder. They'll want a little bit more conviction that yes, food inflation after 3 years of being sticky is finally going down. And as the governor keeps saying, it's not about being at 4% for a month. It's about durably seeing 4% for the next few quarters. But this does, I'll end by saying, if the Fed cutting this year increases the odds of a soft landing in the US, that's a very good global environment for risk assets in emerging markets in 2025.
As crude oil prices hover around $75 a barrel, the Indian government is cautious about a potential cut in fuel prices. Sapna Das is here with more details. Sapna, how's the Petroleum Ministry reading the current market situation?
Well, absolutely. So basically, there's a bit of a bit of caution that seems to be coming, emanating from the government quarters as far as a potential fuel price cut is involved. First, of course, the crude oil prices have been very volatile, and that's borne out by the current rates, like near $75 a barrel in comparison to an intraday low of around $69 just last week. So that's one. So under when prices are very, very volatile, it becomes difficult for OMCs to take a call as such. Need pricing to be more stable for these kind of decisions. That's one. Second, of course, there's a lot of new information coming in, like the Fed rate cut, the China situation, how it pans out. So all of these factors need to be absorbed by the OMCs, and they need to be in touch with all these factors, and all of them probably play out with a time lag. So that's the second element that one needs to keep in mind. Third, of course, very significantly, refining margins have been coming down for quite some time, and we are now given to understand that probably on petrol, the cracks are actually negative. So that's a significant indicator of how things are, and most of the OMCs are now integrated, marketing along with refining. So it's going to be a balancing act. It's not a very, very good situation, so to speak, or not 2 + 2 = 4, where prices come off in the global market and, we start talking about a price cut in the domestic market. So that's the third element. Fourth, importantly enough, we are given to understand that there is also still some under recovery in terms of the LPG sales. Plus, we are also given to understand that the ethanol prices, which are on the higher side right now, and there's already a talk about the next ethanol pricing revision, which is most likely, the Food Ministry has already floated a cabinet note, and it's in discussion with Petroleum Ministry, with other stakeholders. So discussions will unfold with OMCs and a call will be taken accordingly. So this is also impacting the OMC in some way. They're absorbing that higher cost because there's no pass-through mechanism. So all these factors put together, OMCs will be taking a call. Of course, nobody is denying that there'll be no full price cut. But to say that, it's a straight and simple forward maths, or this is what has happened in the international markets and this is how now India should do, or the OMCs should behave, that probably is not correct. So we need to keep a close watch on this, wait and watch and see what unfolds over the next 4 odd weeks.
Right, thank you, Sapna, for that update. Moving on to another big story that we are tracking, a major blow to Bharti Airtel and Vodafone Idea in the AGR dues case. The Supreme Court rejected curative petitions filed by the companies alleging calculation errors by the government in the 2019 ruling. Both companies owe more than 1 lakh crore rupees to the government. Ashmit Kumar is here with the details. Ashmit, take us through what entailed in the hearing today.
Well, first, to establish the significance of this development, let's bear in mind this was a curative petition. This was the final legal remedy that was available to Vodafone Idea and Bharti Airtel. With the dismissal of this application, that of course is the bigger takeaway. The bench headed by CJI, the curative petition has been dismissed by the Apex Court. That's the bigger takeaway. But of course, in terms of understanding the significance, this was the final court of appeal. This was the final legal remedy that was available. With this decision that we've seen today, the AGR issue has been put to rest. It has been finalized. The Supreme Court has had the final word that there is no dithering, there is no changing of the quantum of the AGR demand that was first levied bear in mind that this judgment came back in 2019. At that time, the burden that was cast on Vodafone Idea was north of 58,000 crore rupees. Burden cast on Bharti Airtel was north of 43,000 crore rupees. Now, of course, those figures have grown dramatically with the levy of the interest component. But nonetheless, the long and short is that the contention that has been raised by the telecom companies, that there are arithmetic errors, there are computational errors, there are administrative errors in arriving at that AGR demand that was levied by the DOT. That concern has been set aside. The Apex Court saying that no case has been made out. It does not feel the urgency to indulge this matter anymore. And with that, the curative petitions having been dismissed by the Apex Court and the issue being put to bed, put to rest, finalized by the Apex Court, AGR demand is here to stay.
All right, AGR demand is here to stay. Thank you, Ashmit, for that. Shares of NTPC rose more than 3% in early trade. This after its subsidiary, NTPC Green Energy, filed a draft red herring prospectus for its 10,000 crore rupees public issue. The company is looking to raise funds via fresh issue of equity shares. Around 7,500 crore rupees of the IPO proceeds will be used to repay debt. The board of 361 RAM has approved to raise funds worth 2,250 crore rupees via qualified institutional placement in an exchange filing. The company, formerly known as IIFL Management, said that the fundraise will happen in one or more tranches. Andhra Pradesh government has approved a new excise policy which is set to be effective from the 1st of October. The state government has set a fixed price of affordable liquor at 99 rupees along with facilitating retail sales by private players. In a presser, Andhra Pradesh Minister K. Parthasarathi also announced that the state would also grant license to 12 premium shops with a tenure of 5 years. The license fee for these premium shops would be 1 crore rupees. RP Sanjeev Goenka Group-backed First Source has announced its expansion in the Australian market. The company will set up new headquarters in Melbourne. Speaking to CNBC-TV18, Chairman Sanjeev Goenka said that remains steadfast on his target to increase First Source's profits by 2.5 times in 3 years and margins by 3%. He has also hinted that the company could announce an important overseas acquisition soon.
Any acquisitions that are on the cards for First Source?
Inorganic growth is a way of life as much as organic growth is. And as we speak, there are different conversations going on with different companies. So fingers crossed. Hopefully soon.
From one newsmaker to another, Rajiv Bajaj had earlier this year told CNBC-TV18 that he believes 12,000 would be the fair value of the stock. Today, the stock hit new highs to cross exactly that mark. Speaking to Parikshit Luthra, Bajaj said that the company is firing all cylinders and the stock could even hit 20,000 rupees.
We've really executed quite well in the last 6 months. So we've materialized a lot of the potential and are well on our way, as opposed to 6 months back when it was still, just brimming with potential. And if I were to again compare with the new market scenario, because the market has also moved up, so that's no credit to us. And if I look at the basket of companies I was comparing with, then it seems to me as ludicrous, perhaps, as 12,000 sounded at a time when we were closer to half that number. It seems to me that something closer to 20,000 is not out of the reckoning. At least in mathematical terms, one can justify it.
And you can catch the entire conversation with Sanjeev Goenka and Rajiv Bajaj on News Center at 5 and 9:30 p.m. right here on CNBC-TV18. Shares of pharma company Wockhardt rallied in trade. This after the company said an investigational drug was effective against meningitis, which is a serious infection that affects membranes covering the brain and spinal cord. Wockhardt said it should be completing phase 3 global trials in the next few months and eyes regulatory approval in India in the first half of 2025.
It crosses blood-brain barrier. And that's why Zeneca is very effective, and it has a very high coverage against resistant organisms. Stage of completing phase 3 clinical trial, which is a global clinical trial. And this should get over in the next 2-3 months. And then we would be in a position to file globally in US and other countries. And that will happen after about 4 or 5 months of completion of clinical trial. So we expect to be in a global market sometime in 26.
The Labour Ministry will be probing the allegations levelled by the mother of a 26-year-old CA who died just 4 months after joining EY India. Anna's mother, in a letter addressed to EY India Chairman Rajiv Memani, alleged that the extreme work pressure in the organisation led to her death. Abhimanyu Sharma joins us now. Abhimanyu, what has the mother of the girl alleged exactly? Also, has EY responded to these allegations?
The Union Labour Ministry is going to probe a complaint which has claimed that overwork led to the death of 26-year-old CA Anna Sebastian Perel, who was working with Ernst & Young India since the past 4 months. The deceased mother had written a letter to the company's chairman after her death and had made several allegations. She had claimed that Anna kept on working despite deterioration in her health, and she was chasing deadlines which eventually led to her death. She also criticized a work culture in the company which seemed to glorify overwork while ignoring the interests of the human beings who were assigned to different roles. She also claimed that no one from the company had attended Anna's funeral. The company also issued a statement later giving condolences to the deceased's family, and also said that they are taking the family's correspondence with utmost seriousness and humility. Now, BJP leader Rajiv Chandrasekhar had also sought a probe into the allegations which were made by the deceased CA's family. It remains to be seen what comes out of the probe which has been initiated by the Union Labour Ministry.
Right, thank you Abhimanyu for that update. All right, it's time for a short break. Coming up next, tensions in West Asia worsen as more and more communication devices used by Hezbollah explode in Lebanon. Much more details when we return.
Today is National Voter Registration Day, and we are asking you to please join us in going to iwillvote.com to check your status and vote early like we do.
We are voting for Kamala Harris and Tim Walz because they are fighting to protect our reproductive freedom, our planet, and our democracy.
We can't let extremists control our lives, our freedoms, and our future. The only way to stop them and the dangerous Project 2025 agenda is to vote and elect Kamala Harris.
Vote like your life depends on it, because it does.
Go to iwillvote.com and make a plan to vote early.
Love you guys.
Welcome back. The big international story is the escalation in West Asia. At least 20 people have died and 450 injured after communication devices used by militant group Hezbollah detonated across Lebanon. These devices include walkie-talkies, mobile phones, laptops and solar power cells. Reports suggested that one of the explosions occurred during a funeral procession of a Hezbollah member who was killed during the pager blast that killed 12 people and injured nearly 3,000 people. Only a day earlier, firefighters were deployed across several homes in affected regions to put out fires that engulfed around 60 homes. The Iran-backed militant group has blamed Israel for the attack. However, Israel is yet to accept or deny its involvement. Iran has also vowed to retaliate after its ambassador was wounded in the pager attack. Israel's defense minister has declared a new phase in the war, signaling more operations in the northern border with Lebanon. Lebanon's communication ministry has said that the walkie-talkies that exploded were discontinued devices made by Japanese firm ICOM. The ministry added that these models were not officially licensed and had not been vetted by the security services. The Japanese firm has also said these devices have not been in production for over a decade. They said they cannot confirm whether they were counterfeit. United States has said it's still involved in intense diplomacy to diffuse tensions. United Nations chief said civilian objects should not be weaponized.
Difficult for me to stand up here, Gabe, and tell you exactly how incidents over the last couple of days are going to affect outcomes in the next few days. All I can tell you is we're still putting our shoulder to the wheel to get the hostages home and get a ceasefire in place, as daunting as that is today. And we are still involved in intensive diplomacy to try to prevent a second front from opening up on that border with Lebanon.
This was triggered, I would say, in advance of the normal way to trigger these things, because there was a risk of this being discovered. Because obviously, the logic of making all these devices explode is to do it as a preemptive strike before a major military operation.
The United Nations General Assembly has passed a resolution calling Israel to end its illegal occupation of Palestinian territories within a year. The UN has also demanded for Israel to make reparations to Palestinians for damages incurred by the occupations. With 124 countries agreeing to the resolution, 43 countries abstained from voting, including India, Australia, Canada and the United Kingdom. Prime Minister Modi is set to embark on a 3-day visit to the United States for the Quad Summit from 21st to 23rd of September. Foreign Secretary Vikram Misri outlined PM Modi's plan in the US, which includes bilateral and multilateral meetings. The Prime Minister will also be engaging with Indian diaspora and business leaders on the visit. However, there was no confirmation on his meeting with Republican presidential candidate Donald Trump and Democratic Party candidate Kamala Harris.
The Prime Minister's first stop will be Wilmington in Delaware, which, as you know, is the hometown of President Biden. That is also the venue of this 6th Quad Summit that will be held there. It also happens to be the 4th in-person summit between the Quad leaders, and that will be during the day on the 21st of September. तो अभी मैं किसी स्पेसिफिक मीटिंग के बारे में आपको नहीं बता पाऊंगा कि मीटिंग्स फिक्स हुई हैं या नहीं. हम सभी दृष्टिकोणों से देख रहे हैं कि कितना समय हमारे पास है और किस किस से मीटिंग हो सकती है.
Here's a CNBC-TV18 exclusive. Artificial intelligence is the electricity of the 21st century. That's the word coming in from Wala Afshar, the chief digital evangelist at Salesforce. In a conversation with CNBC-TV18, he added that the company has announced a $1 billion fund solely focused on generative AI startups.
You can come to conferences like Dreamforce and learn about AI. You can get certifications on Trailhead at no cost and better yourself. Ultimately, I think society will benefit for what is, in my humble opinion, electricity for the 21st century. And I think at some point, government, public sector may work together and recognize that AI should be considered a human right. If I had to guess, I would say we invest in a startup on a weekly basis. Because as I look at the hundreds of startups that we've invested in, north of, I believe, $6 billion. We just announced Monday that we have $1 billion fund focused on generative AI startups.
Yeah.
And and of course I'm speaking to someone who knows startups more than anyone maybe on earth. But the fact
I would like to claim that, but sadly, no, I don't think so.
I think if you fact check that, that may be very, very true. We launched Salesforce Ventures in 2009.
Yeah.
And our portfolio is incredible. I mean, this is a company, I believe Salesforce has acquired 76 companies in 25 years. So we acquired, on average, 3 companies a year.
And you can catch the entire conversation with Vala Afshar and Shireen Bhan at 6:30 p.m. right here on CNBC-TV18. And with that, it's a wrap on this edition of Business 360. More news and updates continue right here on CNBC-TV18.
Barely a few months ago, this spot was bustling with shoppers, and your shopping experience was incomplete without being shoved, jostled around, or stepped on at least a few times. Ranganathan Street has long been the heart of Chennai's retail capital, T. Nagar. But this neighborhood is hardly recognizable anymore. The transformation started soon after tunneling work for Phase 2 of the Chennai Metro Rail began earlier this year. It's the smaller retailers who have taken the bigger hit. In nearby Badaparani, 3 metro stations are being built on the arterial Arcot Road. Hardware, textile and electrical stores in these neighborhoods say their footfalls have come to a grinding halt, and some fear the losses they're suffering may spell the end of their businesses.
We have incurred losses of 50% since the metro rail construction began, and these roads were turned into one-ways since customer footfalls have dropped drastically.
I make just enough to pay rent and meet household expenses. Business has been gravely impacted since metro rail construction began.
I have faced losses of at least 3 to 4 lakh per month. I am unable to repay loans and my debt is piling up.
Hello and welcome to this special program. I'm sitting down with someone who was regarded as one of the world's foremost equity strategists. I'm sitting down with Christopher Wood at Jefferies, and what a day to sit down with him from the sidelines of the Jefferies Investor Conference here in Gurgaon. Chris, great to have you with us here. Thank you very much for your time. I said what a day to sit down with you because we're sort of coming out of this 50 basis point rate cut from last night. What do you make of it? I know you were expecting 25, but here we got 50.
No, I'm genuinely surprised by the size of the rate cut because it's contrary to the messaging of the Fed going into the meeting, which is that the economy is okay and the employment market is weakening, but only gradually. So, yeah, if you talked to me yesterday, I would have said 25 basis points. I think there was an article in the Wall Street Journal suggesting it might be 50 at the weekend, so that was probably the clue that they were going to go bigger. But bottom line is contrary to the messaging going in. But the key point here is what the Federal Reserve believes is the neutral rate. So my guess that is probably in the 3 to 3.5% range. So even if the US achieves the soft landing, so to speak, we're probably going to be at between 3 and 3.5 by the middle of next year. But in terms of the short term, I'm surprised it's yeah, I'm surprised it's 50 basis points.
Do you think it's got a political angle to it as well, with elections in November?
My guess, given the fact that whatever they might argue today is quite, anybody who can read and listen is contrary to the messaging going into the meeting. So my guess at the margin is political, because it's pretty clear that probably the vast majority of members of the Fed would prefer Donald Trump not being elected.
I see. And
I'm sure the Republican candidate will view it as political.
But does it help at the margin?
Maybe. I'm not sure it does help. Maybe at the margin.
Okay. I want to come back to the US political sort of elections season in just a bit, but we don't see 50 basis point cuts without a crisis. Either very apparent or, I mean, something which they're worried about. But
there could be conspiracy theories that they know something and the economy is much weaker than which is a risk of them cutting 50 basis points yesterday, actually. But my guess is they actually genuinely believe the economy is okay. So that's why I think the motivating factor is political. And there clearly are some members of the Fed who are very political. Former New York Chairman Bill Dudley has been calling aggressively for a 50 basis point rate cut. If I remember correctly, he was the guy who once wrote an article calling on the Fed to manage monetary policy in a way that could stop President Trump being elected in the previous election. So I think there have been quite a lot of people calling aggressively for rate cuts, saying the Fed's behind the curve. But that's not the message transmitted by the Fed chairman, Mr. Powell. Yep.
Do you believe the economy is solid?
I believe the economy is obviously the economy is okay right now, but I still believe there is a risk of a US downturn because of the big lags in monetary tightening in this cycle. So if you look at a chart in my presentation I gave this week, there's a chart of M2 nominal GDP growth, which had a huge explosion back in 2020 when they printed all that money in the pandemic. And actually, while M2 growth has slowed sharply in the intervening period, while the Fed has been tightening, if you draw a trend line from 1997, the M2 to nominal GDP ratio has only just gone below the trend line, which is a long-winded way of saying that in liquidity terms, the monetary tightening is only just beginning to bite. And you know, the labour market is weakening. All we need for the Fed to be cutting 50 basis points every meeting is one unambiguously bad labour market
data.
Yeah.
And you get another 50.
Yeah, but then the market will be discounting 50 basis points every meeting.
Okay. The Fed themselves in the dot plot is saying that there'll be two more 25 right, this year in 2024. At this point, that seems likely. I think it'll be more than that.
Yeah, but I don't really pay any attention to the dot plots. What's important is the data.
Okay.
I mean, the dot plots are important in the sense of what the Fed think, but I wouldn't invest any money on the dot plots.
Okay. So let's assume that it's a normal kind of an economy, maybe a little slowing at the margin, but no crisis, nothing panicky. And you have these rate cuts which have started. Let's just assume it's 50 now and then maybe another 50 through the end of the year. What does it mean for asset classes like equities?
Well, it's good news it should be good news for emerging market equities because in most emerging markets, particularly here in Asia, central banks all year could have cut rates for their own domestic reasons based on the level of real rates and inflation. But in the vast majority of the cases, they chose not to cut rates because they were worried that they might undermine their own currencies. And in the specific case of Indonesia, which has the central bank has a currency stability mandate, they actually raise rates despite very high real rates. So basically, all these central banks will now have room to cut rates and hopefully their currencies don't get hit. So far, basically, the dollar has been in an increasingly clear weakening trend. So that's basically good news for emerging markets.
So EMs more than US?
In my view,
in an easing cycle?
Yeah, in my view, yes. Because in the specific case of the US, the interesting point is how resilient the US listed companies have been to the Fed tightening cycle. And that is explained by this extraordinary statistic that the net interest payments of the US non-financial corporate sector have declined sharply in this Fed tightening cycle, which is counterintuitive, but it's the reality. And that's because the big tech companies have been earning 5.5% on their cash, where they used to earn 0. And it's because the investment-grade corporate sector in America did a very good job locking in bond yields when they were low, refinancing their debt. So if the higher rates actually were positive for them on the up, it's where the lower rates will help is the SMEs, because they don't issue bonds. And that's the big surprise. SMEs in America have been paying between 9 and 10% to borrow money for the last year. And that's why I'm genuinely surprised how resilient the labor market has been. Yeah, because they employ most Americans.
What about India, Chris? I mean,
well, in the case of India, the RBI can cut rates like
later this year.
Well, I mean, all Asian central banks can cut rates today, including the RBI. But my colleagues here, we believe the RBI is not, not going to be aggressively cutting. I.e., the RBI is going to behave in a different way from the Fed. And actually, the RBI in recent months has been actually counter-cyclical because they've been doing these preemptive regulatory measures as regards the banking system. And so I would assume the RBI will cut rates once before the end of the year, but I could be wrong.
Okay.
And they can cut rates because...
That's the consensus. First cut by December of this year. I
think the RBI would be coming under criticism if they haven't cut rates by the end of the year, because if you look at the level of inflation, particularly core inflation, is below the level rate. So you have positive real rates. But obviously with the stock market at all-time highs, huge domestic flows getting to the stock market, the RBI doesn't feel under massive pressure to cut rates today.
Yeah, absolutely. Chris, what about flows into India? Because the market here has been marching to the sort of drumbeat of local investors putting in money, and that number has sharply increased. It's about $4 billion regularly a month coming into mutual funds. It was about $2 billion a month before elections. So actually post-elections, the number has gone from $2 to $4 billion a month. I remember you were surprised when the market here, barely shrugged in response to the election.
That was a big surprise. That was a big surprise to me.
And of course, after the capital gains...
well, that's actually the biggest surprise to me was the second.
Yeah.
So after the election, clearly it was only one-day sell-off, but then I think the market's reaction was explained by the fact when I came to Delhi shortly, it was clear that everybody believed this government could last 5 years with the two minority parties. So that became more explicable to me, but I have to say I'm genuinely astonished by the resilience to the capital gains increase, which is quite material, most particularly as the week before I met many domestic institutional investors and they were not expecting the capital rate gains tax increase. So I find that...
and many of them were very vocal that markets will be hurt.
Yes, I would have been too, so we've all been completely wrong. So the only explanation is that the domestic households who are investing through these monthly installment plans have become convinced, in my view correctly, that India is a good long-term equity story and don't want to be scared out of the market. That's the only... And the big story of India this year is these domestic flows.
Yeah. But what about foreign flows? You said that easing cycle is great for EMs. India is an emerging market. Foreigners have stayed away.
But on a relative basis, if you're an EM fund manager, after this 50 basis point rate cut yesterday, the markets you're going to want to add positions to are places like Brazil, which have 11% nominal rates, 5-6% real rates, so huge potential to cut rates. Markets in Southeast Asia, like Indonesia, Philippines, which are traditionally very sensitive to lower US rates, weaker US dollar. So India is not the obvious place to put your money in today because, one, it's expensive, and two, the RBI is in no hurry to slash rates.
Well, Chris, stay with us. We'll take a quick break here. Stay with us because we got a lot more ground to cover with Chris Wood of Jefferies on the other side.
We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond.
CNBC-TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence, and in-depth reporting that makes CNBC-TV18 India's #1 business news brand. Foreseeing change, growth, and transformation for over a quarter of a century. Trendsetters crafting innovative content formats.
You've been at the conference, you've been speaking with a lot of foreign investors who are here. What's the sense you get about India? Yeah, it's expensive, but it's been expensive. You could have made the same argument 3 months, 6 months, a year ago.
The people obviously the people here are already invested.
Right.
So their issue, they're not too hung up on the valuation. I mean, they're all concerned about the valuation.
No, we're talking about incremental flows into the Indian market. I mean, what's the sense you get on that? I mean,
well, my sense is yes. The problem for the foreign fund managers as a whole is that they are underweight. Based on our latest data, based on the top 30 global emerging market equity funds, they're now marginally underweight, which is not where they want to be, because most of them would agree with me that this is the best long-term story. But they're underweight. They've become underweight from a de facto standpoint. One, because they've been reluctant to pour money in because of the high valuations. Two, because this is a very important point, the neutral benchmark weighting of India has just gone up a lot, which has made them become underweight by market performance. But there's an additional issue. There are two sectors where foreigners have traditionally most invested in India have ironically been underperforming, i.e. IT services and banks. So in the last year, many foreign investors, particularly value-orientated investors, would have gone into the banks for the first time because they came within their valuation range. But they're not the hot areas of the market. The hot areas of the market in India have been areas like industrials, infrastructure, real estate, energy, defense. These are the areas which have been driving the market. That's not the area traditional emerging market investors have been investing in.
So you don't think that foreign investors are going to come back to India in a big way?
Not in the immediate term, but the good news about this is the really positive point to take away is any major correction in India, like say 10%, in my view, will be viewed by foreigners as the opportunity they've been waiting for to add.
Are you still expecting a 10% correction?
No, I'm not. I'm just saying that's...
someone said 5 is the new 10 and maybe 2 is the new 5.
No, my view, I've got a agreed and fair long in the India portfolio. I'm not going that defensive in it.
Okay.
So, because the point is I can afford a correction. I've got very good performance. But my portfolio is heavily in energy, real estate, capex plays, but I have got the bank, so that's, I suppose, the conservative part of my portfolio.
Okay. Okay.
But the real issue for foreigners, I think the more foreigners know about India, the more specialized they are in the market, the more relaxed they are on the valuations. It's just the generalists are the more concerned. And global investors, as opposed to global emerging market investors, barely own Indian equities at all.
So
I'm talking about global funds.
Right. Not EM funds, but global funds.
They barely own India at all.
At all?
Yeah, literally. They don't own India.
So it's a strange kind of a position, right? I mean, because you're saying is the best long-term story.
Many global investors will agree that India is now the best story, but there's a practical issue that if you only invest in India via ADRs, you have extremely limited choices. Because of the lack of ADRs quoted offshore. Unlike in China, there are many ADRs. And the second practical issue is if you want to invest in India in a sort of more real manner, you have to get FII approval. And that is a regulatory obstacle, right? That requires a real commitment. So most global funds have not got FII status.
Is that such a big issue? I mean,
yes, that's an issue. Don't underestimate that.
Yeah.
So a big fund management company could have their global emerging market fund with FII status, but their global fund may not have it. And then this capex increase, or capital gains tax, will now become another. Will now put them off.
You know, in your note, I think the last but one note, you did mention that you put in that capital gains, and you said, well, that worries you.
Now, that personally, I don't believe in capital gains taxes on equities because people have already earned the money and they're risking. They should be encouraged to invest in equities. Now, obviously, you can deduct the money you lose, but that's just a philosophical point. So, obviously, the government's raising.
No, but did you mean that in the context of where India is in terms of the political?
Well, no, that is an issue because in most Asian markets, you do not pay capital gains tax. But be you domestic or foreigners. But there's another technical issue where if you're running a dedicated Indian fund, or you have to make a provision for that capital gains tax, apparently, even if you haven't sold the stock. You see what I mean? So if you're a fund manager, you're kind of starting behind the benchmark.
Because of this?
Yes.
Okay. So
that is actually a negative, yeah. That's a negative for people trying to do dedicated Indian funds offshore.
So do you think this? I mean, India's weight has gone up, right, in the benchmarks. But do you think foreign funds will stay underweight for some time? I mean, that underweight position can actually even widen if local investors continue to put in money and the market continues to do well.
The direction of travel is foreign ownership is declining relative to domestic ownership. Fundamentally, this domestic flows are just extremely positive. And we estimate Indian households have 6% of their assets in equities. Though none of us are expecting the recent pace of flows to, by every law of logic, they should slow down. As you say, it's remarkable they've picked up since the election.
I mean, it's $4 billion a month now, on a regular basis.
But from a macro standpoint, this conference last year, we were arguing that we were in the early days of a capex cycle, but you couldn't really show data comprehensively proving that. Actually, the best evidence we were in the early days of a capex cycle a year ago, 15 months ago, was that capex stocks were rallying.
Sure.
But there wasn't the actual data. But now there's real data highlighting that the private sector capex cycle's underway.
But do you think, in a lot of ways, across sectors, I mean, stocks are already pricing a lot of this in India? I mean, capex stocks, for example.
So tactically, you would be a bit more cautious.
You would be.
Yeah. But I'm not. I've got these long-only portfolios, and I believe this. See, the last time India had a capex cycle, which I would say was like from 2002 to 2009, India massively outperformed the rest of Asia in that period. I remember it clearly. So, if this capex cycle is happening, structurally, I want to remain invested in the story.
Even if they go through periods of underperformance, but eventually it'll. I mean, it's a great story.
Plus, we have the residential property story, which
you've been very bullish on.
Yeah, and we don't think there's
You did highlight that last quarter there was a bit of a slowdown, but
but that I would view all that as a pause to refresh.
Okay.
So we've got good news of if there's a weakness to the residential property story, which has been dramatic here, right? And, if there's a weakness, is very much focused on what they call the high end, which I suppose in the US, well, it depends what city you're in.
The premium end has done very well.
Yeah.
You're saying that perhaps sees some.
Well, what I'm saying, if you're going to criticize it, you will say it's very vulnerable because it's just the high end going up.
Okay.
But I would say, in response, well, I would have to admit that's true. I would say that's normally how property cycles work. They start with the high end and they gradually trickle down. And in that sense, rate cuts would help because if you go under 200, to use dollars, not if you go under $2,000 for a unit, you're probably going to get to levels of more rate-sensitive buyers. And so if rates go down 200 basis points here or 150 basis points, that's going to increase the number of people who can afford it.
Right. So,
I'm heard that I think I heard this week that inventory in the top 7 cities is at a 14-year low.
Yeah.
So if that's true, we can definitely keep going for another 4 years.
In terms of this cycle, in terms of real estate build-up?
Yes, because we've just entered our 4th year of an upturn.
Okay. So you're saying another 4 years?
Obviously, we take it a year as it comes, but given the fact that we had a 7-year downturn, given this multi-year inventory low, given the fact that India builds far fewer residential units today than even China, given its current problems builds, there's no reason to think why this suddenly blows up.
So, tell us the sectors or places that you're most bullish on now, Chris. If somebody is trying to put fresh money to work here, what would you?
I would put it in today. So I'm not taking out. I've got 19% in real estate stocks in my India portfolio.
Okay.
Now,
what else have you?
If I was starting the portfolio today, I might be a bit nervous putting 19%. But given the fact I have 19% that done well already, I'm not going to actually reduce them.
Okay.
But if I want to have a more cash, let's say I can't own cash, but I wanted to be more tactically cautious. Because I've got more short-term tactical considerations, and you want to own the stocks which are more neo-cash proxies, which I would say are like the banks or the consumer staples.
So I mean, there perhaps there's a little bit of underperformance. I'm not sure. Banks have valuation comfort. Consumer staples maybe not so much.
No, but they're still, because we've got. I think we have evidence now that the rural economy is finally picking up, right? So I can see a case for adding to those tactically.
But if you were looking at slightly beyond the very near term?
Looking beyond the near term, I'm sticking with my current portfolio.
Okay.
So the issue
which is 19% real estate, what else?
No, it's big in capex plays and energy.
Okay.
And if any real correction in those areas, I'd be looking to add.
Okay.
Because I'm quite heavy in the banks, but the whole infrastructure story here in India, the energy story, these seem to be at the center of the action and the center of the capex cycle.
Sure.
It's just very positive for an economy if you have both a residential property upturn and a private sector capex cycle going on. So the way I look at it conceptually is that the government in the last 10 years has spent a huge amount at the central government level building capex. Which has been the big driver of the fiscal deficit as opposed to transfer payments.
Sure.
So that's been the enabling factor for the economy, which should give the private sector confidence to invest. And we are now, in the last year, seeing that actually happening.
Absolutely.
Yes. So whereas a year ago, talking to people in the government, they were saying why isn't the private sector investing? So I was saying, don't worry, the private sector capex stocks are going up.
Yeah.
But obviously, if you're a government official, the stocks going up is not. You don't trust the evidence.
Absolutely. Chris, just one last point. You were cautious, right? You're a bit cautious. We've got another round of elections, state elections coming up. Are they going to be important? Have you heard that as feedback from investors? They're watching it closely.
On the big stage. Obviously, we're seeing handouts, right?
Right. Across states, I mean.
Yes. So that's obviously. I mean, that's another reason to maybe add to consumer staples. Tactically, long term, that's not so great, but that just means maybe the incumbent has a chance of winning where everybody thought they were going to lose.
But would it make a difference? I mean, even if the ruling party were not so much...
That will create some negative noise.
Because, I mean, some argue that the general elections barely caused a bump, so why should this matter?
Well, I kind of agree with that.
You do?
My message, what I picked up talking to government-related people this week is, rather than passing lots of laws, the bigger focus seems to be on doing away with a lot of these regulations, which are a legacy of the what they call the license Raj. I think there's clearly a case for a bonfire of regulations to promote business.
That sounds like Elon Musk in America.
Yes.
Who wants to do the same?
Yeah, that's exactly right.
Absolutely. Chris, it's wonderful to speak with you. Thank you for sitting down with us. Appreciate your time here on CNBC-TV18. It's a pleasure.
Thank you.
Thank you.
And award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC-TV18, your trusted partner and investment ally.
I think what we saw today is really on the part of the Fed an effort to recalibrate their policy stance by really bringing down the funds rate to a level that's more consistent with the easier labor market conditions. I think what's pretty clear is that the Fed is going to be cutting more. It's going to be. It made very clear this I think today that it's not going to cut rates at a very rapid pace. It's no longer going to do 50 basis points. It's more like in the 25 basis point range, unless we see a very substantial deterioration in the labor market.
Hello, welcome to News Center. I'm Parikshit Luthra. RP Sanjeev Goenka Group-backed First Source has announced its expansion in the Australian market. The company will set up new headquarters in Melbourne. Speaking to me earlier today, Chairman Sanjeev Goenka said he remains steadfast on his target to increase First Source's profits by 2.5 times in 3 years and margins by 3%. He has also hinted that the company could announce an important overseas acquisition soon.
In this industry, when you talk of investments, you talk of FTEs. So you don't really talk of $1 million per se, but you talk of FTEs. So we begin small. We begin with about 300 to 500 FTEs, but we'll grow and we'll ramp it up very rapidly.
Okay, so there's a plan to increase growth and investments rapidly. But why Australia, if we were to ask you? Why did you choose this as your next destination for growth?
There are many corporates who are headquartered in Australia, and we do believe that's an opportunity that exists. It's an opportunity to be grabbed, and you don't have too many major service providers there.
Okay. Now, in terms of the jobs that are getting created, one, onshore in Australia? And does this also help you increase the flow of employees from India to Australia? How many jobs could it create in Australia, and how many jobs from the Indian market?
Typically, onshore-offshore ratios would be 1:3. And so for every job that's created in Australia, you'd expect to see 3 in India.
Right. And what will be the focus of FirstSource's business and expansion plans in Australia right now? You have been saying that AI and generative AI is the big priority for you right now. So can we expect FirstSource to work in that direction with clients in Australia?
Definitely. Definitely. And we do believe we will work on our strengths, on the basic sectors that we operate in, where we excel in. Those are the sectors that we will like to take our experiences from other countries to Australia.
Right. What kind of growth are you expecting in the Australian market? You've already been present in US and UK. How significantly do you expect Australia to contribute to FirstSource's business in the coming years?
I think over a period of time, we do expect Australia to become a significant contributor. And we do believe this is a base. So it's not only FirstSource. We recently partnered with an Australian firm to set up, to sign an agreement to set up a nanosilica project, which will be set up in India. And so our experience with Australia is becoming better, and we're getting more comfortable. We are happy with the response that we get from the government, and we do believe it's an area for potential growth.
Right. If we were to ask you about other global growth opportunities that you are exploring in terms of new markets, which could those possibly be?
Well, as far as FirstSource is concerned, we are expanding in South Africa also in a fairly big way. So that's one big market for us. Australia is another big market for us. India, of course, continues to be the place where the maximum jobs are getting created. We're expanding in US, we're expanding in UK, we're expanding all over actually.
Right. In terms of the capex that you're putting aside, recently we heard that the RP Sanjeev Goenka Group is putting aside 50,000 crores in capex for the next few years. How much of that is going to be directed towards FirstSource? How much of a priority is this business for you right now?
You know, all our businesses are in a very high growth phase. So we are investing not only in FirstSource, which will grow organically and inorganically. We are also investing in the chemicals business. We are investing in the renewable energy business. We are investing in the power distribution business. It's a phase of very high growth for us. And every sector that we are involved with, we will grow, and we will grow aggressively.
Right. But coming back to FirstSource, what kind of growth targets are you setting for the company in India and globally for FY25 and the next 2 years possibly, if you were to ask?
I've gone on record to say that our target is to increase our profits by 2.5 times over the next 3 years. We stay steadfast on that course. And the last quarter, FirstSource gave the highest growth in revenue terms for the industry, and which we've never had in the past. So it just proves that we are growing faster than the industry. Whether we'll continue to be the fastest or not, I don't know, but we will continue to be amongst the fastest growth rate companies in the sector.
Right. Any acquisitions that are on the cards for FirstSource?
You know, inorganic growth is a way of life, as much as organic growth is. And as we speak, there are different conversations going on with different companies. So fingers crossed. Hopefully, soon.
Okay, maybe we can nudge you a little more. Is it going to be in the AI space?
Just wait.
Okay.
Just wait. Hopefully soon.
Hopefully soon. All right. If we were to ask you about within different business solutions that you're offering right now, which ones are you most bullish about, or you expect the company to focus on in the greatest possible manner over the next few years?
You know, we do...
The number one priority, maybe.
I don't think I'm going to single out just one priority. I mean, if I had to take one objective for First Source, it would be a growth in margins and a growth in revenues. We do expect margins to grow by 3% over the next few years, and that's our target. And that's what we are working on very, very consciously. And to have significant growth in our revenues organically plus inorganically. In the past, we used to have one big win in a year. Last quarter, we've had two big wins. This quarter, two already, and maybe a third one. So things are beginning to fall into place. I think customers are beginning to see value in the services we provide. So we do believe that the growth momentum will continue. And we have good margins, but we need to grow it by at least 3 percentage points over the next 3 years.
Right. What kind of policy interventions do you hope from the government so that we can win in future in the generative AI space? Because this seems to be a priority for everyone, including you as well.
This space is evolving every day. And as we know it today will not be the same as we would know it even maybe 6 months from now. So as long as, I think government is supportive, all governments are supportive. So specifically, if you ask, is there any policy interventions? No. But generically at a macro level, just support this whole space of generative AI. And we're not looking for incentives necessarily, but we're looking for ease of the environment in which this can flourish.
Right. My final set of questions, Mr. Goenka. In India right now or globally, are there any new business verticals which you're exploring or wanting to get into?
You know, chemicals is something that we entered recently, and we intend growing very aggressively in that. The battery chemical space, the EV battery space, that's something that we are looking at aggressively, and our first nano-silica plant will actually get commissioned in the next 6 months in Gujarat. So that's something that we are very excited about. We are getting into nutraceuticals, which we launch in October, November. And that's purely plant-based and herbal-based, inspired by Ayurveda. That is something that we are very excited about. So a lot of it is based on IP, it is based on research, and it'll be based on technology.
Right. And finally, on the consumer business, you've been working towards profitability on that front. What's your prediction for the consumer business?
2Yum has taken off as a brand, and it's begun to, it's now clocking a beat rate of about 600 crores annually, which is not bad from where we started a few years ago. We break even when we get to 1,000 crores. And that should happen by 28.
All right, that was Sanjeev Goenka speaking to CNBC-TV18 about the latest investment and an announcement towards expansion in Australia. We're taking a short break here on News Centre, but coming up, shares of Bajaj Auto hit a lifetime high, crossing 12,000 rupees mark. Rajiv Bajaj says shares can actually hit 20,000 rupees mark, adds exports are doing well, and Freedom and Chetak have gained traction. Exclusive conversation coming up.
I've got 19% in real estate stocks in my India portfolio.
Okay.
Now,
what else have you
If I was starting the portfolio today, I might be a bit nervous putting 19%, but given the fact that I have 19% that have done well already, I'm not going to actually reduce them.
Okay.
But if I want to have a more cash let's say I can't own cash, but I wanted to be more tactically cautious because I've got more short-term tactical considerations, and you want to own the stocks which are more neo-cash proxies, which I would say are like the banks. We are the whole infrastructure story here in India, the energy story. These seem to be at the center of the action, and the center of the capex cycle.
I think the markets will continue to favor strength, and from a global perspective, clearly India has been the strongest bastion and has been the strongest kind of island, if you may call that, from a global investment landscape. And with this environment of aggressive rate cuts, that should only augur well for a market like India and an economy like India. The reality is that global international investors, foreign investors have been underweight India. India's weight in various market indices has been kind of galloping ahead.
I mean, all Asian central banks can cut rates today, including the RBI. But my colleagues here, we believe the RBI is not going to be aggressively cutting, i.e. the RBI is going to behave in a different way from the Fed. And actually the RBI in recent months has been actually counter-cyclical because they've been doing these preemptive regulatory measures as regards the banking system. And so I would assume the RBI will cut rates once before the end of the year, but I could be wrong.
Welcome back. You're watching News Center. Rajiv Bajaj, Managing Director at Bajaj Auto, has said that the company's stock could reach 20,000 rupees after its stellar performance this year. Speaking to me earlier today, he added that the company is firing on all cylinders and has chalked out growth targets and sales strategy for the Chetak and Freedom models. Here's that conversation.
It's funny, Parikshit, because when I actually joked about my retirement, people took it seriously. And when I spoke seriously about the fair value of the stock, you seem to suggest I was speaking in jest. But coming back to your question, after I said what I said at that time, Rakesh said to me that both he and our CFO Dinesh received many calls from analysts. And the common theme was the question that what is it you guys know that we don't, So that question comes back to my mind right now, that what is it that they know now that has made 12,000 the price for this stock? And to me, really, it's, we've executed well on all those things that you and I discussed. The Freedom is out there in the commuter motorcycle segment. The new Pulsars are doing really well in the sports segment. As you may have seen, I think you were there day before when Rakesh rolled out the new Triumphs in the premium segment. You know how well the Chetak is doing. You know how well the three-wheeler electric is done in the last 6 months. And while with exports, we are still missing out on Nigeria, but the rest of the world is holding steady. So, as I had said before, we are really firing on all cylinders.
Right. And HSBC has raised its target price from 11,000 to 14,000. That's an increase of 27% for the Bajaj Auto stock. How do you think things will move on from here? And your thoughts on HSBC's latest report?
Well, what I'd like to say in that context is this, that if we step back and kind of look at the big picture of the domestic two-wheeler market, then, there's many ways to segment it depending on what attribute one is looking at. But one very simple, almost simplistic way, Parikshit, is to just break up everything into the commuter space and, let's say, the sports space, So in the commuter space, I would count about 700,000 motorcycles, as I did before when we discussed the Freedom. But I was also add to that about 500,000 to 600,000 scooters, because scooters are essentially just city commuting vehicles. So that's a market size of 1.2 to 1.3 million vehicles each month. And the balance 300,000 motorcycles are, let's say, the sports segment. So if you look at our position till last year, for example, in this humongous domestic commuter segment of about 1.2, 1.3 million vehicles, what was our presence? Our presence was just about 40,000 vehicles, primarily with the Platina motorcycle, and we had virtually no scooters to speak of. Chetak this time last year was perhaps 4,000 or 5,000 vehicles a month. I think what has happened in the last 6 months, the most significant development now is that both the Freedom as a CNG motorcycle and the Chetak as a electric scooter have both really gained enormous traction. I had said to you earlier this month that after doing close to 10,000 vehicles last month, I'd like to think we can do closer to 20,000 this month. We were hoping to hit 20,000. It's going to be a bit of a struggle, it seems, but we won't be very far from it. Chetak, we are at full tilt as far as capacity is concerned. We had just about crossed 20 and we are struggling to push it above 20. So suddenly from a situation 6 months back when Freedom was not yet in production and Chetak was just about ramping up, you might well see a September in which both put together would be about 40,000 vehicles or a little more. And I think suddenly, at least we feel this, I don't know whether the street sees it like that, that suddenly between these two brands, we have this enormous runway stretching from now 40,000 Platina and 40,000 of this. So let's say 80,000, 90,000 vehicles a month, all the way up to 1.2, 1.3 million. And it's a marketing aphorism that in any segment, the market leader has 40% share and the number two would typically have 20% share. So even if I were to look at it from a 20% opportunity, the question we are asking ourselves within Bajaj now is that in the domestic commuter space, can we do 250,000 vehicles between the Chetak and the Freedom? And why not? So now that's not something for which, you can ask me whether we have a timeline and we have a capex plan. It's not, as crystallized as that. But I think that is the potential before these two brands, and perhaps that is beginning to be sensed.
So what are you now hoping for in terms of the next fair value?
Well, again, as I said in March, that I'm quite a layman in these terms. But again, if I go back to both, seeing our own situation internally, that we've really executed quite well in the last 6 months. So we've materialized a lot of the potential and are well on our way, as opposed to 6 months back when it was still, just brimming with potential. And if I were to again compare with the new market scenario, because the market has also moved up, so that's no credit to us. And if I look at the basket of companies I was comparing with, then it seems to me as ludicrous, perhaps as 12,000 sounded at a time when we were closer to half that number. It seems to me that something closer to 20,000 is not out of the reckoning. At least in mathematical terms, one can justify it. Of course, the subjective, qualitative, and the sentiment side of things is a different matter.
What kind of change in product strategy, expansion strategy, or investment strategy we are going to see from Bajaj Auto to sustain the growth going forward? Because consolidating the market position, becoming number one, not just in clean energy, but in overall scooters and two-wheelers is going to be important. Motorcycles is going to be important. So what's going to be any change in plans that you're making right now, Mr. Bajaj?
Well, I can only say this, that we are going to be putting the foot to the pedal twice as hard now, because, the big picture is like this again, that I would say we are not number two. We are number two in terms of Vahan for this month, but I must qualify that by saying that that has a lot to do with the fact that, we are a market leader in Maharashtra. With, I think, close to 35-40% share. So when you have Ganpati and sales are up in Maharashtra, obviously we gained disproportionately. That has helped us to kind of get our nose ahead of TVS. But we are neck to neck for the number 2 position, is what I would say. And we are both at about 20% share. And of course, Ola is still ahead at about 27, but that gap is narrowing. So I think, yes, we are in a much stronger position relatively than we were last year. Secondly, with every passing quarter, the cost position gets better, primarily with cell costs, etc., because that's like really the most important thing. So, while on the one hand, we have to prepare ourselves for life without FAME, without even PLI, and frankly, I would say with a higher GST than 5%. But at the same time, I think there is still a lot of juice there in terms of cost reduction that is possible as scale grows. So we see no reason to relent right now. And so we are going to, as I said earlier, if we have an opportunity to push all the way from the current level to maybe closer to 250,000 vehicles, why not? So we are thinking really big in terms of capacity for both the Chetak electric scooter, but also for the Freedom CNG motorcycle.
Okay. We've heard, and you've said this earlier, that you're looking at a capacity of 40,000 units per month for the Chetak by the end of FY25. What about the CNG bike?
Also, we will expand to 40,000 for that, but earlier than we would for the Chetak. So I would like to believe that will be in place by the end of December, because quite frankly, the response we had to the Freedom has been just spectacular. And I think it comes simply from the fact that people are far more familiar with CNG than they are with electric, and therefore more comfortable because it's a biofuel vehicle. It doesn't suffer from those range and therefore charging anxieties. And there is another issue that perhaps is not acknowledged as acutely as it should be right now, which is that with the prices of electric scooters falling, I mean, if you track it for the last 2 years, you will see how prices are falling for whatever reason. So there is a growing concern in the mind of people about the resale value of electric scooters of every brand. I think that concern is not there at all with the Freedom. And, it's just in a segment of one. There's no other CNG motorcycle at present. So I think because of, all these reasons, the attraction for Freedom qualitatively is far greater, I would say. And that is why in just its second or third month, we are talking of exceeding 20,000 vehicles and moving to, higher numbers from there. So that will be in place earlier. And Chetak, as you said, within the end of this financial year, should also be up to a number like that.
In order to consolidate the position of Bajaj Auto with an eye on future growth 5 to 10 years, any inorganic acquisitions that you're targeting right now?
Well, it depends on what one means by inorganic, Parikshit, but I would certainly say that the emphasis right now, our priority is still on executing well, to realize the full potential of what we have, So I would again repeat, whether it's Freedom, whether it's the Pulsar, whether it's the Triumphs that rolled out day before, whether it's Chetak, and I shared with you last time that we have a new Chetak platform coming in early next year. I also shared with you our plans to address next year the e-rick market with something different, etc. So I think we have a lot on our hands, and in the end, there's only so much that any one company can do. But I had also shared with you that there is one new idea, one new thought in our minds about a kind of, let's say, semi-blue ocean, if not blue ocean, and a potential partnership in that context. So, but that is still WIP at this moment. But apart from this, no, we would like to stay focused on these half a dozen things that really offer us tremendous potential in the next couple of years, I would say.
What about the 1 million target for clean vehicles? How close are you to that?
Yeah, I think just to clarify, when we speak of clean vehicles, we mean the Freedom CNG motorcycle, the Chetak electric, and the three-wheeler CNG and electric. So if you look at our total sale of that, 1 million implies a monthly rate of a little above 80,000 a month. And I'm sure that we will achieve that this month itself. So I think from this month onwards, Bajaj Auto will be at a hit rate of 1 million clean energy vehicles a year, if not higher, and it's only going to go up from here as the production of the Freedom, the Chetak, and the electric three-wheeler that we haven't discussed today, but which is also doing very well, that also increases. So we are well on our way in that regard.
All right, so big news there from Rajiv Bajaj saying that they could hit a milestone of 1 million clean energy vehicles from September onwards, and he's very bullish about increasing the capacity for the Chetak electric scooter to 40,000 units per month by March 2025, and even earlier, that is by December this year, to 40,000 units just for the Freedom CNG motorcycle. So that's 80,000 in all. With that, it's a wrap on this edition of News Center. More news and updates continue right here.
So when India, which is a very big abuser, he happens to be coming to meet me next week, and Modi, he's fantastic. I mean, fantastic man. A lot of these leaders are fantastic. You have to understand one thing. They're 100%. These people are the sharpest people. They're not a little bit backward. They are at the top. You know the expression, they're at the top of their game, and they use it against us. But India is very tough.
The Fed has delivered a supersized cut, and EM central bankers, like the Reserve Bank, will now have to face up to a 4.4% Fed funds rate by year-end and as low as 3.4% by end of 2025. So will dollars rush to emerging markets because you earn less on US bonds? Will the Reserve Bank have to cut rates to avert a rupee depreciation? The FOMC has also, remember, lowered the US growth forecast just marginally from 2.1 to 2% for the current year. It has upped the unemployment forecast to 4.4% from 4%. This will mean a slowdown in global growth, or will it? Then which stocks would be best bets for an Indian investor? For a 360-degree perspective on the Indian and global markets and macros, I have with me the JP Morgan Brain Trust. Sajid Chinoy, the economist, Sanjay Mukim, the head of equities and research, and Kaustup Kulkarni, the head of country head in India. They've all been kind enough to come over ahead of their all-important investor conference on Monday. And so here's trying to get everything that foreign investors think about us. But first, Sajid, first things first, the Fed cut. What does this mean? Now is a Reserve Bank rate cut imminent in 2024?
So first, let's talk about the Fed cut. And our US team had called for a 50 basis point cut, so this is not a surprise. I think what matters more than the quantum of whether this was 25 or 50 is why is the Fed cutting? Is the Fed cutting because the US is on the cusp of a recession? And our answer is no. In fact, if you look at the Fed Atlanta's nowcast, growth in the third quarter in the US is tracking 3%. The consumer is extremely solid. So the Fed moved because the balance of risk has now changed. They're much more comfortable that inflation is heading towards 2%, and they're a little bit concerned that the labor market has begun to soften. If you look at their own Taylor rule, right, about where rates should be, given this mix of unemployment and inflation, it should be at 3%, 3.5%. So there was this 250 basis point level shift that they had to undertake, and that's the way to understand this 50 basis point cut, that we may see more of it if the labor market slows in the coming months. Don't rule out another 50 in November if the labor market slows. But the point is that rates are now much above where conditions on the ground in terms of growth, inflation, the labor market are. The important part is the US is not slipping into recession just as yet. So they're cutting, in a sense, from a position of strength. This was a happy cut because inflation is coming off faster than they actually thought. What does this mean for emerging market central banks, Lata? There are going to be a lot of idiosyncratic factors. We should not rush to
India.
First India. Well, let me just lay the backdrop by saying Brazil hiked yesterday by 25. Bank Indonesia cut by 25 even before the Fed. So a lot of idiosyncratic factors will matter for emerging markets. I think for the RBI, again, the news is incrementally positive, that despite a slight upside surprise to CPI last month, despite the fact that September CPI could bounce back to 4.8 or 4.9, there's more conviction now with every passing week and every passing month that food inflation is going to gap down. We've had a strong monsoon. It looks like a good sowing season. Global
so
food
for domestic reasons, you're saying?
So, but I do think the RBI will want to see a little bit more data. So we actually think in October they'll still hold their gunpowder. They'll want a little bit more conviction that yes, food inflation after 3 years of being sticky is finally going down. And as the governor keeps saying, it's not about being at 4% for a month. It's about durably seeing 4% for the next few quarters. But this does, I'll end by saying, if the Fed cutting this year increases the odds of a soft landing in the US, that's a very good global environment for risk assets in emerging markets in 2025.
Our viewers are dying to hear what it does to Indian stocks. But very quickly, would you believe that there is still a global cloud on Indian growth? The domestic factors are pro-growth, but there is a global slowdown?
No question that, yes, the US is holding up, but look at the other parts of the world. There's been a lot of US exceptionalism. Europe has been soft. China continues to soften. So global growth is going to soften. And as we saw in the latest trade report, we won't get the same tailwind from exports that we have been getting over much of the last 2 years.
Okay. Well, with that, let's come to the area where we are, immediately interested in stocks. Sanjay, I read your report on how India is in a late cycle of the business cycle. First, just explain to us before I bring the Fed in.
Well, look, we've seen for the last few years in India very strong stimulus support, very strong economic growth, upgrades which are rare in India to earnings estimates and companies beating forecasts. That seems to have faded away, Lata. Right? And in
the first quarter saw downgrades.
That's right. And a significant number of downgrades, which actually is very rare for 1Q. We normally see downgrades in 3Q and 4Q towards the end of the year, but we've actually seen misses and downgrades in 1Q. We've also seen the downgrades to the GDP number, for example, as well. And that's one of the reasons we're talking about slightly late cycle dynamics in equity markets. Of course, we've stopped talking about valuations because, that signal has been flashing red for 2 years now. But in terms of growth, in terms of outcomes of companies, earnings momentum also, it does appear that we are more than through a significant upcycle in the equities market at least.
Okay, so therefore is it don't avoid equities or is it some kind of equities?
Well, that's a bit hard.
What would your preferences?
Right, so it's difficult to say avoid equities entirely because of course, let's say if you're a local investor, Lata, this is one of the challenges.
Where else will I put my money?
Exactly. right? With the tax incentives that we have in the economy, equities still appear relatively decent on an expected return basis, right? And it's difficult, therefore, to say you sell everything and leave the market. It's the only thing that we argue is that a lot of corners of the market are propped up principally on liquidity. And when things turn, it is that liquidity that presents a risk. See, the one thing that people forget at the top of every bubble, we don't know when it will be, is liquidity, right? Bubbles burst because of liquidity issues. And therefore, our advice to investors is that in all of your participation, be cognizant of quality risks, right? Do not compromise on having
Quality.
Exactly, right? We can't.
So you're never left holding a lemon.
Exactly, because when the tide turns and you should not be unable to get out of your stock.
No, but what is a typical late cycle stock that does well? If you're in the late cycle, obviously the big growth areas, consumption should not do well. What should do well?
Well, as of now, we are overweight consumption, Lata. Okay. And this is because we've...
Both durables and FMCG?
More durables, more FMCG, I beg your pardon, for now. And this is because we expect, the K-shaped recovery that, we've had post-COVID to converge a little bit. We're starting to see a little bit of signs of it. It's still very early to kind of convincingly argue it, but there is hope that this might happen. So we are actually overweight the staple stocks.
And what else?
We like real estate, for example. We think the momentum, again, going back to the argument, where else will you put your money? The equity market benefits from it. The real estate market should also benefit from it. We are overweight healthcare. We also like, so we are not very keen, let's say, on the IT and material space as of now.
No, I would assume healthcare is a late cycle preference. It's a defensive.
It is.
I want to come back on whether the K is converging, and even slightly. But before that, Kaustubh, the big point is that FIIs are not flowing into Indian equities as much as they're even flowing into Indian debt. When you look at the data around, quite a few GEM funds are, not up to the weight they should be, rather underweight India's, weightage in, for instance, MSCI. What's your sense about how they will behave now? Do you expect that now, with the dollar also weakening, will there be a FOMO and they rush in?
I think it's true that relative to the MSCI weightage that India has, FII ownership is still, at least depending on the day, 2 to 3% lower than what it should be. But a big reason for that is the weights for India have increased meaningfully compared to where they were 3 years ago. Two, Indian market and FII, a number of the largest FIIs understanding in the Indian market was reasonably limited to around 75 to 100 of the larger liquid stocks, as Sanjay mentioned. Whereas, as we know in India in the last 3 to 4 years in particular, the breadth of the market and number of companies which have created excess returns is way, way larger than just the 75 or 100 companies. FIIs therefore have to go through their own recalibration and understanding of the market in India. Once they're able to do that, and that's where we are seeing so much more interest from FIIs to understand exactly what's happening. Because of the change in weightage, they have to do more work. But equally, they have to do a lot more work in terms of the complexity and the breadth of the stocks that they have to start covering. We think they are doing active work, and hopefully, I think, therefore, the money will follow once they finish the work.
What about large banks? I mean, Sajid is saying that if not a rate cut in October, it's somewhere there in the horizon. What does that do to your view of financials?
Well, I think most foreign investors, of course, have a decent exposure to financials already, right? And this is a legacy exposure. It's a macro view, take an economy to just go buy a set of banks in the country. That's how it's played out for many years now. And what we're seeing, of course, is banks are best placed on the valuation filter, Lata, but on the growth momentum, naturally, there has been a significant slowdown, right? In the terms of the YOY growth that you got in 22 and 23, the growth we are now getting out of banks is much more meager. So the debate you have in the investment sort of ranking, this looks great on valuation, but the growth number is perhaps no longer as exciting as it used to be. Now, our pushback is, look, relative to growth valuation or a PEG ratio.
You may prefer NBFC in that case, no?
Yes, but NBFCs can be far more cyclical.
Okay.
Right. You have to take a cycle view, sector view, rate view, for example.
Fair enough. I have more questions on the rate view as well and what it does to bank margins. As well, this very interesting point to make about whether the K is not widening, but probably lessening, and more important, dollar. Dollar and dollar rupee. Where is it headed? All those questions to the JPM Brain Trust after the break.
Barely a few months ago, this spot was bustling with shoppers, and your shopping experience was incomplete without being shoved, jostled around, or stepped on at least a few times. Ranganathan Street has long been the heart of Chennai's retail capital, T. Nagar. But this neighborhood is hardly recognizable anymore. The transformation started soon after tunneling work for Phase 2 of the Chennai Metro Rail began earlier this year. It's the smaller retailers who have taken the bigger hit. In nearby Badaparani, 3 metro stations are being built on the arterial Arcot Road. Hardware, textile and electrical stores in these neighborhoods say their footfalls have come to a grinding halt, and some fear the losses they're suffering may spell the end of their businesses.
We have incurred losses of 50% since the metro rail construction began, and these roads were turned into one-ways since customer footfalls have dropped drastically.
I make just enough to pay rent and meet household expenses. Business has been gravely impacted since metro rail construction began. I have faced losses of at least 3 to 4 lakh per month. I am unable to repay loans and my debt is piling up.
High street stores have also taken a hit. Shopkeepers say the pain has been compounded by the fact that the months running up to this have seen tepid growth in sales volumes in key retail markets in the south. 3% in May, 5% in June and 2% in July. Experts say the absence of alternate infrastructure in Chennai has compounded the problem.
Unfortunately, in a city like Chennai, there are no alternative areas for customers to come in, park their cars or come in and access the stores. But my guess is that if the speeding up of infrastructure happens, which is the way it is done in the other cities, things can be much easier. But speed may be hard to come by because some portions of the Chennai Metro Rail could run into delays on account of trouble with land acquisition and funding. The Tamil Nadu government has already decided to single-handedly bankroll the ongoing phase of the transit corridor in the absence of central sanctions. So the June 2026 target to complete the project has already been pushed to December 2026, and many residents feel further delays cannot be ruled out. In Chennai, Jude Sanath.
Welcome back. We are in conversation with the JPM Brain Trust, Sajid Chinoy, Sanjay Mokim and Kaustubh Kulkarni, ahead of their all-important investor conference, which kicks off on Monday. Gentlemen, thank you very much for your time again and waiting on. Sajid, the currency. Now, if a 3.4 is the end rate of the Fed funds rate by 25, and 24 itself it will be 4.4. The dollar is moving towards 100.
Yes.
Do you does your US team pencil in a fairly much cheaper dollar below 100? Yeah. And what happens to the rupee? Already appreciated from 84 to, closer to 83.60.
Again, it matters why the Fed is cutting. If the US does not go into a recession and there's a gradual slowdown and the Fed is cutting and this is a soft landing, the dollar will weaken, right? And in that environment, all emerging market currencies will strengthen. But if the US slips into recession, historically that's been a risk-off event. Yeah. And then the dollar strengthens. So it really matters why the Fed is cutting and what the US growth backdrop is. In the case of the rupee, I think we should be realistic here. Don't expect too much rupee appreciation. I think the central bank has correctly ensured that the trade-weighted real effective exchange rate has been broadly stable. China has massive excess capacity that's flooding into all countries, including India. There are risks that if China continues to disappoint, the CNY will depreciate. The last thing India wants to do is give China a further cost advantage by letting the rupee strengthen. So if exports are our focus, if the focus is to reduce imports from China, we don't want a stronger rupee.
Absolutely.
Right? And so in a world where the dollar is weakening and other emerging markets are strengthening a lot, if the RBI correctly buys dollars and does not let the rupee strengthen, in trade-weighted terms, the rupee is weakening, and that's good for competitiveness. Yes. One last thing I'll say is our reserves, people keep asking, why is the RBI hoarding so many reserves? Our reserves are not earned reserves like current account surplus countries. Our reserves are borrowed reserves through capital inflows. For every dollar the RBI has, there's a dollar sitting in the economy, a liability in the economy which can unwind. So I think the strategy has worked so far. Expect if there's a large BOP surplus, the RBI will buy these dollars, and any rupee appreciation will be very, very modest.
Okay, very modest.
Very modest.
But, just a word more on growth. As it is, the trade deficit was, widening. In the last August number is not very flattering.
Yes.
So, do you think that exports are already finding resistance in global destinations?
I think
exports fell by 9.3%. Not a small number.
I mean, the main reason why the trade deficit balloon was gold imports.
Yeah, of course.
But you're right. I think the manufacturing goods cycle around the world is struggling, and India will not be immune to that. Part of it is because China has just got so much excess capacity. So we have to get used to the fact that, goods exports are going to slow. Service exports are holding up well. But we should not worry from a trade deficit perspective.
No, not trade deficit. I'm worried from a growth perspective.
No, it's a very important concern that the combination of the goods cycle slowing and Chinese excess capacity means the goods sector around the world is struggling, and India will be no exception to that. So we'll have to hope for the fact that if X doesn't provide as much support, then C and I, right, consumption and investment, have to make up the difference.
Okay, you're getting into an economics class now. Okay, Kaustubh, the more important thing is EMS company. Do you see this China Plus One continuing? We have seen fair amount of success in the EMS stocks, the Dixons, even the Tata Electronics. The South is seeing a burgeoning of investments. Will that continue?
Yes, for sure, Lata, because India has started the whole value chain on a very integrated basis on EMS side, and the amount of client dialogue that we are seeing from some of the most sophisticated product companies who want to get their products manufactured in India has substantially increased in the last 12 months. And that goes for EMS and also for some of the more high-end stuff like semiconductor. So when you have the whole prospect of a value chain being created and some very, very large and responsible companies are driving the investment and growth in India, obviously I think you're going to see very, very significant growth in the sector. So this sector therefore has the potential and prospect of creating very large number of jobs as well, just given the nature of work that goes on the EMS side. And hence it's in line with, let's say, what the government would also like to do is to start looking at and bringing sectors which have capability to put India as an important partner in the global value chain, but also contribute to substantial job growth in the country.
Okay. Sanjay, on that, are these attractive stocks?
Well, I wouldn't comment on...
see, don't go about the near term. I mean, you are considering we are in a late cycle now, but more generally for a longer term investor, I'm not asking you to name stocks, but is that a sector? There are two sectors which have burgeoned. This EMS sector, those making Apple iPhones and laptops and assembling, as well e-commerce. These two, how do you look at them?
Well, the growth potential for both of them should have huge runway, Lata, right? And like Kaustubh was saying, this is just a start. We need to create more back-ended, value additive component manufacturing in India. And this is very encouraging. It has multiple impacts. In fact, we extrapolated some PLFS data, Lata, and some of the data is very fascinating. That India has added about 5 million manufacturing jobs in the last, 10 million manufacturing jobs in the last 5 years. 90% of that has gone to women, right?
Oh, wow.
So you had the huge problem in India where labor force participation for females was very low. That's actually turned a corner. And this is, of course, extrapolated from a small sample PLFS data. But nevertheless, my argument is this is just a start.
There is a burgeoning of manufacturing jobs.
There is. And we are seeing it in many sort of verticals within that EMS, within manufacturing in general across the country. And there's a lot that can still be done.
Okay. This fascination for FMCG stocks, or rather your pro-FMCG stance, you see that continuing? I mean, are you convinced that there are that many jobs, multiplier effect, good monsoon, etc.?
I wouldn't go that far, right? And the reason, there's two reasons we've looked at FMCG a little bit favorably. And one is, of course, purely tactically rotational. Because India, if you look at the behavior of stock markets, is a very mean reverting market. And because of the flow of liquidity, investors are always on the lookout for nice quality stocks that have underperformed for a while. And FMCG fit that bill very nicely, right? And then you have companies coming out and telling us on the margin really that things in rural India might be getting a little better. So to your question, I'm hesitating to give you a right answer. Are we seeing conviction that things are getting better at lower income consumption? Not yet. Okay. It's more of a hope trade. That's right.
Okay. Well, to be fair, we had Sunil D'Souza of Tata Consumer, and he said much the same. It's hope that it should get better. Yes. H2 should be much better than H1. But Sajid, I want numbers. What are you expecting in October? Stance change? First rate cut December?
We lean towards the first rate cut in December. The stance change in October is a little tricky. Financial conditions in India are very benign already. Like, look at stock market valuations, look at credit spreads, right? And so one risk the RBI runs is, even if you want to signal a cut in December and you change your stance, you'll get a further easing of financial conditions. So at some level, some EM central banks are stuck between a rock and a hard place where you have to sound hawkish until you actually switch for risk of making financial conditions even easier. So it's a very close call, but I think we're leaning towards the first cut in December, by which time you'll have a second quarter GDP number on November 30th, and more importantly, conviction that inflation is settling in the low 4 handles where we think it is for much of 2025. We haven't spoken about the fact that crude is 10% down at 73. Commodities are down. This is good for growth in terms of trade shock.
What is your year-end inflation? Is it RBI's 4.5?
A little bit lower. So actually, our inflation forecast for this quarter is about 4%. For next quarter is 4.3%. So it's a little bit lower than the RBI's forecast. And I think once they make those downward revisions, we're getting closer to the rate cycle starting. The last thing I'll say is the trade-off for the RBI is to use rates for growth and inflation. But we have to be cognizant that financial exuberance doesn't run too far ahead. So you may need to see more macroprudential tightening to curb financial exuberance, even as you're cutting rates to address growth and inflation.
Okay. I was going to ask you that because the Reserve Bank would be worried about, possible froth in the economy. But before I come to the one number which I'm going to ask you, how would you look at financials in the context of rate cuts? And as it is, we are seeing, the market yields go down because of the bond inflow. 6.75 is here. So, and most of the loans are benchmarked to repo rate and T-bills. Yes. But deposits are not falling. So, why would you be, are you positive on banks, non-banks?
Look, that there will be pressure on margins is without doubt, right? It's the ability of which segment of which financial can reduce that impact or mitigate that impact the best, right?
Or counter it with growth.
Counter it with growth, we'll see. But ultimately for growth, you need the raw material for growth, which is scarce at the moment, right? So it's a question of time where the entire system has to go back down or track the level of raw material available in the financial system.
So NBFCs would do better then?
Technically, yes, historically. But we must also remember that they are not direct deposit taking, right? So they have a disadvantage.
So their cost of raw material also goes up.
Exactly, right? So it's in this sort of setup, the deposit franchises, the PSU banks who are flush with liquidity, at least relative to others, look a little bit better, to be honest. But we do like some segment-wise NBFCs where we see the underlying business demand being strong enough to mitigate it. So you have to be a little bit nuanced with the view that everybody's margins is coming under pressure.
Okay, well, the number question first to him and then to you. Do you expect, Kaustubh, that the FII flows, just gets unblocked next year? People wait and then go overweight on India, or at least equal weight on India. So what would your forecast be of FII flows next year into equities, next 12 months?
I think there are two key themes that are driving the forecast for FII flows. One is, of course...
More than last 12 months?
More than last 12 months.
Okay, yeah. And substantially more.
And maybe at least 10-20% more, just because of the quality of supply that is going to come to the market. So I think we always need to look at FII flows in terms of capital market activity. FII flows is not only chasing secondary market purchases. Indian capital market, just to give you some sense, Lata, in 2020, the peak for global equity capital market volumes was in 2021 for all markets. India is the only market where I think so far we have almost raised $45 billion of equity through primary and secondary. By the time we are completing this year, we will get to $55 to $60 billion of total equity raise in the market, which is 40% higher than our 2021 level. And everywhere in the world, all other markets are 20 to 40% lower. So when you have this amount of volume of activity, then it is just not logical or possible that FIs will not be very, very closely tracking. And we at least don't see any reason or clouds on the horizon why this momentum that I think we have created is going to slow down getting into 2025.
Just one word, are there more investors queuing up for your investor conference this time?
Yes, so I think
How many more?
This year we have about 1,000 people attending our conference. The number of investors, and we stopped registrations because we couldn't accommodate physically, I think, the requests we are getting. But we're about 35% higher in terms of number of equity investors who are coming up. And more importantly, a very good mix between Asia, Europe, US, and of course, India. So we are getting, hopefully, I think, what is this telling? I think it's just telling that investors also are deeply caring about what's happening. And therefore, if they get a good platform like us, they are keen to participate.
The most important question. Therefore, what's the kind of equity gains, not just Nifty, I mean, generally for the investor in 12 months, in 24 months?
We are relatively cautious on that front because the Nifty is close to the upper end of our forecast range for this year. And this, of course, you struggle to argue that, the returns will be generated only on multiples, right? You need to see earnings growth. For FY25, the base case consensus is about 12%, but in the first quarter, we've got sub 5%.
Yes.
Right. So there is a little bit of a tone of caution we're using, and we believe that there needs to be a healthy consolidation or maybe, let's say, a correction even before we start to talk of further strong returns.
So not in the next 12 months, but the next 24 months are glorious.
Yes. So look, ultimately, equities are relative growth instruments, right? If India's growth sustains, then returns will come. It's as straight as that.
This is an unfinished conversation. Yes. We'll catch up. But that's the optimistic story coming in from JP Morgan. We are going to see a lot of foreign investments coming in. Yes, growth will slow a bit because we are in the mature part of the cycle before it picks up again with both government capex and private capex kicking in. That's it on this edition of the JPM Brains Trust. Thanks for watching.
RBI Monetary Policy Committee of Reserve Bank of India will take a decision at appropriate point of time. Right. And my sense is that their decision is based on what is good for the Indian economy. We should not read too much into the event which happened yesterday.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC-TV18, now streaming live 24/7 on YouTube.
But the key point here is what the Federal Reserve believes is the neutral rate. So my guess that is probably in the 3 to 3.5% range. So even if the US achieves the soft landing, so to speak, we're probably going to be at between 3 and 3.5 by the middle of next year. But in terms of the short term, I'm surprised I'm surprised it's 50 basis points. Anybody who can read and listen is contrary to the messaging going into the meetings, so my guess at the margin is political.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Sensex and Nifty hit record highs in intraday trade after the US Fed cuts rates by 50 basis points, but both indices give up some gains in late trade. Mid-caps continue to underperform. India's Economic Affairs Secretary says the Fed rate cut is unlikely to impact foreign inflows into India. Many economists do not foresee big rate cuts from the RBI, at least until the end of this year. Bharti Airtel and Vodafone Idea lose the final legal remedy available in the AGR case. Supreme Court rejects curative petition filed by the companies alleging calculation errors by the government. Both companies owe more than 1 lakh crore rupees to the government. First Source is reinventing itself, says Sanjeev Goenka, as the company enters Australia and New Zealand. Goenka also says First Source will hopefully announce a new acquisition soon.
We've really executed quite well in the last 6 months. So we've materialized a lot of the potential.
Shares of Bajaj Auto hit a lifetime high, crossing 12,000 rupees. Rajiv Bajaj says shares can hit 20,000 rupees as exports are doing well, and Freedom and Chetak have gained traction. That's an exclusive. Government investigates allegations of unsafe and exploitative environment at audit firm EY after the death of a 26-year-old employee. The mother of the deceased blamed extreme work pressure for her death. Within 4 months of joining the company, EY calls it irreparable loss and says it has provided assistance to the family. After pagers, more communication devices used by Hezbollah explode across Lebanon, killing 20 people and wounding 450 more. Israel declares the start of a new phase in the war. Prime Minister Modi reiterates the promise to restore statehood for Jammu and Kashmir at his first election rally in Srinagar amidst tight security. Accuses Congress, National Conference and the PDP of trying to divide the state.
Ultimately, I think society will benefit for what is, in my humble opinion, electricity for the 21st century.
Artificial intelligence is the electricity of the 21st century, says Vallabh Shah, the chief digital evangelist at Salesforce. Exclusive interview coming up. All right, let's start with the market action. Sensex and Nifty hit record highs in early trade as a 50 basis point rate cut by the US Fed fueled a rally, but markets did give up some of those gains but still managed to end in the green. Mid-caps continued to underperform with the index ending in the red. On the other hand, financial stocks saw healthy gains with the Nifty Bank Index adding almost 300 points. And the top story this evening, the United States Federal Reserve kick-started its much-awaiting easing cycle with an interest rate cut after over 4 years. It handed out a hefty 50 basis points cut against a widely expected 25 basis points cut. Speaking at a press conference later, Fed Chair clarified that nobody should assume that this is the new pace for reductions going forward. He said that Fed committee has greater confidence that inflation was moving sustainably towards the target of 2% set by the central bank. He also stressed that the Fed's goal now is to keep inflation stable while simultaneously ensuring unemployment rate does not tick higher. Back home, India's Economic Affairs Secretary maintained that the supersized rate cut by the Fed would not have any significant impact on FPI inflows. Market experts and economists maintain that a rate cut by the RBI, if any, may not happen before the year end.
The Federal Reserve has done what it assesses the good for the US economy, the largest economy in the world. And I see it as a positive for the global economy, including for the Indian economy. As far as your question about flows are concerned, it is a 50 basis points cut from a high level, So I don't see that making any significant